Hi, everybody. My name is Anthony Calhoun, sports director at Wish TV Channel 8, and it is so great to be here with you this morning and talk about a perfect day. How about this weather here today? I mean, here at the Indianapolis Motor Speedway. What a treat we are in for today. Want to welcome you to the CFA Society of Indianapolis Forum, and my goodness, take a look around. Look at this first year. What a turnout. Incredible. Of course, today you're going to be experiencing and hearing from some experts talking about making this economy better here in Indiana, and hearing from some great experts who live it daily. I'll be honest with you, I'm a sports guy, and so I'm so used to emceeing events when it comes to sporting events, but this is going to be a treat for me today to learn more about the great impact folks like you are having here in our city and making it great when it comes to the economy. Can you pick a better place to have a forum, to have a conference than here at the Indianapolis Motor Speedway? I mean, how about that? Opening day of practice as we get ready for the 106th running of the Indy 500 coming up in a couple of weeks. But we got a lot to get to. Sit back, take notes, and really make it a special day for yourself and the folks you've come here with today here at the Speedway. At this time, I would like to welcome the VP of the CFA Society of Indianapolis, a guy who has been working around the clock to make this event a big event here today. Please put your hands together, folks, for Jared Leagers. Let's give him a big round of applause as he comes to the podium.
Wow. I can't believe this day's finally come. It's been a lot of work, but oh my God, to be able to put this event on after a 2-year hiatus from, having our investment forum, to really re-kick this event off at IMS on opening day of practice for the Indianapolis 500. We really just want to set the stage here. This is just the first year, and to have all 275 registrations and all you out there, we really appreciate you. All of our old CFA charter hold members, our base, our old friends that are not charter holders, our new friends that, saw the lineup of speakers that we have here today and were like, that's really interesting. And that's kind of the vision of the society moving forward, is we want to open our events up to everyone, that we're not a closed group, and we want to put on educational and knowledge building events that anybody can take part of to really highlight what being a charter holder is. So like I said, the goal here is to build this bigger. We want to fill this whole room up next year. We want to have it a regional forum. We want to show that Hoosier hospitality that we have, and have people come in from Chicago, Ohio, and from there just continue to move on. Really excited to kick this event off today. And this year's theme is Think Global, Act Local. So it's a little bit of a twist. We're going to be covering all global topics, but we're also going to cover having people that are public markets, private markets, government officials to talk about what's going on globally, but then what is Indiana doing to, combat these trends, and how can we continue to compete and excel on the global stage. So really excited to launch that, with also a announcement coming that Chris will talk a little bit more about, of an event series that we'll be launching that's talking about all things Indiana investment. We're really excited about this, and we can't wait to share you more details. But other than that, I wanted to say I got to give a lot of shout outs to people, because you can't put on an event like this without the power of the group, power of the team. And this is a volunteer board. So I'm just incredibly proud of our whole board for putting this event on. But there's a few people that definitely need recognition for helping to put this on. And so I want to shout out Matt Henry. Matt Henry did an amazing job helping pull all these sponsors together. And then if we could hold the applause to the end, but Roger Lee, Chris Reckley, Luke Zhang, our event coordinator, Kayla Garcia, our executive director, Ashley Murder. And it's unfortunate to have that Scott Ryan was not able to be able to hear. He had a business trip overseas. We really miss him, but this core group of people have been with me since the day one of this, started planning this back in September. And you guys probably hate me, but dude, I hope you're proud of what we were able to put on here. It's because I'm super proud of what we've been able to do here. And then if we could, here we have all of our sponsors, and this event doesn't happen in this forum. We've typically done it at hotel conference rooms. This event doesn't happen without our sponsors' monetary support. And so I want to call out each and every one of these because they actually mean so much to the event. They're why we were able to discount the tickets to where we were. But first off, I want to thank our sustaining sponsors throughout the year, Northern Trust and JP Morgan. And on that line, I also want to shout out, unfortunately, our guys from First Trust couldn't be here, but our biggest sponsor throughout the year, First Trust, I really appreciate their support. And then kind of getting into the event, our biggest sponsor, CBRE, who's going to be providing all the drinks and appetizers when the fun starts and we hit the garages at 4:30. Thank you, guys. It means a lot. And then our session sponsors, we have Barnes & Thornburg, T. Rowe Price, and DWS. Thank you, guys. And then getting into all of our table sponsors, we've got New York Life, Goldman Sachs, Eaton Vance, Voya, Diamond Hill, Barings, Innovative Portfolios, Purple Ribbon Office Solutions, Reams Asset Management. I want to give you guys a shout out for being our first local firm member and helping us to get that off the ground as we try to re-strengthen our ties with our local employers of charter holders and people just in the investment world as we try to continue to put on high quality events like this for Indianapolis and our base. Barron Funds, Fort Wayne, Purdue University, Vallejo, and Star Financial. So I just want to give a huge shout out to everyone that helped put this event on. I want to shout out all you people for coming to this event and being a part of this. And hopefully we can continue to make this a bigger event going forward. So thank you again. I'm now going to turn it over to our president, Neil Banwort, to talk more about the society and the direction that we're moving.
All right, good morning. It's great to see everyone in person after a couple of years of Zooms. Who's excited to be here for an in-person event? So this morning, I'm going to tell you a little bit about the CFA Society of Indianapolis. But before I do that, I'm going to zoom out a little bit and talk about the CFA designation, because I know that there are some here who are not familiar with the designation. So there's a lot of acronyms in finance, right? It's alphabet soup. But the CFA stands for Chartered Financial Analyst, and it's considered the highest distinction in the investment management profession. It's often referred to as the gold standard, okay? To gain this designation, you have to pass 3 exams, aptly named Level 1, Level 2, and Level 3. To pass these exams, it's recommended that you study for 300 plus hours for every single exam. Right? So if you take all 3 exams and you pass them all on your first attempt, which is actually pretty hard to do. There's only about 10% of the candidates who actually pass all 3 on the first attempt. But if you do that, you've probably put about 1,000 hours of studying in, right? At a minimum. You have to have a bachelor's degree, you have to have letters of recommendation. But when you obtain the charter, it literally opens doors that you never would have thought would be possible. And obtaining this charter can literally change your life. You know, some people say that attaining the charter is kind of like running a marathon. And I've actually ran a marathon, and I'm a CFA charter holder, and I would say it's no comparison. The marathon was easy compared to passing the CFA for me, right? The time commitment, it's absolutely incredible. And so I would encourage you to, if you're not familiar with the designation, to do some research and to think long and hard about pursuing this certification. There are about 160,000 charter holders across the globe, and a lot of the work is done at the local society level, right? There's 161 societies around the globe, including the CFA Society of Indianapolis. And we're about 400 members strong. Most of our members are CFA charter holders, but not all. You do not have to be a CFA charter holder to be part of the CFA Society of Indianapolis, and we would welcome you to become part of our society. Most of our members are located in the Indianapolis area, but not all. We cover the entire state of Indiana. So we do have some charter holders in Fort Wayne, Lafayette, Bloomington, Terre Haute, right? So although we're the CFA Society of Indianapolis, we really are the CFA Society of Indiana. So what do we do as a society? Well, we get together to learn. We get together to network. We have annual events like this one, the Investment Forum. We have a forecast symposium. A few months ago, we had that at Lucas Oil Stadium. In the past, we've done those at Bankers Life or Gainbridge. We have fun, right? We have an annual golf outing. It's a fall event, a great event. We have happy hours. Some of our events are purely social in nature. We educate, right? By nature of our backgrounds, education is very important to us, and so we want to pass that on to the next generation. So we meet with students, we meet with professors and talk about the charter and the benefit of obtaining the charter. We also host an annual research challenge, which is personally one of my favorite events that the CFA Society is involved in. And this is an international competition that starts, again, at the local level. What we do is we partner with research institutions and we identify a publicly traded company. We give one ticker symbol to a group of undergraduate or graduate students. And these students research and they come up with a buy, hold, or sell recommendation and a target price on this stock. And then we get together for an in-person, basically competition, stock pitch, and the students make a presentation in front of a panel of judges. There's a winner. There's a local winner of our research challenge, and that winning team advances to a regional final where they compete with other societies in the Midwest. And then the winner of the regional final competes on a global basis. The winning team of the Global Research Challenge gets job offers immediately from Wall Street. So if you are an undergraduate student and you have on your resume that you won the Global Research Challenge, Wall Street firms line up to hire you. These are the best of the best. And we have some of that talent here locally. If you're an HR director, tell your HR director about this event next year. Send them. It's a great way to identify the next generation of financial talent. So if any of that intrigued you, how can you learn more? Well, of course, we have a website. Go to our website, and I'm excited to announce we're going to have a new website here in a couple weeks. Stay tuned for that. We're on social media, so you can follow us on LinkedIn and Facebook and Twitter. We have many sponsorship of opportunities available, as Jared highlighted. We have this new local firm membership opportunity. It's a great value, and we'd love to see more firms step up at that level. We also have a new podcast which we launched called Hoosier Money. So go ahead and search for that. We have a couple of episodes that have already been released, and we have more coming. Come to one of our events. One of our goals, as Jared indicated, is to increase our membership base and to have more people attend our fantastic events. We'd also encourage you to just go ahead and sign up for a membership. It's less than $100 a year, and it's a fantastic value. We're really, really excited about the future, and we want you to come to be a part of it. As Jared indicated, we have a pretty exciting announcement, and in a second, I'm going to have Chris Reckley come up. But before we do that, there's one very minor operational issue. When you walked in, when you registered, I hope that you got a wristband, okay? If you did not get a wristband, but you want to take a tour afterwards, and I anticipate most of you do, please see either Ashley, can you stand up? Tanya, Wilson, and then Lamika. If you can see one of those, they will take care of this, right? I just wanted to clear that. So see one of them. With that, I'm super excited to announce Chris Reckley. Come on up, Chris.
Thanks, Neil. Welcome to everyone, and if this is your second or third time coming, as Jared alluded to, you're going to see a little bit of a change in the afternoon session compared to how we used to do things. Hopefully you've noticed the giant Hoosier Hub logo next to me. About a year ago, a group of us, half CFAs, half non-CFAs, began to start kind of brainstorming on this Hoosier Hub idea, this Hoosier Hub Investor Series, under the umbrella of the CFA Society of Indianapolis, with the goal of covering more private market type investments that you don't traditionally see in the CFA. Traditionally, the CFA covers a lot of public market type items, whether it be equities and bonds. And unfortunately for investors like myself, which I am a CFA charter holder, I also work in the private space. So some of that, it leaves something to be desired. In this series, we want to touch more on local private type investments, whether that be private equity, venture capital, real estate, anything going on within as the name alludes to, within the Hoosier realm. Anything that you could touch or see, it's tangible in the local papers. That's the lane we want to play in. There are a lot of big things happening. You're going to hear about a lot of it today within our state, within our city. And we need to be able to really touch on that, whether it's on a national and a global scale, and show what Hoosiers are really doing on the investment side. It'll allow us to have the opportunity to learn from each other, network, create ideas, and see things from different points of view versus the traditional CFA public equities type angle. So that's where kind of that think global, act local comes into play. Excuse me. Our thought was if we could broaden the scope and the topics that CFA Society of Indianapolis actually covers, we would be able to diversify a talent pool, gain better insights across less covered asset classes, especially in the CFA curriculum and standard traditional events that we get to hold. Our first proof of concept was a Hoosier Hub event late in 2021. Our own Trey Buck of Gravity Ventures had a panel with Midwest Venture Capital Studios. It was a huge success. The title of it, if you're a Phil Collins fan, was Stu Studio. If you're not a Phil Collins fan, you should be. It was a huge success in terms of our first event, the audience, the actual amount of people that had showed up, and then on top of that, it was the most diverse background of attendees that we had ever had, whether that be your background, whether that be job, age, sex, gender. It really was kind of like I said, a proof of concept to say, if we broaden what we're looking at in the investment world, the investment criteria, what different ideas, what different people will we actually bring to the table, and can we actually share ideas on? So we were really encouraged by the initial representation of that event, and we wanted to keep that going with this series. So you'll notice in the afternoon, we're going to touch a lot on local private market type sessions. But going forward over the next few months, we'll have a real estate event, multiple private equity events. So we really encourage you to show up and come join us. So we look forward to seeing you. And if you have any questions on it, there's a few of us here who have these blue shirts we're going to be carrying around. Feel free to grab us and peg us with some questions. And with that, I'll turn it back over to Anthony and take it away.
All right. Thank you so much, Chris. You guys ready to go? You ready to have a good day? You ready to have a good day, everybody? All right. Session 1. Here we go. Back home again in Indiana with the governor. Our great governor of this state, Governor Eric Holcomb, has done a crazy amount of international travel, folks, recently after the lockdowns, of course, sharing his observation thoughts on how Indiana is globally competitive. He is doing whatever he possibly can to attract companies to invest right here in our state. Please put your hands together for a very busy man that's taken time to be here with us today here at the Indianapolis Motor Speedway. Our great governor of the state of Indiana, Eric Holcomb, everybody.
As always. Thank you, Anthony. As always, I'm going to set up my little prop here, do my part to advertise the good work that you're doing. Good morning, everyone, first and foremost, and welcome here, whether you're from Indianapolis or Indiana or around the Midwest. So thrilled that you're here. Anthony, you say I'm a busy man, but I'm never too busy to come to the IMS. And a little birdie told me that there was already beer flowing back there. And so you mentioned 4:30, and I guess it's true, it is 4:30 somewhere. right now, but really pleased to have you here at the home of obviously the world's largest single day sporting event. Obviously in a couple weeks we're gonna getting revved up, as you can hear. I applaud your focus or your ability to multitask with the sound of those engines roaring around the track right now as you work. I'm glad that I am not speaking at 12:30. I understand Jay Powell is going to be speaking at 12:30, so I suspect there'll be a lot of phones out during that panel. But obviously, as we ramp up for the 106th running of this special place and special race, it truly is no place like Indy on planet Earth in the month of May. So much going on, so much activity, so much of that hospitality on full display. And I would encourage, I'd be remiss if I didn't say, if you're not from here and you don't already have tickets, there is still room. It is not completely sold out. I'm a firm believer in taking care of the people that take care of your money. So if you have trouble finding a ticket, please find me. And we'll see what we can do to assist. I would, depending on your interests, I would recommend a seat in the stands, not in the infield. You can see things in the snake pit that you can never unsee. But if that's your thing, there's plenty of room in the end, so to speak. And it's so large. I always marvel at just how expansive this place is. And if you're not from here, I'll tick through what you can fit on these grounds. You can fit Churchill Downs, Yankee Stadium, the Rose Bowl, Vatican City, the Taj Mahal, the White House, Liberty Island, and the Roman Coliseum. And since this is primarily a Big Ten or a Midwestern crowd, you can fit 14 Big Ten football stadiums lined up right next to one another just on these grounds. And so it really is a massive space. And it's extra special when we get to share it with organizations like you, like the CFA Society and the Institute, and really share just how much of a part, this is really our DNA. This is a part of who we are as Hoosiers, and it gets traced back to our rich heritage and where we came from. This was originally built in 1909 as a test track, as a proving place for engines and auto manufacturers. So it was this kind of the epicenter of innovation. And still we find ourselves right back in that very same place out here, constantly seeking to, as a state, and as this kind of future of mobility presents itself around the world, this is where that's occurring. And it's just a real honor for us to try to roll out our welcome mat for you, and hope that you not only just take it all in, but you consider even investing more of your time and interest here. When I think about this place, maybe reading about it in 1909, and then even 2000, we have a relatively new owner. If you're again unaware, Roger Penske bought the place in November of 2019. It was in the newspaper today that he's invested, and that's right before COVID struck and really hammered a lot of the hospitality industry and sporting events all over the world, obviously. But he's plowed in about $30 million to spruce the place up. And I can tell you, I grew up on the west side of Indianapolis, and this place has never shined, never sparkled, never looked better than it does today while you're here. So I would also encourage you to, look under the hood and really kick the tires and just see all that has been improved, and a lot through innovation. And that's something that we pick up all over the world and something we seek to emulate. Roger Penske is known for Penske Perfect. So if you go in the restroom, hopefully you will see one of the, if not the cleanest restroom at a sports racetrack. I want to know where the cleanest is. because so much thought has gone into you having the experience that was just as special as was for him in 1951 when his dad first brought him here. And all the investment that goes in to make sure that this is truly a fan-centric experience. And so, again, special place for us. It's also a pretty special place because it's also international on steroids. When you think about the drivers and the fans that come here from all over the world, many through our airport, which has been ranked the #1 international airport in North America for the last 10 straight years. That's more than a streak. That's called dominance. That's called dynasty. And we seek to make sure all those pieces, again, from the time you step off the plane or you pull into this track, that the experience is one that's going to make you not just remember it forever, but it's going to make you want to come back. And that's what that Hoosier hospitality is, and this is something that we seek to export all over the world. We get these ambassadors that are the drivers. I'll never forget, in a 5-year period, 2015 to 2019, 5 of the winners, those straight 5, were from a different continent, not a different country, but a different continent. So it shows you the far reach of the sport and the ability for us to connect into different communities and really be able to share our message. You're going to hear from our Secretary of Commerce, the president of our Indiana Economic Development Corporation, later today, and I'll leave it to Brad to rattle off kind of the Indiana highlight reel. But we are gearing up for this weekend. He may allude to this, but we are gearing up to take our efforts. As Anthony mentioned, I get around. I'm a firm believer in you got to show up if you want to win, and I'm constantly reminded, and wherever I go, about the number of folks that aren't in the competition. And when I see those 33 cars out there driving on race day, I kind of envision 50 states out there tweaking every last little thing on that car to get it to go faster and more efficiently. And so, as Anthony said, in the last 50 days, we've been in Slovakia and Israel and the UK and Monaco and Sweden, to name just a few. And some of this was for diplomatic reasons, some of it was for economic reasons, but it all is geared toward the same thing, and that's your slogan. And I call it global because it really is a mesh. I love how you use global and acting locally, because it really is a mesh of the two words. And you find yourself doing business with Slovakia, maybe as an example, one day, and then a friend in need is a friend indeed, and you find yourself over there for a whole different reason. And the state of Indiana shipping armored personnel carriers because we have a long-standing Indiana National Guard agreement with the nation of Slovakia. And so we're doing our part with dealing with the Ukrainian crisis right now through those bordering nations. And I just couldn't be more proud that to be hosting at this moment in time around the world with all the changes, technological changes and others, and all the challenges that we are both facing, to be hosting a global economic summit. And I hope you'll connect with that in some way, because we're pulling in, as it stands right now, and Brad may update me in a few hours, but as it stands right now, we've got 29 different nations from around the world coming here on May 26th and 27th. Again, from those very same 5 different continents that those winners represented. and having diplomats and CEOs of Fortune 10, Fortune 50, Fortune 100 companies speak for 2 straight days on topics like food security and sustainable practices, the impact of AI across industries, building the next generation fleet, full throttle sustainability, the digital health revolution, curating the economy of the future, applications for life sciences in a post-COVID world, the economic development and its impact on local communities, building the future via green manufacturing, internalizing DEI core business models, supply chain disruption. We'll have a specific focus on semiconductors, public policy implications, and transforming talent, the energy transition, the geopolitics of sports, vet tech, building trust in a global, with a global, all the technology advancements globally, and then how they again kind of wash upon or crash upon the shores of different regions of the world, and the future of the hydrogen fleet. That's probably 15 of the 30 panels that we're having, but you can see this is the breadth and depth and the real kind of maybe the sizzle and the substance, that balance of the topics that are going to be discussed is, I think, well worth your attention as well. All of this in the context of what you all do, where you all are leading in terms of investments and where they're occurring. We're living through, again, I'm not going to get into the weeds, but State Representative Jerry Torres with us today, and we've been hard at work about simply providing a state of stability and predictability and certainty and, quite frankly, continuity. It is what obviously markets crave. It is what we think citizens of and around the world are seeking. And so we're very deliberate, very methodical, very careful about making sure that we're cultivating that very environment. And the proof is in the pudding, so to speak. When you look at our recent growth patterns, we are shattering all previous records in terms of capital investment, in terms of payroll, in terms of new jobs, high wage jobs, in terms of foreign direct investment. We tripled our foreign direct investment from 2016 to 2018, just before the pandemic obviously took real hold, but it hasn't slowed down our momentum. And so you'll hear more of the pitch, I think, from Brad later today around 2:45. But until then, I hope that you enjoy this. If you're not from here, I hope that you enjoy this Indiana oasis and make a lot of money along the way. Thank you all very much for being here.
Another applause, everybody, for our governor here, Governor Holcomb. Thank you so much for taking the time. All right, moving on now to session 2. What's behind the bond market rout? Jim Bianco, the president and macro strategist at Bianco Research. Everyone in America is very curious, of course, about where interest rates are going, from home buyers to retirees living on a fixed income. Jim is going to give us his thoughts on where things stand with the global bond markets as of today. Jim is the economist expert, I should say, on the global economy and currency markets. By the way, he has an epic Twitter account, so make sure you check that out. Please put your hands together for Jim Bianco.
So it's unfortunate that people like to come to racing events to watch a wreck. So let's hope that there's not a wreck, because I'm going to talk about the economy, so that'll be your rec for today as we go forward from here. When will the Fed stop hiking interest rates is really the question that everybody wants to know. And the short answer I'm going to give you is when inflation peaks and starts down. And unfortunately, that's going to take some effort to get inflation to peak and come down. And it's going to continue to be a turbulent market and a turbulent economy as we move forward from here. So if we go to my first slide, these messy charts I'm going to show you, I'm going to start off by highlighting the bond market. This is the Bloomberg Global Aggregate Index. All those gray lines are each individual year of the history of the index. That black line is the total return for this year. Not only is the bond market having its worst year, it's having its worst year by miles, to use a car analogy as well. If you go to the next chart, it shows you the monthly returns. Not only was April the worst month in record, it was the worst month by a long shot in a record. If we go to the next chart, this is the Bloomberg Global Aggregate Index, which goes back to 1976. And the black line shows you the total return is down 10%. The bond market has lost you 1/10 of your money in 5 months. It's not only the worst that it's ever been, but as to complete this thought, the next chart comes from Deutsche Bank. They calculated, and this is no typo, they calculated the total return for the bond market back to 1785. 1785. And this is the worst year since 1788. So we've now had the worst year in 250 years in the bond market. That's how much pain has been meted out to, to bond investors. Now, how can it be? I remember when interest rates were 15%. You probably do too. How could it be now is the worst that we've ever seen in the bond market? Because it's a combination of low interest rates and the volatility of price. And since you're not getting compensated enough for in coupon payments, this sell-off that we've seen in price has been a toxic cocktail that's led to one of the worst bond markets we've ever seen. So if we go to the next chart, why is that happening? Because we have the worst inflation in 40 years. The inflation rate, which came out last week at 8.3%, was the second straight month in a row where the year-over-year number was above 8%. The orange line on the chart is the core inflation rate. The core inflation rate was above 6% for the third straight month in a row. And you have to go back to 1981 to find another period when it was like that. And what's kind of behind the inflation event, if we go to this chart here, the top chart shows you in bars the actual monthly inflation numbers, and the orange line is Wall Street's estimate. But look at the bottom chart, 14 of the last 15 months, the inflation rate has either been at Wall Street's estimate or above it, 14 or 15 months. Wall Street doesn't understand this inflation. They've been consistently wrong now for almost a year and a half by underestimating the inflation rate that we've had. Now, what's causing the inflation rate? Well, it's obviously, now I shouldn't say obviously, it's two things that are behind the inflation rate. One, we talk about, you hear about all the time, and that's supply problems. Whether it's the supply chain, constraints that we have, and I've got more on that later, or the war in Russia and Ukraine constricting energy prices and or agricultural prices, we know that there is a supply component to this. But there's something else going on if we go to the next chart. Now, this is a messy chart. What this is this is from the Organization of Economic Cooperation and Development, and that big black line on the top panel is the U.S.'s inflation rate, and there's all different colored lines on that chart for the 30 most developed countries in the world. The bottom panel shows you the percentage ranking for the U.S. It's at number 100. Now, 100 is not good on this chart. It means we have the highest inflation rate in the developed world. We almost never have the highest inflation rate. We almost never have the lowest. We're always somewhere in the middle. But right now, we have the highest inflation rate. So, is it a supply chain problem? Well, Europe, Asia, Middle East, they have the same supply chain issues. They have the same energy issues. They have the same problems with agricultural prices. But why do we have a higher inflation rate than Canada, then the UK, then France, then Japan, then Australia, and all the other major countries in the world. And if we go to the next chart, why does this matter so much? It matters so much because inflation is outpacing wages. So the top panel, if you go back to this one, the top panel in orange is that same inflation rate I showed you. In blue is the average increase of salaries in the United States, which is a little over 5%. That bottom panel shows you that salaries are not keeping up with the inflation rate. Now, an important thing to know about this chart and about the state of the economy as we move forward from here. The Federal Reserve does a study of consumer finances. They do it every 3 years. The last one they did was 2019. They're going to do another one this summer. You might have remembered this when it came out, but they estimated in 2019 that 40% of the American public has less than $1,000 of savings and they rent. So when their wages are not keeping up with inflation, those red bars on the bottom, quite frankly, those people are getting killed. They don't own a home like we do. They don't have an investment portfolio. The S&P was up 29% last year. The Case-Shiller Home Price Index was up 19% last year. Inflation was up 7%. So if you're like me and you own a home, you have an investment portfolio, even if you underperformed, okay, I did better than inflation. I'm better off at the end of the year than I was at the beginning of the year. But if you're part of that 40%, you don't have any investments, and you don't have a home, what those red bars mean is you buy less stuff every month. And it is showing up in the political polling in a big way. But let me turn back and go to this next chart from the San Francisco Fed. Why is it that we have that high inflation rate? And why is it that those 40% are being hurt so bad? San Francisco Fed did a study and found that of all the major countries that stimulated their economies because of the COVID lockdown, either fiscally, and that was the CARES Act, and that was all of the stimulus money that was mailed out, or monetarily, with the Fed doing quantitative easing, the U.S. ranked number 1. Now, this is not necessarily another place where you want to be ranked number 1. That's what the blue line is. That's the amount of disposable income, real disposable income that the U.S. has seen since 2019, and the red range is the rest of the OECD countries. We stimulated the hell out of our economy. And while you might argue we got some good benefits of it, we have a 3.5% unemployment rate, as opposed to a higher unemployment rate, we also have the highest inflation rate. Now, the difference, though, is that while maybe we went from a 5% unemployment rate to 3.5%, that benefits 1.5% of the population. But inflation affects 100% of the population. Every single person feels inflation. And if we go to the next chart, the San Francisco Fed estimates that the inflation rate, or the amount of stimulus, fiscal monetary stimulus we did, added 3% to our inflation rate. So where would we be because of supply constraints and the reopening of the economy and inflation? They're estimating we'd be at 5.3%. Where are we? We're at 8.3%. That extra 3% is what I think the Federal Reserve is going to try and take out of the inflation rate by raising interest rates and sticking it to investors, quite frankly. That's what their job is. I'll talk about that in a second. But if we go to the next chart, this is probably the most unbelievable statistic you could find. This comes from Zillow. Zillow has, and the top panel shows you their home price index. The average home in the United States now is $338,000, according to Zillow. The average home in the last 12 months has gone up $58,000. The average income in the United States is $50,200. The average person has made more money off their home going up last year than they did at their job. That has never come close to happening before, not even in 2006, before we had the housing bubble. And that's because of this massive stimulation that we've seen in the economy that's been leading to all this inflation. And the next chart shows you that over the last 2 years, the stock market's gain has been 95% of GDP, or about $19 trillion. The stock market has gained in value about the size of the economy. And this chart, by the way, goes back to 1928, and we've never seen anything like that before. So we've got a terrible bond market, which is impacting every investment right now because of higher interest rates including the stock market. It's coming about because of inflation, but we just don't have inflation. We have the highest inflation because of all of the fiscal stimulus that we've done. And it might be adding 3% to the inflation rate. So if we go to the next slide, this is from Jay Powell's press conference 2 weeks ago. This was his opening paragraph. I'll read it to you. Before I go into details of today's meeting, I'd like to take the opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we are moving expeditiously to bring it back down. And this is key. We have both the tools and the resolve it will take to restore price stability on behalf of American families and businesses. What does that mean? We have the tools and the resolve. It means we're going to raise rates, and we're going to raise them enough that it hurts. And when you say it hurts, we're going to keep raising them. And our goal is, if we go to the next set of slides, this is Jay Powell last Thursday speaking at the Marketplace radio show. And I will highlight some of the things he said a week ago. I will say we are in the process of getting inflation to 2%. This will include some pain. That's what he warned us. It will ultimately be but ultimately the most painful thing would be is if we fail to deal with inflation, we're to get entrenched in the economy at high levels. We know what that's like. Then he went on to say, nothing in the economy works. The economy doesn't work for anybody without price stability. Demand and supply are out of whack. There's too much demand. Too much demand. Remember, the San Francisco Fed said an extra 3% in inflation. The Fed chairman just told us there's too much demand. There's more demand for workers, and there are people that are taking jobs right now by a substantial margin. And because of this, wages are moving up to levels that are unsustainably high and not consistent with low inflation. Made it very clear. And the next slide shows you that Mary Daly, who's the San Francisco Federal Reserve president, said, not only can the economy tolerate 50 basis point hikes, she also said this, I expect financial conditions to tighten even more as we march through these rate increases and remove stimulus from the economy. I think we've made a good start on them already, and I would like to see continuing financial conditions that would be consistent with bringing back supply and demand into balance. Let me translate that for you. You need to lose more money. That tightening financial conditions is precisely, as the next slide shows, what former New York Federal Reserve President Bill Dudley stated in an op-ed last month. If stocks don't fall, the Fed needs to force it. The Fed's out to make us lose money. The Fed wants us to stop spending money to bring down that inflation rate, that extra 3%. We've already gotten a $58,000 increase in our home. And why is the Fed doing that? Because those 40% that don't own investments are getting killed. And that's who their focus is. And this is the crux of the question on Wall Street right now. The Fed has the tools. It's a blunt sledgehammer. Raise rates, inflict pain, get us to stop buying things. That's why the bond market's having its worst year ever. The stock market, by the way, I know it's a little bit of a contrived statistic, but if you look at the stock market's gains or losses from January 1st to May 13th, last Friday, this is the third worst year in the last 105 years for the stock market. Only 1932 and 1940 were worse starts from January to May 13th than this year. Now, there's lots of years that have been much worse than that, but just at least from the beginning of the year, that has been the statistic for it. So that's what the Fed's focus is those 40%. We know they've got the tool, but do they have the resolve? That's really the big question that everybody's trying to figure out on Wall Street. If we go to the next chart, this chart here shows you the betting on Wall Street as to what the Fed's going to do. You can look at this from the markets, and basically what it shows is there is a 100% chance the Fed is going to raise rates at their June 15th meeting by 50 basis points, and a 100% chance they're going to raise rates by 50 basis points at the July 27th meeting. The Fed has never failed. Thank you. The Fed has never failed to deliver on a 100% pricing of a Fed rate hike. So we're looking at a 1% funds rate by July 27th, going to a 2% funds rate, almost a cinch guarantee. Now, everybody knows this, but the question is, will the Fed actually follow through? If markets get messier, will they cave? And that was what happened right after the meeting 2 weeks ago. When Powell said we have the tools and the resolve to deal with inflation, 10 minutes later, he said 75 basis points is not under consideration. Oh, so you're not serious about it, are you, Jay? Because you just said you were serious about it 2 minutes ago, and now you said you're not serious about it. So there's some question about his resolve, is where we're trying to look at. And Wall Street has been focused on this type of metric. This comes from Bank of America. It's called their global stress indicator. Their global stress indicator. So when the line falls, it means that there's more stress in financial markets. Now that dip down, that was the COVID lockdown. Unless we do that again, and God, I hope we don't, we're never going to see markets that stressed. We haven't seen markets that stressed in 100 years in Wall Street history, and we probably won't see that again. But you'll see that little dip down underneath the text there. That was 2018. That was enough to get the Fed to stop rate hikes, stop quantitative tightening, reverse on a dime and call it Powell's pivot. We're worse than that right now. And not only are we not talking about stopping and reversing, we're talking about 50 basis points, 100%, 50 basis points, 100%. So the question is, does the Fed have the resolve to follow through on what they're promising? And as I just said last week, Jay Powell said it's going to involve some pain. And the pain is going to be that they need to get demand down. Now, if they don't have the resolve, now I think they do, but I'll be frank, we've never seen them try doing something like this since Paul Volcker 40 years ago, and this is not Paul Volcker. So we don't know, but we have to understand, if they don't have the resolve, what are going to be the consequences? Here's the national average for gasoline prices. It's $4.48 as of Friday. When I updated this chart, it's $4.53 today is national average. We're at $5.60 right now on diesel. Prices are going through the roof. Now, can the Fed do anything about this? They can get us to slow down our demand. They can get us to try and drive our cars less by trying to get us to do less. But basically, not a whole lot they can. But what the Fed cannot do is say, you see that chart going up for you 40%? I'm sorry, can't help you anymore. I can't let the stock market go down anymore. They cannot do that. They absolutely cannot do that. And here's the price of wheat. Wheat is making another run at its all-time high. They cannot do that either. So, unfortunately, the Fed made a mistake. The Fed made a big mistake in 2021 by using the word transitory. By dismissing the inflation that we were seeing percolate last year, they put themselves in a very difficult spot this year, that they're going to have to respond to inflation, and it's going to be painful. And they have really no choice, because on the unusual situation that we've seen in politics is we've always wanted our central bank to be independent, because we were always afraid if our central bank wasn't independent, that politicians would tell them, like Donald Trump used to tweet a couple of years ago, just print, go to negative interest rates, throw money out the window, and make everybody happy. But now, politicians are demanding that the Fed raise rates. They're demanding that they do something about inflation. Elizabeth Warren has already put a bill in front of Congress to institute price controls across the entire country. She wants every company that wants to raise prices to submit a form explaining why. The House of Representatives is voting on a bill to curb excess prices, whatever that means, in gasoline. So price controls are definitely a big thing in Washington right now. And the Federal Reserve is being demanded to do more because the political climate is terrible for incumbent politicians. They're getting killed in the polls because of inflation. The number one issue in the country, by orders of magnitude, is inflation. A distant second, third, fourth, take your pick, is Russia, Ukraine, social justice, immigration, crime. Those are way behind inflation. And that's why politicians are demanding that the Federal Reserve do something about this. And that's why it's a difficult environment to invest in. And unless or until inflation comes down, it's going to remain a difficult environment to come to. That gets me to my last topic. What else is going to help to bring it down? And this topic I'll call the biggest thing we don't talk enough about: work from home. Work from home is here. It is real. It is not going away. And it is going to mean a massive change in the economy. Maybe as big as the post-World War II boom to the suburbs. That's just what work from home is going to do. Nick Bloom is an economist at Stanford University. He's been studying work from home for 20 years, and now he's got the most important topic to be studying in the country right now, in my opinion. He estimates that 55% of the American workforce of 160 million people cannot work from home. A doctor can't work from home. At least I don't want my doctor working from, don't want him operating on me via Zoom. A policeman, I don't want my cops. I'm in Chicago. We already got enough problems. I don't want my cops trying to police my neighborhood from Zoom. A waitress as well, too. But 45% of the public can work from home. And he's estimating that 29% are doing some kind of hybrid, a couple of days in the office, a couple of days from home, and about 15% of the workforce is fully remote. This chart here comes from Castle Services. They're the key card swipe services largest in the country. And they've been putting out a statistic of what percentage of their offices are currently in use. And as of May 4th, 2 weeks ago, last number, it's only 43% of offices are currently in use in the country. The highest number is in Austin, Texas at 60%. And the lowest number is around 30% in San Francisco. We're 43%. Now, according to Nick Bloom, he thinks this number is going to peak somewhere under 50%, and then that's going to be pretty much it for the rest of time. For the next several years, that number is going to go down. And how to think about that number? A study came out last week. Manhattan, 11% of all office real estate is in Manhattan, and only 8% of it is being used full-time. Everybody else, the other 92%, are either hybrid work or fully remote. This is not going back. We are going to continue to move to a hybrid work or a fully remote environment. As Nick Bloom likes to say, this is his study. And what this chart shows is prior to the pandemic, about 5% of us were working remotely. Then it shot up to 60% in the first quarter of 2020 when everything was locked down. And it's slowly come down to around 40-ish% or so. I'm sorry, this is the percentage of paychecks in the country that are remote. So he's weighting it by who's doing it. So about 40% of the paycheck is for somebody who's working remotely. So this is a real thing, and it has two major consequences as we move forward from here. The first consequence is the consumption basket of the public is changing. So what does it mean that I'm home more, you're home more, maybe full-time, a couple days a week? You consume more things, you consume less services. And what are we complaining about with the supply chain is that it's chronically short because we've changed our consumption basket and we're consuming more things. What do we need to do? We need to spend $1 trillion or $2 trillion to reorient the supply chain, to reorient what we make, why we make it, and how we make it. Instead, what are we doing? Arguing whether or not there is actually a work from home phenomenon in the first place. And so we're not even ready to start thinking about how to fix the problem because we're not admitting there's a problem. We still think everybody's going back to the office. We still think that if there's a recession, we're going to go running back to the office, and we're going to say that we want to, that we're going to go running back to the office. But that's really not the case at all, I don't think, because we've seen 8% of people in Manhattan are going there. And two big things have come anecdotally. The company that has been pushing the hardest to get everybody back to the office, probably in the country, is Goldman Sachs. They are pushing a 5-0 workday, 5 days in the office. And if you know Goldman Sachs, that means 11 hours a day, and probably Saturday too. And just 2 days ago, Goldman Sachs came out and relented and said that anybody that is executive vice president, managing director, or partner can have an unlimited number of vacation days. Now, what does that mean, an unlimited number of vacation days? If you're a partner at Goldman Sachs, you're going to take 125 days off a year? No, but you can work from home or your house in Jackson Hole or the Bahamas, 125 days a year. So what they've effectively done is they've given up on their 5-0 workday. They won't relent on the policy, but they're going to give you unlimited vacation, which means you can work from wherever you want. Apple Computer, that big spaceship office that they have, they've been trying to get everybody back 2 days a week. And what's been happening at Apple? Mass quittings. Their head of machine learning, just him and his whole staff, just walked out the door last week. They don't even want to go back 2 days a week. So my point here is that we also need to understand that every pandemic has led to an epic change in an economy. This one is work from home, remote work. And this is why the economy is off balance. And it's going to stay that way until we say, look, we got to change things because the world is changing. And in 5 years or 10 years, every office space might be only 8% in use, like it is in Manhattan right now. But we're not thinking that way. We're not going that way. And another thing that's affecting is probably, if I was to go back to my chart, it's my last thought for the day, about that home price gain. $58,000 in home prices. People have asked me if the home market is a bubble because of that big gain. And I'd like to say, no, I'm not sure it's a bubble. Well, two things could be true at once. There might be some bubble aspects of home prices that a rise in mortgage rates can change, but it also might be vastly different than any home price market that we've ever seen. And I'll give you one statistic. Redfin looks at the number of homes that trade or are sold at above their list price. Pre-pandemic, about 15 to 20% of homes in the country would trade above their list price. This year, it's 55%, over half. Now, what does that tell me? Why do you hire a real estate broker and pay them 5% of your home price? Because you have only one question. What's my house worth and what is the maximum value I can get? And if 55% of home prices are trading above the list price, it tells you that your real estate broker doesn't understand this market. They're pricing homes incorrectly. Why are they pricing homes incorrectly? Work from home, remote work. Because now all of a sudden, you don't have to look towards the job opportunity in the neighborhood you live in. You can live anywhere you want. Airbnb last Friday announced that they're going to go 100% remote and their employees can live anywhere in the world. And a lot of them are actually leaving the country and still working for Airbnb as well too. So all of a sudden, if you're a home builder and you decide where you want to build homes, spec homes, what is the first thing you look at? What are the job opportunities within a 30-minute drive of that home? Doesn't apply anymore. It's where are the job opportunities anywhere on the planet is really what's happening. And this is why the home market has changed so much. Santa Barbara, California, some of the real estate brokers are now starting to list homes with no price. Just come on in, take a look, and give me your offers. It's basically where we're going. Because they've kind of given up. They don't know what the homes are worth. They're always worth more than what they think. So work from home has really changed things. Again, I think it's the biggest thing that we don't talk enough about, and its impact on the economy. The economy is suffering from inflation because it's out of balance. The Federal Reserve was too slow in acting on that. That's why they are now trying to play catch up, and they're warning us that they're going to be very hostile towards markets. You know, don't fight the Fed. Well, boy, there's never been an environment like this where they've been so openly hostile towards investments before. And that's because they see inflation as something that is hurting 40% of the public and affecting 100% of the public, and they absolutely have to do something about it. I think they have the resolve to do it, and I don't think we're going to like that resolve. If they don't have the resolve and they cave to falling markets or stressed financial conditions, they're not going to like the response they're going to get from the 40%. They're in a no-win situation right now, and that's why you've seen the bond market have its worst year in history, and you've seen the stock market struggle. So as I started off in the beginning, let's not wish for a crash, up on the TV here as they're practicing, because I just gave you the crash here in my presentation. It's going to be a struggle as we get through this and as the Federal Reserve tries to deal with this inflation problem, but it's something that we haven't seen before. So thank you.
All right, we're going to take some questions. By the way, how good was that, everybody? How great was that? That's great. Positive, and I know, but great job. Okay, we're going to open up for some questions. We got 2 mics. We got a question right there, sir. Where's our mics? Where's Luke and my man? Okay, I'll let you handle this. I'll go around.
Okay.
Thanks, Jim.
Yeah, it's on now.
I hear you loud and clear on the Fed put.
Yep.
As long as capital markets are working, there shouldn't be a Fed put. And the bond market's still working here, but financial stability is another, why don't we call it the third leg of the Fed mandate. Full employment, price stability, but they also took on the extra responsibility of financial stability with the global financial crisis. So what would be your number on the S&P 500 before the Fed would be in the Fed put business again?
Yeah, that's a question that people ask me. That's a question people ask me a lot. Where does the Fed put kick in? That is what level? Obviously, there's a level somewhere where if the markets got so bad that the Fed would have to consider changing its policy. I think it's a lot lower than we all think right now. And ultimately, I think that Fed put comes in when they see signs that the inflation rate is done more than just peak, and it's actually started down. So the way I like to answer the Fed put is we're all focused on growth in the economy. When does growth get so bad that the Fed stops? They're focused on inflation. That's their focus. If you go back to that, if I was to go back to that Marketplace radio interview, they said, what 5 words do you think about before you go to bed? And what Jay Powell said was, get inflation under control. And that's really his only focus right now is inflation. So as far as the Fed put, if I was to answer your question directly, I think it's much, much lower than it is right now. We're not close to it yet. So if we're looking at a level where the Fed's got to stop, it's going to be much lower.
If you look at inflation, and you saw deflation for the last 12 years was because of fracking and cheaper energy prices here in the United States. Now we're at a place where we're having an oil crisis and natural gas prices are shot up over $8 for a unit for natural gas. Even with everything that the Fed is doing right now, raising rates, aren't we running into a situation where we're going to be like the late 70s with oil and natural gas because there's such high demand? Even if demand doesn't increase from here, supply is falling. Aren't we having a problem with the energy, and energy needs to come down in order for inflation to come down?
Well, energy can only come down in one of 2 ways. We either need more supply for energy to bring it down. The problem is we're taking Russia offline, and that's 5 million barrels a day, and they're the second largest gas producer in the world. So the supply situation is not going to get better. And then the other problem with energy is 3 letters, ESG. And it's largely becoming understood that ESG has only really meant E, and that has really been a detriment to the energy supply situation. Demand is the problem with demand is it's still very strong, and yet we're getting very little demand out of China right now because their economy's shut down. And yet we still have $116 on WTI this morning is where we're at without China. And as soon as China comes back online, we could see much higher prices. So I agree with you that we definitely need to get oil prices down. But the problem is there's 2 ways to do it. We either need to ramp up demand, and taking Russia out of the equation means You're not going to ramp up demand by the 4th of, you got to ramp up supply, but they're taking rush out of the equation. You're not going to ramp that up by the 4th of July. So the only other option is to get people to stop driving. And that's going to be a tough one. Because the last I saw, we're all paying 5 handles for gas and we're still driving. We're not pulling back, we're not reining in our driving. And the answer is not a $90,000 Tesla to fix that problem for high gas prices.
We have a question over here.
Hey, Jim, thanks for being here. I want to ask about the Fed's resolve and your thoughts on the midterm election, whether they may move more slowly with the election coming up and accelerate beyond that.
No, I think the opposite. They might move faster going into the election. I think, my take is behind the scenes, they're trying to tell the Democrats, stop with the price controls. Do not even go there. Let us do our job. Because I think that they understand that putting price controls on an economy, everywhere it's tried, it's been a disaster. And that anytime you want to because what do price controls do? If you fix the price, you get less supply. I don't make money, I stop making stuff, and you get shortages everywhere. But if you've got panicky politicians that their whole world is the first Tuesday in November, do price controls work to get that inflation rate down by the first Tuesday of November? Maybe, but at a huge cost in 2023. Fine, I'm still a politician in 2023. We'll deal with it then. That's their thinking. So I think if anything, the Fed is going to ramp it up to try and pull down this inflation rate because of the problems that it is causing politically.
Okay, two more questions. Right there.
Jim, we've talked about rate hikes a lot. Where do you see balance sheet runoff factoring into all of this?
So the Fed's going to start reducing the size of their balance sheet by $47.5 billion on June 1st. And they've said that they're going to go to $95 billion by September 1st. So they're going to ease into it. They seem to be worried about balance sheet runoff because they don't. And by the way that works is that the Fed owns $9 trillion of securities, about $100 billion worth of securities a month mature. They're just going to reinvest $5 billion and let the balance sheet fall by $95 billion. They're not going to sell anything. After what they went through in 2018, 2019 with the convulsions in the market when they tried doing quantitative tightening, I think they're going to be very leery about trying to get aggressive on that side of the equation, and they're going to be more aggressive on the interest rate side of the equation. They understand interest rates. They don't understand quantitative tightening as much, but they are going to do it nevertheless. Last question? Oh, okay.
Thanks, Jim. Appreciate it. Thank you. Yeah, one more time, big round of applause here for Jim. Thank you so much for all the great knowledge there. All right, moving on to session number 3. By the way, you guys ever having a good time? Are you learning? Are you able to take something to put in your bag to take with you back to work and to your places where you come from? I hope you are, because that was some great stuff there from Jim. Session 3, as we move on. Will the SEC become the Securities and Environmental Commission? David Hooper, partner at Barnes & Thornburg. The ESG is a very hot topic right now for investors, and the SEC just issued a document over 500 pages. David Hooper is going to give us the cliff notes for what you need to focus on. As I mentioned, Dave is a partner at Barnes & Thornburg and chair of the firm's Securities and Capital Markets Practice Group. Let's please welcome David Hooper. And by the way, everybody, we'll do a Q&A after every speaker, so please have your questions prepared, and we'll go around the room so you can ask some questions.
Well, thank you, everybody. Thank you for having me today. That's a tough act to follow, Jim, talking about all the challenging economic conditions that we're facing. It's only natural to follow that with a challenging regulatory environment talk about our favorite acronym these days in the legal world, and especially the securities world, ESG. And just by a raise of hand, raise your hand if you know what ESG stands for in this room. And if you don't raise your hand, you are liable to be called on by me at the end of the, so raise your hand, ESG, everybody knows. Few that don't. ESG stands for environmental, social, and governance issues in my world, which is the securities world. Now, following Jim's talk, challenging economic conditions, everybody's aware of that. I'm doing my part. I won't tell you how long I've lived in Indiana, but I've been telling the folks at my table, this is the first year that I am actually going to the race. I've probably golfed Brickyard Crossing more than I've been to the race here, so I'm doing my part to inject into the economy. And if anybody from the governor's staff is here, I do have my tickets to the race, but I don't have a parking pass yet. So I would rather not have to park in Avon to get into the Speedway, but if the governor's staff is here, I'd love to talk to you afterwards. But in all seriousness, I do want to take a few minutes to talk to everyone today about an important rulemaking that has come out of the SEC this spring, long awaited, directly affects public companies, SEC registrants, those companies that file annual reports, quarterly reports, proxy statements with the SEC. So the rulemaking on climate change disclosure and auditing, and again, it directly affects public companies, but it certainly has an effect also on private companies, private enterprises. So those of you that in this room that may not be in the public company world will be definitely interested in what the SEC is trying to do here and what the effects it will have going forward. Because many of our private companies that either we invest in or work for take our cues from the public company world, from public company disclosure regimes, from financial reporting and what's in the footnotes to financial statements and how you're supposed to approach those issues. So this is important for you, even if you're in the private company realm. But in a larger sense, and we can take all day getting down into the weeds, talking about the disclosure requirements, which you can read in our client alert and our primer that we have on the tables that we put together for everybody. We can take a lot of time to get into the weeds on that. But in a larger sense, what I really want to focus on today is that the rulemaking that I'm going to talk about also affects how investors and companies of all types, again, public and private, are supposed to approach the capital raising process going forward. How are all stakeholders, managers, employees, political leaders, investors, how are you now, in light of this rulemaking and others like it, how are you to view the role business enterprises are playing in the economy, in the community, and in society in general? What are the factors that you're supposed to take into account now? Traditionally, of course, we've always focused on hard and fast economic factors and evaluating whether an investment is a good one, whether an M&A deal is priced fairly, and whether business managers should make expansion or contraction issues. Economic factors have always been at the top of the list. Now, are the regulators telling us, and more importantly, is the market telling us, are all of you in this room telling us that other factors need to be taken into account in order to determine whether an investment is a good one? And that is what I want us to focus here on today, is the SEC, the Securities and Exchange Commission, really morphing into something more than that. Is it morphing into a Securities and Environmental Commission or a Securities and an ESG Commission? And to understand that, we have to first understand what is the SEC's mission. And again, this is focused on public companies primarily, but it has an effect on private companies as well. Okay, so the SEC was created in 1934 after the Great Depression. And it was established by the Securities Exchange Act in 1934, and its primary mission was to enforce the securities laws that were passed by Congress and to impose disclosure requirements on companies, primarily public companies, but also in an indirect way, private companies. And in that vein, the role of the SEC is threefold. Number one, to protect investors. And this is directly from the SEC's own publications, long-standing publications, so there's no editorializing going on here. This is their published mission, to protect investors, to maintain fair, orderly, and efficient markets. Okay, that's number two. And to facilitate capital formation. So keep those three mission statements in mind: protecting investors, maintaining fair, orderly, efficient markets, and facilitating capital formation. Okay. With those in mind, let's move to the actual climate change rules, which fall into the category of the E in ESG. There are others, and the SEC has been very active this year and in late last year in other areas of the ESG category, but the climate change disclosure rules that have come out have been very important, very controversial in certain respects. The rule, and again, this is a proposed rule, it is not finalized yet. So how the SEC works, for those of you who don't know, they put out a proposal, a rule proposal, allow public comments to come in, sometimes over months, sometimes over years, as we saw with the Dodd-Frank rulemaking, some of which have never been completed. And those comments are either distilled and taken into account, and either the rule is finalized and adopted, or it just goes down on the cutting room floor and never sees the light of day. So we are in the public comment period right now of the climate change related disclosure rules. Now, this proposed rule would require all SEC registrants, all public companies, to do essentially three things. Number one is to include specific climate-related disclosures in annual reports, registration statements, and financial statements. Right now, there is something of a requirement that all public companies must disclose all material, and the keyword material, climate change-related issues affecting their companies. This proposal makes that much more hard and fast. There's specific disclosure requirements that the SEC is proposing public companies make now. For example, oversight and governance of climate-related risks by the registrant's board and management, the company's process for identifying and assessing climate-related risks, disclosure of any actual impact of physical climate change related events. So those are some of the examples of the prescriptive disclosure rules that public companies would face. Okay, that's number one. Number two, and we get progressively worse and more controversial as we go on here. Number two, and this is where the finance department of the public companies, for those of you in the room, start sweating a little bit. The SEC proposed rule would require a new financial statement footnote in companies' financial statements disclosing any climate-related financial impacts, expenditures, capitalized costs that in the aggregate result in impacts of 1% or more on any line item in a company's financial statements. So if you were thinking of asking me in the Q&A section an example of that, how that's going to work, don't ask me. I don't know how that's going to work. I don't know if anybody knows how that is actually going to work in practice. But that is the proposed rule. It's called the 1% rule, and it's likely to cause quite a bit of work for the finance departments and for the lawyers and the accounting firms and the auditors that are looking at those disclosures. But then third and most controversially the proposed rules would require all registrants to disclose information about their greenhouse gas emissions, including there are 3 types of greenhouse gas emissions that public companies would have to disclose. And most companies that already address these issues are probably somewhat familiar with them. There's Scope 1, Scope 2, and Scope 3. Scope 1 GHG emissions are those direct emissions that come from company-controlled operations. So those are easy to understand. Scope 2 emissions are indirect emissions from that occur because of the purchase of energy by a business enterprise. So in these situations, companies would have to look up their supply chain to their electricity provider or their natural gas provider and determine what the impact of the purchase of that energy from that supplier how that would be quantified in emissions perspective. Before I get to Scope 3, Scope 1 and Scope 2 emissions, and this is where the rubber really meets the road and may be changed as we go through the final rulemaking process, is that the largest of the large public companies would be required by this proposed rule to obtain essentially an audit, an attestation report from an outside third-party auditor, an independent service provider, auditing the Scope 1 and Scope 2 emissions and the disclosures on those emissions in the SEC filings. That will be a big expense. That will be difficult to manage. It will be difficult to quantify in many, many cases, but that's part of the proposal. And then the Scope 3 emissions, which is clearly the most controversial of the entire rule, is the rule would be that a registrant also would be required to disclose Scope 3 emissions, as long as they're material. And Scope 3 emissions are all those other indirect emissions upstream and downstream from the company's operations. And so, as you can see, there's a ton to chew on here. 500 pages of rulemakings, highly controversial in many respects, but the SEC made a determination that these proposals are within the scope of the SEC's mission. Chairman Gary Gensler of the SEC is very much in that camp. When these proposed rules came about, his statement on the proposal, very much supportive of it, he said that these proposed disclosures will provide investors with consistent, comparable, decision-useful information for making their investment decisions. His assertion was that companies and investors alike will benefit from the clear rules of the road proposed by these rules. And this is the key to his position, was that the proposal is driven by the needs of investors and companies, issuers of securities. So let me repeat that. The assertion of those that support these rules is that they are supported by the investor community. Investors want to know these things. They want to know greenhouse gas emissions of the companies that are reporting. And so this proposal is driven by those needs. Now, on the other side of the ledger, one of the opponents of the proposal, another SEC commissioner, Hester Pierce, had obviously a much different view. Her view was that this proposal turns the entire SEC disclosure regime on its head, that there is no authority for the SEC to do this in the Securities Exchange Act. It is not commensurate with its mission, and that current SEC disclosure mandates are intended to provide investors with an accurate picture of the company's present and prospective performance through the manager's own eyes. But contrary to that mission, her assertion was that this rule proposal tells corporate managers how regulators doing the bidding of an array of non-investor stakeholders expect those people to do their business, how they expect them to run their companies. So, who's right here? Who is right? Is Gensler right or is Pierce right? Are these new disclosure requirements useful to all of you in this room in evaluating companies? Are they useful to evaluating public company investments, private company investments? Is it the regulator's role to mandate these types of disclosures? And the most fundamental question of all in this entire presentation and in this proposal, this rule proposal, is do investors care about these disclosures? And do they care about how companies, both big and small, address these issues? That is the fundamental question. Because if the answer to that is yes, that investors do care deeply about these issues, as Gensler asserts, then this rule proposal, with all its costs, with all its requirements, with all its hidden gems in there, this proposal and others like it in the ESG realm absolutely have efficacy and real-world application, and we should pay serious attention to them and give them the attention that they purportedly deserve, so that if Gensler's right, that is the outcome. If the answer to that is no, and Hester Pierce is correct, that this turns the disclosure regime on its head, that these are non-financial factors that are being pushed by outside stakeholders and telling companies how to run their businesses, then these proposals and this specific proposal would not fulfill the SEC's mission and rightly should be heavily scrutinized. That is for the market to decide. That is, the answers to those questions are not for the lawyers to decide. They're for you to decide. They're for all of you in this room, in the investment community, as managers of business. They are for you to decide, and that's really what I want you to ponder as you go away from this discussion today. We have the economic factors that Jim talked about. Now, the ESG factors that I'm talking about. Clearly, everything you saw on the slides from Jim absolutely are important in this economy that we're going through right now. But the question now from the regulatory perspective is, are these issues important to you as investors? Because the SEC has this SEC has absolutely put its stake in the ground and said, yes, they absolutely are important. And not only should you consider them, you must consider them because they're going in public company disclosures. So again, I'm not providing answers to you today on these issues. Clearly, I cannot bore you with more details on the rule proposal. Again, the primer that we've put together gives you a taste of what the proposal provides and what companies are facing going forward. But again, rather, we're posing the fundamental question today, and it's an extremely important one with far-reaching implications for everything all of you are doing on a daily basis. It has implications for operations, for M&A activity, for pricing deals, for investment and capital raising and corporate governance. And again, the question is, the fundamental question is, should businesses be evaluated primarily on the economic factors, on the economic performance that we've seen in Jim's presentations and others? Or when you're considering an investment or an initiative or any other process for your business, are these other factors enunciated within, at least in part, in the environmental climate change disclosure rules? Are those other factors important, even though they may have an indirect impact on financial performance? So that's what I'd like you to ponder, what I'd like to leave with you today. And, I'll open it up for a few questions on the front end, but I think I'd like to also pose a question to anyone who's brave enough to raise their hand and have an opinion on this. From what you've seen on the environmental climate change proposals, I'll go back to the fundamental question. Is this important to your investment decision? How, and if it is, how important? I'll say, I guess I will editorialize a little bit. I think that with any of these rulemakings, even going back to the Dodd-Frank days, when there were extensive rulemakings, not necessarily in this context, but the one-size-fits-all approach to any SEC regulatory regime rarely works for everybody. It rarely works for a large segment of the public company registrant world. The more tailored the disclosure regime is, the more principles-based, where companies can take those rules and craft them to their own business and how they see their investor base, their investor base would react. Those seem to work much, much better than a one-size-fits-all proposal. And so there may be situations, and as a lawyer, I give the answer to the question, well, will this work? Will that work? Obviously, I give the question many times, it depends. It's not a great answer, but it does depend. It's like, Harry Truman saying that he always wanted a one-handed economist, because they would always say, on the one hand, you have this over here. On the other hand, you have this over there. It does depend. There are some companies, there's some significant investors, the BlackRocks of the world and others, that really put a lot of efficacy, a lot of attention to these ESG issues, and specifically the climate change issues that are facing companies. So I will open it up for a few questions. I know maybe we're a little bit behind on time, but sure.
Can you hear me? So my question's more, literally the presentation before you is Federal Reserve their whole job is to tame inflation. But wouldn't literally everything we just talked about do the exact opposite and have the exact opposite intended consequence? Because the idea that gasoline's over $4.50 a gallon, diesel's over $5.60 a gallon, but then you start bringing this in to where then it's like, well, you're an Indiana-based Fortune 500 company. We are powered by coal power plants, i.e. your ESG is way higher than it should be, and there's not any actual solutions outside of nuclear within the energy space that will have any dramatic impact.
The answer to that is absolutely. It absolutely has an opposite effect, in the sense that any disclosure, and again, I keep going back to Dodd-Frank, but that's a great recent example of significant disclosure regimes that were imposed by the SEC and Congress, and what those effects were directly on companies. And the answer is yes, it has a direct cost effect on companies. Some companies, the larger accelerated filers, the largest of the large caps, are much more able to absorb those costs, with the army of SEC lawyers and internal staff that they have. But the others, the vast majority of our country's public companies are, smaller accelerated filers, smaller reporting companies, nano caps, micro caps, that have very limited resources to aggregate the data that would respond to these disclosure requirements, distill it, and get it into a format that would be understandable to investors. There's a lot that goes into it. There's the lawyers looking at it, there's the auditors, there's public relations folks that would have to review this information. So there is a direct cost to this disclosure regime and any disclosure regime that is imposed by the SEC. And would that have the opposite effect of what the Fed's trying to, as our prior panelists indicated, at least purportedly bring down the inflation rate by lowering demand, by lowering the cost, with the effect of lowering the cost of everything we see that we buy every day. But anytime you impose, or a regulator imposes, a disclosure regime of this nature, especially one where companies, managers will have to go out and get the data, okay? Then that imposes costs as well. And so we don't know if these rules will be finalized and in what form, but if they're finalized in the form they are now, there will be a cost effect to it.
How long do you think it'll take to work its way through the court system once this is challenged?
Excellent question. Excellent question. It will absolutely be challenged. The lawsuits were written months and months ago, before the proposal was out there. Those of us in the SEC world that know folks within the Department of Corporation Finance and or the Division of Corporation Finance and the General Counsel's office, we've heard the arguments going back and forth. And so there are lawsuits that are ready to be filed if this goes final. Now that's a question. That is a significant question of whether these rules actually go into effect and become finalized. But if they do, typically the lawsuits are filed for the most controversial of rule proposals that have come down over the years. Typically, there's an injunction that's issued immediately within, days or weeks of the rule going final. And then, there's a trial and goes through appeals process. It literally takes, years to get to a spot where you're even in an appeals process. Okay. But, I'm done predicting what judges do. And so you just never know if an injunction would actually be issued. Some of the more controversial Dodd-Frank rulemakings went final without significant legal activity in the court system. So this one's probably different, but we'll see. As a matter of whether these rules get finalized or not, the SEC kind of tipped its hand and said, look, if we adopt these rules, they won't go into effect at least until the earliest 2023, for most companies 2025, 2026, which means they wouldn't even be finalized until December of 2022 this year. So it's going to be a long road, but you can see the direction. The orientation is really what's important here of what the regulators are looking at, what this regulatory body is looking at.
Yes, to attempt to answer your question, I think ESG investing is becoming more important to endowment and pension fund investors. The problem is each organization has its own set of values. So the variation of the values of those requirements, to meet those requirements is going to be extremely difficult. But my question, I guess, is how much is this going to impact foreign companies that want to list on U.S. markets?
Great question. And the first part of your statement underscores what I said before. In our experience as securities lawyers, more tailored approaches to disclosure regimes almost always work better than a one-size-fits-all. So different values, different approaches, principles-based works better. So agree with you on that. I think it remains to be seen what foreign companies will do with respect to U.S. listings. And I hate to hedge on that, but I think we have to wait and see really what, again, all of you in this room do in response to these rules if they become finalized. Will the investor community embrace these disclosures? Will they demand them from public companies, at least in a certain format? And will they demand them in such a way that, becomes a standardized set of disclosures for most public companies? I think that will answer, because if they do become standardized and there becomes kind of a rhythm to the disclosure regime, I am not convinced that it will have much of an effect on whether foreign companies list here or not. There would be, again, the NYSE, the NASDAQ, most vibrant stock exchanges in the world by a long shot. And that matters a lot. And so if these disclosure regimes do become somewhat standardized, I think the prestige, the access to capital, the access to liquidity will trump that.
What, if anything, do you recommend currently for clients, given the fact that this is just a proposed rule at this point? Do you recommend, if they're not already tracking their scope 1, scope 2, scope 3, that they start doing that, that they look for an auditor? Just kind of curious what you recommend to clients and what you see them doing.
Another great question. First and foremost is I recommend clients read my client alert, okay? Read the summary of the rule. Understand, at least in a general format, what it is that the SEC is requiring here. Understand the terms. Understand there's so many public companies that never have to deal with these issues. A great example, financial institutions, if banks don't emit, they don't have smokestacks emitting pollution into the atmosphere. So they very rarely have to deal on a day-to-day basis with these issues. And so many of them don't understand the terminology or don't understand the issues and don't understand what is being asked of them on the forefront. So understanding the general concepts is number one. And number two is to, in consultation with folks like us and auditors, try to understand, they always want to understand what is the most likely outcome here. What is most likely to be adopted and what's not? I think in this proposal, there will be something that's adopted. I think the most likely aspect will be those rote disclosures that I described in the first part of the summary of the rule proposal. Just the 3 or 4 or 5 different categories of these climate change related matters that the SEC is saying you should put in your filings, such as how the board addresses climate change. Are there policies and procedures in place? That's something of a low-hanging fruit. Those are likely to be adopted. The others, greenhouse gas emissions, reporting, auditing, that is the most controversial aspect of this, the hardest to address, and so that may not be something that gets passed. So just understanding, number one, and preparing for what's most likely to occur. All right. Thank you, everybody.
Thank you so much. All right. Thank you so much, David. Session 4, as we move on. We're not in Kansas anymore. Active management matters. Chris Dillon, CFA investment specialist at T. Rowe Price. We are seeing many structure changes globally. Chris is going to come here to break down why we are where we are and how you should attempt to combat a more forward challenging investment environment. Chris, investment specialist in the multi-asset division and fixed income specialist with the T. Rowe Price. 28 total years of investment experiences, also a CFA charter holder. Please welcome Chris Dillon, everybody.
Hi, everyone.
happy to not be the last presentation between you and lunch. So let's efficiently move through this presentation anyway. I'm here with some good news and some bad news. I guess first of all, I'm a Philadelphia Eagles sports fan. I don't know if that's the good news or the bad news, but for years I've wanted my flat screen TV in my man cave to better watch my Philadelphia Eagles in the fall. My wife is the frugal in my family, and for years she's been telling me that TV is going to be less expensive next year. Now, we've only been married 11 years, but she's been right for 20 years. Each year, that TV has become less and less expensive. Well, I can now say to my wife, Cindy, Russia invaded Ukraine, and Russia is now a pariah state. And Xi Jinping met with Vladimir Putin the day before the Chinese Winter Olympics. The Russian invasion started the day after the Chinese Winter Olympics concluded. We have this enormous trade partnership with China, and now maybe those intricate trade relationships need to get revisited. I can also say, Cindy, we had a trade war in 2016, not just with China, but with Europe as well. And I can also say, Cindy, COVID-19 was awful for everybody, and there weren't enough ventilators and there weren't enough masks. So what I can now say to my wife, Cindy, is globalization 2.0 is now here. That flat screen TV is going to be more expensive next year. Now I get my flat screen TV. The world we have known for the past 20 or 30 years has changed. I just walked through some of those dimensions of it. I was lucky enough to be a history major in college, and I remember walking in Econ 101. It's September 1981, and I had a great Econ 101 professor. And that professor opened up that first lecture, and I just wanted to get to the first keg party. I was excited to be at the University of Delaware. And this econ professor said, hey, class, really high inflation these days? Anybody struggling filling up their car? I raised my hand. He said, anybody notice that Ronald Reagan fired 12,000 air traffic controllers last month? I didn't think that. I was aware that it happened. I didn't know what it meant. American labor has been on the back foot ever since. Meanwhile, something else happened after Paul Volcker got a handle on inflation, after labor took a big step backward after Ronald Reagan fired 12,000 air traffic controllers. Something else happened remarkably in 1991. Anybody want to venture a guess what that was? Wasn't it the end of the Cold War? The end of Russia disintegrates. So no Cold War anymore. So there's no Cold War. And all of a sudden, Steve Jobs shows up on the scene and designs this great supercomputer that we all carry in our pockets. And in a peak globalization world, let's ship all of these parts out over the world, have Japan make a little bit, have South Korea make a little bit. Final construction happens in China. We've been in Kansas. Kansas been no Cold War, no inflation, low interest rates, bigger and bigger houses. We all get to carry a supercomputer in our pocket. What else have we had? Anybody keeping track of S&P 500 and the returns annualized? If you jumped into just the S&P 500 in March of 2009, even with the rumblings in the market this year, anybody want to venture a guess what the annualized returns are in the S&P 500? I'm in front of a bunch of CFAs. I'm sure somebody's got a number. How about 17% annualized returns for the S&P 500 since March of 2009? Just remarkable. Anybody kept track of the scoreboard since March 23rd, 2020? How much the market's up? How about 85%? Remarkable? Yes. But has the ground been rumbling underneath our feet, the world we have known of what I'll call Kansas? Has it been rumbling for the past 5 years? It certainly has. Does Russia's invasion of Ukraine sort of cement in this idea that we're now in a different world? Answer is yes. Does anybody think that we're heading back to a world of 1.7% inflation, which was what the 5-year break-even average was pre-pandemic? Anybody think we're going back there once we settle? How about 3.5% as a new steady state for inflation going forward? Just here to walk through some of these dynamics. Look, we've had this great luxury of just being a 60-40 investor. Here, be diversified with your clients. You've done remarkably well just by owning the S&P 500 and the Bloomberg Barclays Aggregate Bond Index. I'm here to tell you today that we're going to have to work harder to achieve less, and diversification now becomes much more complicated with the world changing underneath of our feet. Just going to walk through some slides here just to defend my points. So I mentioned Ronald Reagan firing 12,000 air traffic controllers. That picture on the left-hand side of those slides, those are the PATCO workers, professional air traffic controllers. All of them were about to lose their jobs. Paul Volcker got a handle on inflation. That's inflation moving powerfully down left to right. But something else happened along the way. Ever cheaper electronics, ever cheaper mortgages. Jim Bianco made a great point. If you own a house and you're in the stock market, higher inflation matters a lot less because you're hedged to it. Stock market's been unbelievable. But if you're not in the stock market and you don't own a house, you're getting crushed, and especially in a world of 8% inflation. Why am I mentioning this? I'm mentioning this relative to there's this Gini coefficient, wealth inequality measurement. Does anybody think the United States ranks fairly favorably from a Gini coefficient score across the world? Doesn't score well at all. I'm not here to make a political statement, but did the events of January 6th, 2021 give a signal that people in the United States are angry? I think the answer to that is absolutely yes. Don't need to get into the political dynamics of that. But as we defeated inflation and we got ever better quality of life, some people were not participating. And that Gini coefficient, which is that pale blue moving left to right, is telling you that wealth inequality in the United States today is as bad as it was in France, Paris, 1789. And if anybody's up on their history around the time of the French Revolution, something needs to change. The good news here with all of this, there is a manufacturing renaissance that's slowly taking place in the United States. The world that's been put together for the past 20 or 30 years, in the next 10 years is going to get slowly dismantled, and regionalization, resiliency, is going to be replacing peak global efficiency. So I mentioned the end of the Cold War. Anybody remember Mikhail Gorbachev and glasnost and reform for the Soviet Union? He wasn't just the only leader in Russia. That picture on the left-hand side, it's Gorbachev and three other guys. Anybody notice the guy that's right next to Gorbachev? That's a really bad hairpiece. That guy had something to hide. Well, there was a coup of those other three gentlemen tried to take Gorbachev out of power in Russia. That picture's taken in May of 1991. Soviet Union was dissolved right after. No more Cold War, peak globalization. That chart on the right-hand side, as you're facing it, is just all of the different countries that are involved with the manufacturing of a smartphone. Final construction happens in China. Why do I keep hammering this point? Final construction happens in China? Well, final construction happens in China, and that total value of this phone is counted as an export from China to the United States. China's value add in this manufacture is about 4%, but they get hit with 100% of the value of this phone as an export from China to the US. Simple math of the trade deficit the United States has with Asia is anything but simple. It's enormously complicated. Does anybody think that China completely understands that they are only the 4% value add of this and that they're getting dinged in a trade war because they're getting counted for being 100% responsible for this? It's complicated, and I'm not here to get political or anything about this, but if China is angry about this and the United States is angry about this, is the world getting configured to something else? I think the answer to that is absolutely yes. So trade policy uncertainty index, something we haven't had to worry about while we've all been in Kansas for the past 20 or 30 years, but we did have a trade war erupt in 2016. Was it right for the Trump administration to take on China from certain aspects? Absolutely, no argument there. But did it also make sense to pick a trade war with Europe and other nations at the same time? Maybe not. Midterm elections are coming. Anybody think the Republicans have momentum this fall? I do. Are we done with this trade policy uncertainty? I think the answer to that is absolutely not. There has been a little bit of a lull after 2016, and we've also had COVID-19 to deal with. But trade policy uncertainty is here to stay. So I'm excited. My son just graduating from the University of Maryland. I'm happy for him. And the reason why I bring this up says unless you had to put a child through college or you had a trip to the hospital and you didn't have health insurance, for the last 20 or 30 years, there's been no inflation. So this is just a whole series of electronics that we've been getting out of Asia for the past 20 or 30 years. But where are we going next? And what is something else that was revealed as a byproduct of COVID-19? When we didn't have enough ventilators, we didn't have enough face masks. Are fragile, strained global supply chains a national security risk? I think the answer to that is absolutely yes. Anybody hear the governor? What was one of the things he said in that global economic forum that's coming to Indianapolis? Food security. Have we had to worry about anything like that for the last 20 or 30 years? No. We won't have to worry about it in North America, but if I was a sovereign leader of Africa, I'd be scared to death and I'd be trying to have my contacts all over the world right now. We have a food crisis right now because of the conflict in Russia, Ukraine. It's not going away. It's a different world. And with that, we also have geopolitical uncertainty. We've had a remarkable, stable time here for the past 20 years or so, where we just haven't had to worry about global conflict. Russia, Ukraine reveals something else. Does anybody realize that half the world's population has yet to condemn Russia action? They need Russian energy resources. Cold War 2.0 is where we've landed. It's a bad angle, sorry. So, has Vladimir Putin revealed himself here with the invasion of Ukraine? Look, there was a war in Georgia in 2007. There was an annexation of Crimea. But everybody reading that quote that I can't read from here, where it's Vladimir Putin basically saying that the collapse of the Soviet Union was the greatest tragedy of the 20th century? Yeah. Vladimir Putin wanted to put the band back together. What do I mean by that? He wants to put the old Russian Empire back together. That quote from Vladimir Putin, that's 2005. We've all been looking the other way while Vladimir Putin has been quietly trying to put the USSR band back together. Does anybody think that if Putin was able to walk into Ukraine and knock them out in a week like he said he could, anybody think that China thinks that maybe they could have taken out Taiwan in a similar way? Well, it's not going that way, and the West is galvanized, and Europe may be a great place to invest in the next 10 years. Meanwhile, there's also this other perspective. Look, I was a history major. I was always told that when the German army went into Russia in 1943 or whatever year it was, 42, 43, that the mistake they made is when they hit Ukraine, they were welcomed as liberators. They did not want to be under the rule of Stalin, and they wanted to get on board with the German invasion. But the SS showed up, and history says that they were killing all the Ukrainians, and the Ukrainians had to get on board with the Russians. Anyway, what I'm here to say is Ukraine does not want to go to Russia, but meanwhile we have this impasse between the West, Vladimir Putin, and Russia has become a pariah state. Deglobalization is here. Globalization 2.0 is here. But meanwhile, here in the United States, if we had a really unpopular leader, wouldn't we just get rid of him somehow? Anybody remember the TV show here in the States, Happy Days? Isn't it always easier to think back to a more simple time when everything was simple and more happy? Same thing exists in Russia. The older you are, the more you want to put the old band back together, the old USSR. Vladimir Putin, health problems, maybe that's a good thing. I'm not here to say that on a public stage, especially representing my company, but Vladimir Putin does have public support back home in Russia. What do I mean by putting the band back together? That's just a map that I picked out of Encyclopedia Britannica, and that's the old Soviet Union. Does anybody think that Vladimir Putin would have stopped with Ukraine if he was successful quickly there? He was going to pick off every one of those countries if the West doesn't get together. The good news is that the West is going to get together. Did anybody see that Sweden and Finland are going to join NATO today? That's a big deal. So the West galvanized. Europe having to think about common defense. This is a big deal. Europe having to come together with energy infrastructure. It's going to be a big CapEx spend that happens in Europe in the next 10 years. They're not bluffing, it's here. Something else on the left-hand side is just foreign currency markets. So why did Vladimir Putin have to go ahead and invade Ukraine and sort of push forward his timetable of putting the band back together? That line that's moving left to right in a big way, that's showing you that ever since Vladimir Putin has been in power, the Russian ruble has been sharp decline versus the US dollar. And if you're an elite in Russia, you've been fine. But generally speaking, Russian people have been a lot worse off under the rulership of Vladimir Putin. The other line that's just steady across the bottom there is China's currency rate versus the US dollar. It's an uneasy truce between the US and China is working within what we'll call, I guess, the Bretton Woods rule. Can the US and China get along in an uneasy truce in the next 10 to 20 years? My company's betting on it, but you're going to need to be invested in the A-share market. It's dirt cheap right now. But now, if you were to look at 20 of the United States' best companies, Walmart, Marriott, I'll go down the list, China has now made a clone of every single one of them. Is there an opportunity there? Yes. Do we have to like that they picked the brains of our best corporations? No. But now, can we invest in the Home Depot of China locally in the A-share market? My company's made that bet. We opened an investment office in Shanghai last year. We think it's an attractive opportunity over the next 10 to 20 years at a time when diversification right now is hard to find. I mentioned the world's just become complicated. Half of the world has decided not to vilify Russia's invasion of Ukraine. So Israel needs Russia for certain things in terms of their national defense. India needs natural resources. Is it globalization 2.0? I think at my firm, we think the answer to that is absolutely yes. So not only did the S&P 500 deliver you 17 or 18% annualized returns for the past 10 years, what would have done even one better? How about just the Russell 1000 growth? Better yet, how about the FANG stocks? That's been a great run that we've had for the past 10 or 11 years. But some other stocks now need to get considered. And ESG, there's an intersection here. Do defense stocks need a revisit from an ESG perspective if you're on the Eastern Front in Europe and the Russian army is coming to invade you? Does Northrop Grumman, Lockheed, L3, do any of those companies, should they be barred from an ESG perspective? In this world, I think the argument is already there that does need to be revisited. What are some other stocks that have just been getting left behind in this whole technological disruption conversation we've all been in for the past 10 years? What about a good old-fashioned ag stock like Archer Daniels Midland? What about a fertilizer stock like Nutrien out of Canada? Do we need to sprinkle some Jimmies on top of our vanilla ice cream cone right now with a world that just changed because of globalization 2.0? I think the answer to that is absolutely yes. And does 60/40 need to work harder? I'm going to get to the punchline on that in just a few slides. Europe is in a world of hurt right now, but I am here to tell you that I've delivered this quote from Arif Hussain, who's our head of international fixed income at T. Rowe Price. And his point is, and I've already mentioned this, to the extent that now, let's go back and let's think of the United States. Revolutionary War, the United States just wins. Alexander Hamilton becomes our first Treasury Secretary. And what was he able to do? Take 13 separate colonies and bring them together. Now there's a Hamiltonian moment potentially for Europe where they have to think about their common defense. They have to have common energy infrastructure. This could be the decade for European investments. We're not there yet. It's a world of hurt right now, but just something provocative to think about for the decade to come. I'm not going to spend a lot of time here, but been a lot of talk about blockchain and digital dollar and El Salvador taking on Bitcoin as a currency. Does anybody think that Bitcoin is a threat to the US dollar? It's a bunch of CFAs. I'm so glad not to see any hands come up. Now, how about a regulated digital currency in the US that's ultimately backed by the United States government? Is that the future at some point? Yes. Are there threats to the US dollar, and is Russia just selling its oil and you have to settle in rubles right now? Yes. But for right now, is the US dollar still the only game in town? The answer to that is absolutely yes. If you haven't seen the interview, but our trade representative that is referenced on this slide just did a live interview on Bloomberg a couple weeks ago. You get a chance to see the interview. It's nothing short of remarkable. I can't think of a better representative of the United States government going toe-to-toe with China. But her point is, it's a recalibration of our relationship with China, but an uneasy truce can exist between U.S. and China. I'm here to deliver that message from my company's perspective. So now, how about the world of the future? I was thrilled to get a chance to see your governor in action today. Just talking about a global economic forum and all these best and brightest minds coming here. But I'm here to show you the world of the way the Canadians are thinking about the future. I've said the word globalization 2.0 probably 5 or 6 times while I'm up here. So did anybody notice last year that Canadian Pacific Railway purchased Kansas City Southern Railway at a premium? This is a picture of Canadian Pacific's taken from their Canadian Pacific Railway website. And there's this interconnected railway system linking manufacturing in Mexico, running right through the heart of the United States and energy resources in Canada. I opened up my talk today, regional resiliency, replacing peak global efficiency. These are the buzzwords of our investment environment. This is the decade that we're going to be living ahead. I was just in an investment conference 2 weeks ago in Austin, Texas. Epicor was the name of the company. They're an infrastructure company. They also do human resources work, everything for a multinational to navigate global supply chains. That business is off the hook busy in Mexico right now. Reshoring, regional resiliency, putting the world back to dismantling the world of peak globalization for the past 20 or 30 years and bringing it back to the North American continent. This story's already happening. Implications for the road ahead. Anybody see Federal Reserve professionals on the tape and they keep hanging on to the idea that 2% is the inflation target of where they're trying to get back to? But you can also see them starting to blink and say, well, it isn't going to be by the end of 2023. Well, if it's not going to be by the end of 2023, you start to get pretty far out there. But why am I mentioning this? I'm mentioning this is right now a 5-year break even on the 10-year on the 5-year Treasury is 3.09%. It averaged 1.7% for 5 years before the pandemic hit. We're not heading back to that world. The pendulum has swung from capital to labor. I just talked about, I remember my talk, getting rid of the air traffic controllers. Anybody see that a unionized shop in an Amazon warehouse just formed in New York City? Anybody see that Starbucks workers are unionizing? Anybody see that the stevedores in Long Beach Port and Port of Los Angeles are unionizing? I'm here to say that the puck, or the pendulum, has swung to the interest of labor. This is a good thing, rebuilding the middle class in the United States. Does anybody think that the Fed's going to get back to their 2% inflation target in the next 10 years? I'm not here to tell you that today. Investing in China, dirt cheap, but it's nuanced and you've got to be in the local share market. Quickly on the market, I became a Peloton consumer in the spring of 2020, and that stock was $170. Last week it was $11, and they might be going out of business. We used to do this by Zoom. Zoom used to be a $570 stock. Last time I checked last week, it's a $97 stock. A world of hurt has already been inflicted on the stock market. I think in my shop, it's now a time for active management, but a lot of the pain is gone, and now there are fertile bargains across the whole investment universe, and it's not just U.S., it's global as well. So this is our world of how we're diversified in T. Rowe Price multi-asset. Neutral is right down the middle. We've been underweight stocks since this time last year. Jim Bianco's talk on inflation, it was powerful, but I do have some good news relative to some of that messaging. $28 trillion was pumped into the global financial system to combat the economic ravages of COVID-19. The good news is that we got it. The bad news is that we're not getting it again. Since May or June of last year, that $28 trillion has been rolling off and has been a big headwind for markets. And the markets have become an earnings-driven market. Does everybody remember that DocuSign moment first week of December last year when they missed their number and came out with squishy guidance? The stock dropped 100 points in a single day, down 40%. It's an earnings-driven market. Meanwhile, you have this headwind of $28 trillion of stimulus just slowly been rolling off for the past 12 months. Big headwind for the market. We're through the worst of it. Price of money is no longer free. And I guess T. Rowe Price may moderately disagree with Jim or maybe partially agree. But it's the question came in around the Fed's balance sheet. And what we would describe, or I would describe, Fed monetary policy is a bit of etch-a-sketch right now. Yes, it's Fed funds, but it's also the balance sheet. And the balance sheet is $9 trillion. And the aspiration is to get $600 billion off the Fed's balance sheet in relatively short order, followed by another trillion. That's the equivalent of about 6 25 basis point rate moves. Does anybody think that the Fed can do that and take funds to 3.5% and do them both at the same time and not rip the head off the U.S. economy? Absolutely not. They're going to blink on one side or the other. I think we're thinking that it's probably going to be on Fed funds. So a little moderate disagreement between T. Rowe Price and Jim Bianco, because we think they're going to be committed to the balance sheet. But the point is, a lot of pain is already priced in. And we see value at a 10-year Treasury yield of 3.25%. There's support for that. A lot of pain already priced in. So some glass half full here from my company's perspective. Finally, 60-40. We've been huge beneficiaries of 60-40 for the past 20 or 30 years. It's been a free lunch. You've been 80%, 90% of the return of the S&P 500, but with 60% risk by just being in 60-40. These days are gone. We're not thinking 60-40 anymore at T. Rowe Price. We've broken our pie into a lot of different parts. And I guess I'll end this point with, while I said a lot of pain has been inflicted on capital markets, we also firmly believe in global diversification. So, good news in an earnings-driven market, S&P 500 earnings cratered to an aggregate number of 130. They have recovered to 200, but in an environment where wages are up, energy prices are up, does anybody want to venture a guess of what consensus thinks earnings are going to be 12 months from now, that aggregate number? How about 237? So we're at 200 aggregate number in the S&P 500. Consensus still thinks that earnings are going to 237, which is 18% earnings growth. Anybody think we're going to get there? Not here to tell you that. You know who's dirt cheap from an earnings expectation perspective right now? Europe is, and emerging markets, particularly in North Asia, absolutely radically dirt cheap. Just a couple of punchlines. I'm not going to read them, but that's just a conclusion to wrap up my discussion. I'm happy to take any questions. I can't tell you how thrilled I am to be speaking to a CFA audience. And relative to those opening comments about the CFA and how hard those tests are, I am not one of those people that passed all 3 of those tests on my first shot. And now to have a chance to speak to this group, I can't thank you enough. Happy to take any questions.
We'll do a couple of questions real quick. Anybody have a question? Got one question right there. All right.
How does the U.S. dollar play into the valuation of the emerging markets in Europe, since the U.S. has been buying their assets and buying products?
So, complex question in that the U.S. dollar has been on an absolute tear. We're the world's largest economy, most liquid capital markets, and now Fed funds is potentially on its way to 3%. And you're getting 3% from the U.S. when a country like Japan is committed to easing, so no raising of monetary policy. So I'm mentioning that relative to a measure of the dollar and the dollar strength is something called the DXY, which has been on an absolute tear from a year-to-date perspective. But your question's important in that when the dollar strengthens that powerfully, it normally represents pretty powerful kryptonite for the emerging market world. I think from our perspective, if the Fed were to fully follow through, get to 3.5% Fed funds while also ripping the balance sheet down, that DXY could not only be at 103 points, it could be at 110 points. And from our perspective, that would be destabilizing, potentially contagion-inducing risk for emerging markets. We just happen to think that we're flirting with peak dollar at this moment. And so far, so good in terms of a dollar at 103 points on that DXY. Is it constricting economic activity in emerging markets? It is, but is it absolutely decapitating them at this point? And our answer is no. They continue to function, and we're constructive on emerging markets, although the strengthening dollar, if we were to go materially higher, that would be a tipping point relative to you'd absolutely want to be tactically backing away from emerging markets. We're constructive, but there is a point of inflection here that we're flirting with. Did I answer your question?
Appreciate it. Round of applause to Chris. Thank you so much, sir. All right. We got one more session to go before we have lunch. So if we can have some help here on the stage, or we've got two special guests here this afternoon. And we are in for a treat. We know it's opening day, right? Here at the Indianapolis Motor Speedway, opening practice here. Everybody ready for the race coming up in a couple of weeks, next weekend that is? Are you ready? Well, we are in for a treat today. We have, take this off here, yeah. We've got three-time Indy 500 winner. Come on, y'all. Three-time Indy 500 winner. The great Dario Franchitti, everybody here with us. Let's welcome him. Also, we have a guy who knows what it means to be successful at the Speedway as well when it comes to qualification. He was on the pole for the 100th running of the Indy 500. Now he's doing what I try to do for a living, that is, do the broadcast scene. Please welcome a fan favorite for so many years, James Hinchcliffe, everybody. Come on, make him feel welcome. All right, fellas, thank you so much for being here, taking the time. What a day. I mean, you guys obviously spend so much time here when it comes to the month of May. James, let me start first with you. I mean, what is it like? I mean, I know you've been out here obviously working for NBC, but how great is it to be back in this place for the month of May?
Yeah, I think anybody will tell you, it doesn't matter how many times you come here, every time you come through that tunnel in between turns 1 and 2, and you come out the other side, you just sort of see the Speedway kind of materialize in front of you there. It gives you a special feeling, you know, and when you're either from Indianapolis or you live here like I do. I've been living here for about 12 years now, so I consider myself a local. I'm an honorary Hoosier. And just getting to come to this place, it gives you such a cool feeling. As soon as that calendar flips over to May 1st, everything in town changes. And I love that feeling. And I love being here at the Speedway now.
That's awesome. And Dario, obviously you drank the milk 3 times. And I remember covering those races. One year, did it pour one year when you won it? Was it raining like crazy that one year you won?
Yeah, 07. 15 years ago.
Yeah, gosh, 15 years. I just remember the rain. It's got to be great to always be back here, especially as a former winner, right?
Yeah, it's lovely to come back as a former winner. You know, this. Well, first of all, good afternoon, everybody. How are you? Yeah, it's such a special place, and if you listen to the drivers, and if you watch when Al Jr. won, and he said something like, "You don't know what Indy means," and I remember at the time thinking, "What are you talking about? what is that?" You know. And then having come here for my first year in 2002, 20 years ago, and yeah, having done this race, I think I did it 10 times, it drags you in to the point it becomes an obsession. And so to be back here now as a former winner, working with the Ganassi team, it's still such a special place, and I love seeing my heroes from the past they all come back in the month of May, and it's an incredible event. But it's, to me, as a purist of the sport, just the race itself as well is something very, very special.
Yeah. Earlier, the governor was here and he was talking about Roger Penske and the fact that he owns an unbelievable facility. And I've been told that it's got to be the Penske perfect. That's been like the term, because everything Roger touches turns to gold, it seems like. When you started racing, I'll get to you, Dario, as well. We got a lot of investors here as well. How amazed are you to see where IndyCar has gone with the sponsorships and people diving into this series?
It's been incredible. I mean, how many people are from Indianapolis here by a show of hands? And how many people are diehard IndyCar fans by a show of hands? All right, so some of you know the story, some of you don't. There was a split in IndyCar racing for a long time. Yeah. And we don't need to go into that, but in 2008, they all merged. The other thing that happened in 2008 was, the world fell apart and the global financial crisis. Well, the first thing to go when people start losing money is frivolous marketing expenditures like racing programs. And all of a sudden, our sport was in a really tough spot.
Yeah.
And over the next sort of 10 years, we saw this incredible kind of slow but steady growth in IndyCar racing specifically. And globally, motorsports was kind of taking a bit of a hit, but IndyCar just sort of carried on this really steady upward trajectory, all in sponsorship, in viewership, in attendance at races, number of races, number of entries. We just saw the sport really continuously, this steady growth, even as other sporting properties were really suffering. And I think it's because it's a good product, right? Everything's got to fundamentally come back to the product, which I think is second to none when it comes to motorsports. And I think the fans have responded to that. I think companies and investors have responded to that. And it's been a really fun thing to be a part of. My rookie year was 2011. Old boy here was here in the glory days of cigarette money and pre-financial crisis.
Those horses don't buy themselves,
Yeah, based on the car collection he's got back in England, he was there in the big money days. Yeah. But no, I kind of came in right as the sport was really trying to re-identify itself, and re-find itself after 2008. And it's been really fun kind of being part of the rebuild and part of this upward trajectory.
I love it. It's amazing. I remember a time been on television where we always called it just IndyCar, Then all of a sudden, eyes on IndyCar, right? And then it got to Verizon. I'm like, what the world? I mean, you lived it all. I mean, it's got to be amazing to see where we are now when it comes to IndyCar and open wheel racing, right?
Absolutely right. And I think James makes a good point that this sort of civil war that happened, it really ripped the heart out of IndyCar racing for a while, and it was a difficult recovery. But to see the sponsors coming back, to see the teams investing, to see the business to business deals that have been going on. I mean, back when I started, it was sort of cigarette and beer money, which, trust me, was awesome. But it was not sustainable, and so to see what's happened with the series now, to see the different names on the cars, to see we've got PNC Bank as one of our sponsors, to see how they're sort of making the most of that sponsorship it's really been incredible. And to mention Roger Penske buying the series, buying the Indianapolis Motor Speedway, he's really taken that to the next level and will continue to do that. And any of you that know him or have done business with him, he's an incredible individual. He's also my local car dealer. So I've actually...
he's a lot of people's local car dealer.
Yeah,
he's got a few of those.
Right. Yeah, I've funded quite a lot of this, I feel.
That's right.
But his attention to detail is second to none, and that will lift IndyCar racing, and his organization will lift IndyCar racing as well. So it's... I think it's got a very bright past, but I think the future is it's going to be very, very cool.
Yeah, I know you both have a great connection with this place for many reasons. Dario, let me start with you. How much did this race, winning the Indy 500, how much did it change your life?
I think, it started on the introduction. 3-time winner, Indianapolis 500. You can sort of say, if somebody meet at a dinner party says, "Oh, what do you do?" "Oh, I used to drive racing cars." "Oh, what?" "Well, IndyCar." "Oh, yeah. Indy 500." "Oh, yeah. Oh, wow. Oh, yeah, got that." Yeah. This place is, we talked a bit about what it means. When I first showed up here in 2002, I thought, yeah, it's kind of cool. It's a big race, a lot of people. And then I had to miss it in 2003 because I had a motorcycle accident. That was an awkward conversation with my boss, but anyway. Then I realized how much this thing had got under my skin, and it's the one thing I've done in my life. The more I did it, the more it meant to me. If you do whatever you do, you ride motorbikes, you jump out of airplanes. The more you do it, it kind of becomes normal. This race, every year I did it, every time I won it, I wanted to win it more. I wanted to, it got under my skin so much. And the levels and the risks you take and the things you do just to try and be competitive here, it's really incredible. If we want to talk about risks and crazy stuff, I think we should talk to my Canadian friend here.
Yeah.
And I think you should tell the story. Can you?
Yeah, I guess
Please.
The Speedway changed my life in a different way.
Yeah, I was going to get to that. Yeah, but please share. Yeah.
Yeah, wasn't fortunate enough to win it like Dario, but did have a life-changing event here in 2015. A really bad practice crash just over yonder lost all the blood in my body twice after an accident left me impaled by a piece of the car. And it was only through the absolutely incredible work of the safety team that travels around with IndyCar, the medical staff right here at the Methodist Infield Medical Center, and then the surgeons down at Methodist downtown that I was saved. A piece of the suspension went kind of in here, out here, hit an artery in my leg, and I was bleeding to death. I luckily don't remember any of that. Mercifully,
that always helps, doesn't it?
Yeah, it sure does. Yeah. Mercifully was pretty concussed, and I was driving along. As far as I was concerned, everything was good. And the next second, in a blink of an eye, I'm laying on a backboard. I got a tube down my throat. I have a bunch of bright lights in my eyes. I'm in a neck brace, concerned faces all around, and I think something's gone wrong here.
What happened the next year, though?
So it was a bit of a recovery. I was out for the rest of the season, but did not have any thoughts or second guesses or questions about coming back racing, coming back here. And we came back the following year and actually qualified on pole for the 100th race. So right after, thank you. Yeah, a year afterwards, because there was a lot of conversation about what's it going to be like going back to the place? I'm like, I don't care about that. That's so far in the past. I'm focused on now. And it was a really cool moment to get to kind of accomplish that, as a group after what had happened the year before.
Yeah, it's funny as a competitor working with Ganassi, if you're not on pole, you're upset generally. But I don't think there was one person in this whole stadium, teams included, that didn't go, yeah, wow. I mean, to me, that shows what this means, that to get back in after what you went through and to be dumb enough to put it on pole. I mean, that I mean, all seriousness, the bravery required.
Yeah.
It's funny. I always joke that racing drivers are wired differently. We lack the self-preservation gene that most humans are born with, I think. And you and I, as nuts as we might be, we're nothing. I mean, we're pussycats compared to. We were just talking about this outside about the drivers that used to do this back in the day, when the cars were nowhere near as safe, when the risk was just so much higher, the risk of a mechanical failure, and if something did go wrong, you're sitting essentially in between two fuel cells, and the rate of injuries or fatalities back then was astronomical compared to what we look at those guys and think, you guys are cowboys, we're boring and lame compared to that. So the fact that drivers were willing to do that, and even with the risks today, we're still willing to do it. It just shows you what this place means and what this race means, that even though we know what the risks are, we blindly accept them, strap in and go.
And go for it. It was always the guys that, to me, that just strapped themselves, the guys and girls that strapped themselves in some shit box just to try and make the field and risked it all.
No hope of winning.
No, it was not even.
This is just to get to the starting line.
Yep, those are I have maximum respect for those guys.
I love it. The point that you brought up about James and just that horrific accident you had, and I remember everything. But one thing that came to my mind, kind of what Dario said, when you won that pole, and even when the year prior when you had that accident, the love that folks showed you, not your teammates obviously, but your competitors, but not only that, the fans. I mean, so that's what I meant by the connection. I know you felt what this city was, how supportive they were to try to help you get through that.
Oh yeah, I mean, this is my adopted hometown, like I said, and racing it's a community, it's a family, it really is. And yeah, we go wheel to wheel with each other, and you want to beat everybody, but at the end of the day, it's family, and you always want everyone to be okay at the end. And the support that I got after the accident from fans in the city, from fans in other countries, from everybody in the community was absolutely overwhelming. And that's why it was so cool to kind of come back that next year and just get to be around everyone again. We'd been to other races at the earlier part of the year, but it's not to get to Indy and you've got all 350,000 of your closest friends hanging out here at this place that you really kind of feel that, and it was remarkable. So I got a lot of love for this place.
That's awesome. All right, take the folks inside these cars here. 200 laps, going around the track, circles, on and on and on and on.
It goes that way.
Yeah, well, yeah,
that way.
Yeah. Sorry about that. Yeah. Take us through. What is it like, especially with the heat? As competitive it can be.
Okay,
Give us a feel of that.
All right, okay, hold on.
That way, yeah.
What's the one word you would give a rookie for advice?
Respect.
Okay. I would say patience. Because I think that's what it's like. Because it's so, you strap into this car.
Do you remember the advice I gave you? When
go fast, take chances.
What about the people you're concerned about being an IndyCar driver?
Oh, yeah. This is that.
Let's hear it.
All right, so we'll get a side story. So I'm a rookie in IndyCar, second race in Long Beach. And I'm still just, bright-eyed, bushy-tailed. Can't believe that I'm here racing against my heroes. And just incredible. And we're walking back from practice, and I bump into Dario here. And he's like, so, how you getting on, man? Like, how you liking it? How are things going? Whatever. And I'm like, man, I can't believe I'm here. I can't believe I'm racing against some of these guys. It's just an incredible. And he's like, he goes, he puts his arm around, he goes, Hinch, my boy, he goes, let me tell you, you spend your whole life getting here just to realize when you get here, you're racing against the same assholes you've been racing against since go-karts. Nobody here is special. They're all just drivers. It's not a big deal. And you know what? That day, my mind shift changed, right? Because before, like, Scott Dixon would come behind me in practice and be like, oh, I should get out of his way. That's Scott Dixon. I don't belong here. He doesn't want to, And no, after this, no, he's just another driver. Screw him. And you go for it. So, yeah, he was a big help to me in a lot of ways. But that day was particularly...
Words to wisdom.
Yeah. So back to Indy. You strap in the car.
Yeah.
It is very hot. This is the longest race that we do. As you guys all know, Memorial Day can be scorching, especially now with the aero screens. It's even hotter in those cars. Yeah. Like, did you ever do the weight test before and after the race?
I just know that I had a six-pack after the race until I started drinking water. So I'm like,
right.
Yeah.
So I did it. The record I had was 9 pounds I lost from the start of the race to the end of the
9 pounds?
9 pounds. And before anyone's like, oh, that sounds like a fun diet. No, it's all water weight. And by the end of the night, you just do nothing but drink water for the next 12 hours.
No,
you probably
don't
go to the bath. Sorry, not just water. You drink water for a little bit, then you drink some other stuff that probably dehydrates you further. That's not the point. Basically, you don't pee for 24 hours after this race is what I'm getting at for one reason or another. Yeah. But yeah, it's keeping that focus for that amount of time. It's a 3.5 hour race. At 200 miles an hour, you're traveling a football field a second. So if you lose concentration for 1/10 of a second, you've missed the turn in by 10 yards. And your margin of error is maybe 10 inches. And so to maintain that amount of concentration and focus for that amount of time with that sort of penalty on the line, it's not like, oh yeah, if you're distracted playing golf, you shank the ball off to the right, cool, mulligan, let's keep going. There's no mulligans in motorsports. When you hit the wall, you are done. And so being patient, being respectful, not forcing the issue. Tony Kanaan was saying in an interview this morning, he was telling Jimmy Johnson, who's going to be doing his first 500, there's 2 races during the Indy 500. There's lap 100 to 180, and then there's lap 180 to 200. And you got to make it to 180 to be in the second race, and that's the one that matters.
That is so true, especially with the regulations now. That last 20 lap sprint is where it's at. But you've got to get in with track position. You've got to be in that sort of top 5, top 10 in those last 20 laps to have a shot. For me, I was always in a trance, almost like before the race. I never saw any of the fans, any of that stuff. My job was to switch off and to ignore all that. And so I never looked until the year that I retired and I drove the pace car. My mum came to the race with me for the first time. She'd never been here. And we walked out Gasoline Alley and I looked at the fans and soaked up the atmosphere for the first time. Before that, nothing existed. Just head down, got into this almost trance-like thing, and 3 hours later, either I was drinking the milk or I was sitting on the wall being upset. It was as simple as that. It was, because as Hinch says so eloquently, the margin for error is minuscule. I remember leading here in 2010 and bouncing it off the wall in turn 1. Luckily, I didn't really damage it because I was able to keep going and win the race. But that showed me, I was like, oh, yeah, keep your focus. You've got to be millimeter perfect around this track, and then you've got 32 other lunatics that keep doing things that disturb the air around you, and you've got to have eyes on the back of your head.
What would you say the toughest turn is here? Because you hear
turn one.
Turn one.
Turn one. Absolutely.
Why is that?
I have a scientific explanation for it.
Oh, I'm dying to hear this.
The shape of the track is different in turn one than turn three. And what it does, the way the road moves and the way it changes what they call the cross weight across the car. And it moves cross weight onto the left front, which makes the car slide more on the entry to turn one. Bet you didn't know that.
Is it actually different?
It is.
What's different?
The profile of the road.
Really?
It's very slight different profile of the road.
Wow. Interesting. See, my theory was more mental. Because so of the four turns, you're looking at turn one and turn three because you're going into them with so much more speed than 2 and 4. But in theory, well, a little bit until 30 seconds ago, I thought they were the same. Otherwise, geometrically, when you approach them, but visually, they're very different. Because the back straight, there is a grandstand on the right-hand side, but on the left-hand side, it's fairly open. You can sort of see through and around the corner a little better. The grandstand's only so high. In turn one, you have the whole pit structure on the left side, the overhanging grandstands on the right side that go all the way around turn one. It looks narrower. And it looks tighter. And when you're going into it at 240 miles an hour, yeah, you feel more comfortable going into a slightly more open corner where
That's
you can
a
visually
relative
see it.
term.
Yes,
So, yeah.
more comfortable is a
Slightly
relative
more-
term.
yeah,
Yes, you're still
yeah.
terrified, but it's slightly less terrified. So that was always my theory on it. But now Professor Dario has informed me there is, in fact, a geometrical difference in the track.
So now you know.
Now I know.
All right, we're going to open up for some questions. I got one more for these guys, and then we'll go around and get some questions for them. Obviously, getting ready for the 106 running the Indy 500. Dario, I'll let you get your take on Elio. Sorry, you okay? I know. He's got 4. I'm sorry.
He's actually got 3.
Oh.
Paul Tracy won the 2002
Oh, gosh.
Indianapolis
Here we
500.
go.
He was
wholeheartedly agree.
I'll tell you a little story. So Elio and I kind of started at the same time, and we bashed heads a lot. And clearly, Paul Tracy won the 2002 Indianapolis 500, and we disagree on that. What Elio did last year was so impressive. And I wrote him this long, heartfelt WhatsApp message about just that and how we disagree on that, blah, 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 blah. What a great job you did, though. I'm so, at your age, our age, to come back and to do that, so impressive. And the reply I got said, "This isn't Elio's number anymore."
Oh, no!
I was like, shit. And I haven't sent him to, I haven't sent it to his new number.
But him trying to go for 5. I mean,
4.
Okay.
Yeah, for another.
Yeah, go for another.
Thank you, James.
That's pretty significant. What do you think? I mean,
it's entirely possible. You know, he drove such a race last year. He was against one of our cars, Alex Palou, and Alex is second Indy 500, and Elio's, 15th, and Alex is driving on the nose. He's looking at Elio's car. He's like, I got this. Elio's looking half a lap ahead, going, all right, I'm going now. And he timed it to perfection. And that's the tough part for these kids. They're really quick, but racing against guys like Elio, like Scott, like Tony, they've got so much experience that to beat them is bloody difficult.
That's good. That's good stuff there. Speaking of these young guns, we got so many. We saw Colton Herta just past weekend win the Indy Grand Prix. You live it. You see these guys coming up. How excited should these folks be about this race coming up next week?
I mean, not just about this race, about the future of this sport. We have such an influx of young drivers right now that are going to be superstars in IndyCar for a very long time. And this race is going to be, it's going to be so exciting. Next weekend's qualifying is going to be absolutely nail-biting. We don't have any bumping this year, which is obviously one of the things that normally people really like to watch. You don't like being a part of it if you've ever been there. But qualifying, going for pole, throwing it out there for 10 miles, 4 laps on the absolute limit is one of the scariest and most challenging things that the drivers are going to do all year. And it's going to be so tight for pole. And that's just going to lead into a race. I mean, we've seen how competitive and how close the competition is in IndyCar this last couple of seasons. And yeah, this race is going to be awesome.
I love it. Okay, let's take some questions for the guys. Back, yes, sir. you know, get up here.
So I guess my
You're good. You're good.
question is, I think everybody remembers you winning with Sato and you going into turn one, and only one of you made it out, and you ended up winning under yellow. Do you prefer to be going into the last lap ahead, or the person chasing who has the advantage?
That's a great question. We're talking about, do you want to be leading coming to the white flag, or do you want to be leading, the last lap? I always, because with the slipstream around here, you tend to, if you're leading on coming to the white flag, you tend to get past. My sort of outlook on it was I just wanted to be leading because I felt there was a good chance of a yellow, and on that situation I was absolutely proved right. But I think now they've changed things a little bit. They tend to, if it happens sort of 4 or 5 laps before the end, they'll red flag the race so it finishes under green. But if it happens on the last lap, I always go with I want to be leading. Scott Dixon was always sort of, I want to be leading the lap.
And you think back to 2017, Scott Dixon kind of sat behind Takuma Sato because he's like, well, I don't think he's got enough fuel to make it. I'm not going to force the issue. Yellow came out. Takuma made it on fuel. Scott didn't get another chance to go by him. So, I never did it, but I'm kind of with you in philosophy on that because you just never know what's going to happen. So I'd rather be out front.
Okay, one more question over here.
Dario, your involvement with Formula E, how do you, as you look into the future, 10 years, 20 years, with the change in the way in the cars we drive, how do you figure Formula E, IndyCar, how does that balance go?
Yeah, that's an interesting question that I think not only all of motorsport, but all of the automotive industries and other transportation areas are asking. But to me, Formula E has been a great addition to the world of racing. It's not going to, right now, it's not going to take over from Formula One. It's not going to take over from IndyCar. It has its limitations as a sport, one of which for me is the lack of sound. I think it puts on phenomenal racing, and it's done a lot for the sort of speeding up the development process of electric vehicles. But I'm an old petrol head. I love cars that make noise. So I think it's a great addition. I don't think it should take over from any of the... I think it should remain an addition, shall we say. That's probably the best way to put it.
All right, we've got time for one more question.
This one will be quick. Do you guys get to pick your milk? Are you a skim milk, 2%, whole? Do you pre-order it? I guess that's for Dario.
No. Oh, wow. Sorry.
Jeez.
Wow.
Get that guy out of here.
So
Let's go. We're kicking him out.
all drivers get a form, and I think they've already had it, and it says something like, if you're fortunate enough to win the Indianapolis 500, would you like? And you've got to tick a box, and it's 2%, full fat.
Yeah, it's whole milk. No, it's 2% skim milk. I think they added a lactose-free option one year.
They did, yeah.
I don't think that was particularly well received. But they also used to have buttermilk. Because if you know your Indy 500 history, that's actually where the tradition started with Louis Meyer back in the 30s. And in 2014, I believe, was the first year buttermilk was no longer offered. And Ed Carpenter and I actually both threw a big fit and wrote a sternly worded letter to the Indiana Dairy Farmers Association saying if it was good enough for Louis Meyer, it's good enough for us. And so I wrote my own box and said buttermilk and checked it, and they never brought it back. Never came back. Yeah.
I told them they could give me 10-year-old's yak's milk, and I would be quite happy as long as I won that race. And then the last one, 2012, it was the second hottest on record or something. So I get this milk, and I'm like, here we go, because I was pretty thirsty at this point. And then Chip's going, stick it on your head, pour it on your head. So pour it on my head. Don't do that in 102-degree heat, because after an hour standing in the sun, it starts to smell. Anyway,
It was curdling.
yeah, it was horrible. Anyway, so I finished the bottle, and I say to the guy from the Dairy Association, "Can I have another?" And he said, "No." But he's like, "There's one for the owner, there's one for and there's one for you." I'm like, yeah. Yeah. So anyway, they're generous, but they're not that generous. And they actually, cards on the table here. You do get paid by the Indiana Dairy Association to drink the milk as part of the thing. If you drink the milk, you get more money on the banquet. There you go.
Drink up.
Wow. Okay.
We're telling all the secrets today, aren't we?
Yeah, we're loving this, right? We're liking that. I got one more question, and then I'll let you guys finish up here. I know you get asked this all the time, so we got to bring it up. Rituals. Like, what did you do before the big race? And you got to deal with people like me trying to interview before the race. You got family members, but what were your rituals before you got ready for the race?
Well, that's what's so unique about our sport, right? I mean, if you've been to this race, you've seen it. The grid's packed with people. The drivers are down there. It's sponsors. It's family. It's team people. It's everybody. It's media. And they clear the grid, about 7 minutes before you strap into the car. And that's the time that you've got to sort of get into the zone. And up to that point, you're taking selfies and signing autographs and answering questions. I remember talking to a member of the media. I said, "You've covered Super Bowls." Well, they're there. All those distractions are right there. And I was asking some member of the media, I'm like, "Well, you've covered Super Bowls before. What's the closest to Super Bowl, to kickoff on Super Bowl Sunday that you could talk to Tom Brady?" And the answer was Thursday. We get 7 minutes. He gets 72 hours. So like that ability to switch up everything that was my ritual had to happen in that 7 minutes, because that was really only the time you got. I'm not a superstitious guy. I was superstitious about not being superstitious. Like some people, our buddy TK, he's got to put his gloves on in a certain order and get in from one side of the car, and he can't wear a new suit in a race. He has to wait and practice first. I remember saying to him, I'm like, "TK, if you think what underwear you're wearing today affects the outcome of your race, stay the hell away from me on the track, because you're out of your damn mind." So if I had a good session, I would change everything, because I didn't want to get into my head that's why. So I had a routine, just like any athlete would, about kind of getting into your zone. But I was never, it was always very simple stuff. It was how you got in, how you did your seatbelts up and stuff like that. And that was just more muscle memory to get your brain into the right mode. Like, okay, now we're going driving.
What about you, Dario?
I'm just laughing here at Hinge trying to say he wasn't superstitious. And that's when people say, "Oh yeah, it's just brain triggers," when it's actually superstition.
No, it's training. It's mental training. Totally different. What underwear did you wear?
I've still got it. I've got all from the wins. I've got it all. I
believe you do.
Mannequins at home. I've got under the suit, right? There's a whole outfit. So I would about an hour before, I'd sort of do that thing, start getting into almost sort of a self hypnotizing. So then I would go into the green room, and I would find a quiet spot, and then you go up on stage and wave, but none of that was sort of penetrating into my brain. I was just do it automatically. Then get in the car, and the one thing I would do was when Jim Nabors would sing "Back Home Again" in Indiana, I would sing along. That was my one little thing. I loved Jim. Jim was my pal, and I would do that. Yeah. And I was normally there was no emotion involved in any of just completely out of it. And then 2012, it was the year after Dan Weldon had died, and I was in the car. I qualified 15th or something, really not very good. And I was sitting in the car, and Jim starts to sing, and it was a recording because he wasn't well. And I don't know what happened, but I just started crying in the car, and I'm like, "Dude, get your shit together. You've got a 500-mile race to run here and attempt to win." So that was the one time something kind of penetrated in.
That's great. I'll let you guys get out on this. James, talk to the folks here. Give us some encouraging words why they should. I know they're going to get a chance to check this place out and tour here, but why they should come back to the race next week, check out Carb Day, and spend some time here this month.
Well, I mean, it's history, guys. This is the single largest single-day sporting event on Earth. We're finally back open to 100% capacity, which I know everybody's excited about. Ticket sales are through the roof, but it's the spectacle It's the greatest spectacle in racing. They don't just put that on posters and T-shirts. It's there. The line's there for a reason. There's nothing quite like this race and this track on race day. The people, the atmosphere, the energy, the excitement, and then ultimately 33 lunatics out there trying to go fight over a bottle of milk. But it's absolutely worth coming here. You got to see it in person. You got to experience it if you never have before.
Dario?
I don't think I can top that. All I'll say is today, if you get the chance, go out there and just watch the cars for a minute. And remember, that's only practice. You know, just think what will happen with 350,000 people in the stands and 33 cars all actually fighting it out. They're just trying to learn for a week on Sunday. It is so spectacular. And I hope you enjoy it today and hope you come back week on Sunday.
That's great. How good was this, everybody? How good was this? Dario Franchitti, James Hinchcliffe, thank you guys so much. Awesome work, awesome work. Come on, give it up, y'all. We can get up for these guys. Great job. Thank you so much. All right, section 6, the opportunity for crypto and a blockchain technology. The speaker for this session is Paul Veritaket, a partner at Pantera Capital. Paul is a guru in things most people don't understand. He's a crypto investor as well. Please put your hands together, folks, for Paul Veritaket, a partner at Pantera Capital. Oh, give it up for him. Give it up for him.
What's up, man? Hey, thank you very much. Hey guys, thank you very much. My name is Paul Veritaket. I'm a partner at Pantera Capital. We are a $6 billion fund focused just on cryptocurrencies and blockchain. I'm here with my colleague, John Johnson. John, where are you? Oh, he's right there? Yeah, go John. And I just want to thank Indiana University and Cfa Society for having us out here. I want to get a little bit of a temperature of the room. I mean, anybody own any cryptocurrencies here? A little bit? All right, we got some folks here. Anybody heard of Ethereum? All right, anybody heard of Terra? Okay, all right, actually more people hearing about Terra than maybe owning cryptocurrencies. Well, we can talk a little bit about Terra in a bit, but yeah, why don't we get onto this? I think I really want to give you guys a little background on our firm, sort of what makes cryptocurrency and blockchain compelling. And then we'll wrap it up with, some of the offerings and what we sort of do as a firm. And so maybe just getting straight into it. The firm was founded by Dan Moorhead, who used to be CFO and head of global macro trading at Tiger Management, one of the world's largest hedge funds. And around Dan, he's assembled a team of about 75 people. I joined Dan in early 2014. And my background, actually coming from finance, I used to be an economic consultant, so I sort of relate with you guys. And then I joined Pantera 8 years ago. Beforehand, I was also at another VC firm called Strive Capital. But I do want to say that, this space is really approachable. Just think about it as sort of internet, but the internet of money, which we'll get into. But surrounding Dan, and myself, we have John Johnson, and we have other people that come from traditional finance, venture capital, and deep tech. We built a firm of $6 billion, and we invest across all different asset classes in blockchain. So everything from your tokens to your equity and startups. So Pantera has been early on in the space. I mean, Bitcoin was created in 2009, and we started investing in Bitcoin, launching the first institutional fund for Bitcoin in 2013. So we've been investing into Bitcoin was $40. And so the return of our fund is about 80,000% returns, which is pretty good. It's pretty good. We launched the first blockchain venture fund in 2013. We also was the first, our co-CEO Joey Krug launched the first application on the blockchain called Augur, a decentralized prediction market. And then in 2017, we actually launched the first fund focused exclusively on ICOs. Getting in to these crowd sales, getting into these tokens, and doing very well with that strategy. So this is kind of us at a glance. $6 billion, average IRR for all of our funds is about 105%. So, normal IRRs are probably in the sort of like 15, 20%. Good firms have 40%. We're hitting triple digits, about 50-50 in terms of equity investments and early stage token investments. And we've led about 50% of our deals. So what makes blockchain interesting? I mean, we've had early things like gold and commodity. We've had obviously fiat money. And then now more recently, we have digital currencies, Bitcoin, Ripple, other digital currencies that kind of act a little bit like money. And then now we have, in 2016, we had all these ICOs where a lot of these technologies and products use that token. And so that token sort of represents shares within that project. It's freely tradable, so think of them as sort of digital companies. And the last category that we're seeing right now is digital, or sort of decentralized finance. And that is really what we'll get into a little bit later, but being able to actually automate finance and remove the middlemen, removing banks, removing guys that do arbitration, marketplaces, et cetera. And so at the end of the day, what this really shows is, we're kind of removing the middleman and giving more power to users and creators. So what we think of, I guess, starting off with Bitcoin, is that it is the final piece of the protocol. So we've had other protocols like HTTP, SMTP that help power the internet, but that kind of helps move data and information around. But we haven't really had a protocol that actually helps move money around freely, and that's what Bitcoin does. You can actually move money peer-to-peer without the banks. I think now we can talk about other protocols that also do the same sort of thing even better. I mean, one of the things that really excited me in 2017 was with Ethereum, when it wasn't so clogged, but Ethereum is a digital currency that you can send from one person to another person. And I did a transaction for Pantera. I sent $600,000 from where we were in the United States over to Hong Kong, was able to send that within 10 seconds and it cost me 30 cents. That's amazing. I'm not going through these correspondent banks to charge me, anywhere from, 2 to 3% all the way up to 10%, and it takes 1 to 2 weeks, and there's no transparency whatsoever. So to be able to use digital currencies, cryptocurrency, be able to move money around, I mean, we'll get into one of the case studies, but like one of our companies is doing 10% of the remittances between US and Mexico all over cryptocurrencies, and you don't even know anything about cryptocurrencies. So this kind of gets a little bit more into, where we moved from, voice over IP using something like Skype. Now we're going over to money over IP, where you're using something like a mobile app and you can send money cross borders using cryptocurrencies in the back end. So we'll get into a little bit about some of the more popular cryptocurrencies. Starting off with Bitcoin, which, when I got into this space, Bitcoin was really there for store value and payments, especially in the emerging markets, places like Argentina, where, inflation and governments can sort of, make the value of your cryptocurrency go to zero. And one of our entrepreneurs, the value of his currency, Argentinian peso, has gone to zero 3 times in his lifetime. So to be able to store value in something that is decentralized like Bitcoin has been huge for the emerging markets, in addition to having them, move money peer-to-peer or even cross borders without, using banks. Ethereum is I guess it would be the silver to Bitcoin's gold. Ethereum is a blockchain that enables smart contracts. So what's different about Ethereum is that you can basically input a lot of different rules, and you can have transactions or money get executed from that. So let's just say, using Joey's example of Augur, if you're betting between who's going to win the Super Bowl, and it's you bet that the Rams are going to win the Super Bowl. If the Rams do win the Super Bowl, you usually have a centralized intermediary that has to kind of figure out, like, okay, who gets paid what, like that sort of thing. What if all of this is all coded and there's money that's tied to that code that basically automatically pays everybody out? Now you don't have to pay the middleman. You don't have to pay all these brokers. So that's what something like Ethereum does. It really allows you to program money. And the last thing is Polkadot, which we don't have to get too much into, but we're now having a lot of blockchains out there competing with Bitcoin and Ethereum. Polkadot is a blockchain that helps to connect blockchains together. So at the end of the day, as we see more competition out there, we need connectivity. And so this is kind of how protocols have evolved. We've gone from store value to one smart contract blockchain to now we have a lot of different options to kind of build in terms of applications. I think this slide is pretty interesting. So, as I mentioned in the past, HTTP, all these protocols that you never really know kind of helps power the internet. No one knows about it. Those protocols don't make money. All of the companies that do make money are Apple, Microsoft, Google, all the guys that are taking sort of the intermediary position. What we're seeing here is Bitcoin, Ethereum, all these different protocols are actually taking most of the value. They are building platforms in which you need their token to actually execute transactions, or you need it to sort of store value. And the applications on top, things like Coinbase, things that are like Alchemy, things that are acting like developer platforms, or things that are acting like decentralized banks, they're taking less of the value. So this is actually really cool that we're actually seeing a lot of these underlying platforms really give value back to the users, because anybody can actually access Bitcoin and Ethereum. And as you prove, and as you help run networks and do things for these different protocols, you actually get part of that value, which is pretty awesome. So this slide right here, we're going to talk a little bit about some of the other blockchains that are out there. Bitcoin, Ethereum. Now we have probably 5 or 6 different blockchains in which people can build applications on top of. You can just imagine the blockchain is a decentralized ledger that can automatically execute transactions. And so what I really want you guys to get out of this slide is that people would say, there's a lot of risk around hacks and technology. Well, we've kind of grown as an ecosystem where there's diversification. There's a lot more options for people to actually build in terms of technology and also in terms of scalability. There's probably trade-offs between scalability and decentralization and even sort of applications. There are certain blockchains that are better at building certain applications than others. For instance, a lot of people are going to Solana and we'll talk about NFTs, but a lot of people are building games and NFTs on Solana. A lot of people are doing things like decentralized finance on top of Near and Avalanche. And so, each of these blockchains are serving those specific purposes. I want to talk a little bit about Bitcoin. We'll start off with the most popular cryptocurrency. Usually when you ask about, hey, what do you think about cryptocurrency? People say, oh, you mean Bitcoin? Yes, Bitcoin to us is sort of like Microsoft. It's the first one. It has the biggest mind share, has the biggest market cap. And as you can sort of see over time, the return for Microsoft has been limited to about 10x versus some of the other companies, Google, et cetera, the ones that came later on and started to disrupt and provide innovation. Those are the ones that have made 933x. And so at the end of the day, what's really interesting here is, we do believe that Bitcoin should be part of people's portfolio. And it's part of our portfolio too, just a small amount of it though. The way that we think about it is there's other cryptocurrencies right now that have a lot more upside than Bitcoin because Bitcoin's already at a certain level. And so for us, when we create a portfolio, we're looking to create a diversified portfolio, but we really skew towards cryptocurrencies that can outperform Bitcoin. And there's now thousands of them. So, for you guys, you guys can go out there and choose yourself, but if you go with an active manager, our job is really to analyze each of these and come up with a set of cryptocurrencies that we think will do very well in addition to outperforming Bitcoin. So I want to talk a little bit about decentralized finance. Again, this is automated finance. That's the way to think about it. There's a couple of different things that are needed for decentralized finance. And we'll get into the first one a little bit more deeply, and you guys may be familiar with it. It's called a stable coin or a stable cryptocurrency. And so these stable cryptocurrencies can be pegged to the US dollar or even backed by the US dollar. And there's a couple of different ways that you can go about doing that. There's decentralized exchanges, so being able to actually have an exchange where you do that exchange directly in a peer-to-peer way without an intermediary using smart contracts. There's also things like lending and borrowing. At the end of the day, when there's assets out there, there's going to be a marketplace to actually get new assets and to be able to take leverage and margin. So all of these are needed within decentralized finance. You can see that decentralized finance has grown quite a bit. So, we've now facilitated over, 200 billion in terms of market cap. and over 100 billion in terms of monthly trading volume. A lot of these are centralized or sort of consolidated around some of the largest decentralized exchanges and some of the largest decentralized lending and borrowing. Some of this collateralized stable coins, and then also things around like staking. So the stablecoin market right now is fairly large, 186 billion. It's centralized around USDC, which is a dollar-backed stablecoin. There's also Tether and Binance. Some of you guys may be familiar with Terra, which is an algorithmic stablecoin that actually went from a fairly large market cap down to zero recently. Wanted to say that that is a risk of the ecosystem of just having too much money in without having sort of the right mechanism. But at the end of the day, for us, like we had minimal Terra Luna exposure by the time the crash happened. We actually made a 100x investment on that strategy of going into Terra Luna fairly early on, and through our data and everything, we're able to sort of de-risk along the way. And so that's one of the things of going with an active manager, really able to look at the risk and being able to actually look at the data to see if a mechanism is going to work. Now looking at Web3, which is what we would also call the creator economy. It's also the difference between Web3 and Web2. Web2 is kind of what we see right now, the eBays and the Lyfts and Ubers. Is really Web3 is where you have a token and you incentivize users to use your platform by giving them tokens. Tokens represent shares in the company. So imagine if you were to join a decentralized Facebook, you could be earning Facebook tokens where it actually mirrors having a share in the company. And as long as the company continues to do well, you do well. And so instead of actually giving up $5 for user acquisition, you're giving up shares in the company. And so it really aligns the company and the user. And what's really neat about that is, you can continue to incentivize certain actions within the product to incentivize more usage. And then of course, like you'll earn more shares in the product. So it's really just kind of giving value back to the users, especially because Facebook uses your data. So if you actually opt in for them to use your data, you should be able to get more value from it. So Facebook is one example of a type of company that can be decentralized around social media, but we think that there's opportunities for two types of disruptions, either marketplaces where you're paying, Spotify, you're paying Lyft and Uber 20 to 30% to actually run these transactions where they could be automated, or you're paying them to do arbitration. Or there's things around, the maintenance of the ownership of your own data. And then any time that someone actually monetizes that data, you make money off of it too. Now I'll get into things that are a little bit more on the consumer side. Anybody heard of an NFT? A little bit? Okay, great. So an NFT, it's different from Bitcoin. Bitcoin, if I give you a Bitcoin, you're not really quite sure if it's Bitcoin number 1 or Bitcoin 1 million. But with an NFT, each of these tokens are represented on the blockchain as a unique token. And what's interesting about that is that you can now turn anything into something that's unique or a collectible by pointing it back to the blockchain. You could issue anything around art. That's probably the first thing that's been sort of brought up as an NFT. Moving the traditional art market to the digital art market. Normally, it takes a long time to kind of go to a intermediary or someone to appraise whether this piece is real or not. But what if you can do that in an instantaneous way by just checking the blockchain? The blockchain says, hey, that is a unique thing, and the blockchain is immutable. There you go. Like that thing should have at least it's authentic. Now, of course, whether you think or whether someone else thinks it has value, that's up to the market itself. But this can be anything from music, art, video, etc. I guess one of the most interesting use cases of NFTs have been around NBA Top Shots. So I know you guys this could be maybe a highlight video of your favorite IndyCar driver finishing up a race. There's only 10 editions of that. You can prove that it's authentic on the blockchain, and whoever created that can earn some value. What's also really interesting is as each of these transactions are tracked on the blockchain, you can also program that every single time there's a transaction of this NFT, that original creator gets 10%. That's pretty cool. You actually get a lot more value back to these creators, all programmed on the blockchain. Gaming and metaverse. That's another area where you can also have NFTs. NFTs are used to, create engagement, incentivize the fan, but also it could be used for, representation of unique items. Let's just say it's a certain sword or a certain cape or something like that. So, NFTs really can go anywhere. We can see Coca-Cola launching NFTs, and they can be tied to access to different things, perks, etc. I can see Indy 500 doing something like that too. Some of the other companies, now we'll start getting into maybe some of the more boring stuff, but I think the infrastructure to power some of these applications. I mean, we've invested into things like Alchemy and Starkware, things that are providing developer tools, payments, Veeam and Wire. They help move money across borders without anybody needing to know that Bitcoin's used underneath. Exchanges, so your Coinbases and your FTXs, consumer, Maker's Place, Audius, those revolve around digital art marketplaces. Audius is a music platform that allows musicians to stream music directly to their audience without having to go through Spotify or SoundCloud. And then the last category is around finance. So you got to make sure that you can keep your cryptocurrency safe and maybe even get some yield from it. The first case study I'll talk to you guys about is a company called Alchemy. So Alchemy is the Amazon AWS for crypto. They provide the server, infrastructure, developer tools, and APIs. And we invested into them fairly early on during their Series A round. And we've probably made about 50 or 60 times capital on the investment. And so we kind of go in there, find the team, find the guys with the vision, the product, and just help them kind of scale out from a technology perspective and from a business development perspective. So I'd say they now power about 95% of the transactions on Ethereum. And so every application that runs on top of the blockchain is building on top of its developer platform. So it's been a great investment and a really needed area for our ecosystem. Another one is Amber. So there's a lot of exchanges out there. And so if you want to go out there and actually trade, you have to set up accounts at all of these different places. And then you have to then figure out like which place has liquidity and which place has the best prices. Amber is a decentralized prime brokerage, or not decentralized, but it's the prime brokerage for crypto. And it also has a consumer product that provides structured products, institutional type products for retail. So we invested early on in the Series A, and now they are about to raise it probably close to 10 billion. So, for us, it's been another 50, 60x return. We've really helped them out with business development and around technology. The last case study is going to be probably pretty familiar with you guys. If you guys do get into crypto, you probably start off with either something like FTX or Coinbase. This is the Coinbase for Latin America. So Bitso is the leading exchange and brokerage in Latin America, in Mexico, Argentina, and Brazil. And so for us, we believe that there needs to be a Coinbase of each of these different geographies. It's actually a really early thesis for us. And so we invested early on, and we're one of the largest shareholders. They actually do facilitate about 10% of the remittances from US to Mexico, all using some sort of cryptocurrency. And so, we've helped them out think about like product, strategy, M&A, et cetera. We invested around the Series A, and they just raised at a $2.2 billion valuation from Tiger Global. So I think the way to think about cryptocurrencies is, I'm not going to advise you guys to put half of your net worth in cryptocurrencies. Probably not the best thing to do or the wisest thing to do. But I would say that, looking at the asymmetric opportunity, the cryptocurrency market size is about 1.5 billion. And look at the different areas at which cryptocurrencies can really disrupt. I mean, everything from payments to store of value like gold and other bigger ones like that, like bonds. And so, for us, like we advise folks to put a single-digit percentage of their net worth, or look at putting maybe half of what they normally put into a certain fund into cryptocurrency. It really is something that's not correlated, at least in the future, to sort of the traditional markets, and it really just provides a lot of asymmetric opportunity and a lot of diversification. As you can see right now, I mean, the deviation Bitcoin from its trend line is fairly low. So if you look at that, then the next few slides are just telling you that it's a great time from sort of a trend perspective to get into something like Bitcoin if you're going to start off there. I'll give you guys a little bit of snapshot on what we do at Pantera, and so you can think about maybe how you want to, think about your strategy for cryptocurrencies. For us, we feel like there are 3 different ways that you can invest into cryptocurrencies. Number one, you can be investing into, number one, you can invest into us. Number 2, you can invest into venture equity. So that's actually investing into the equity in companies, just like venture capital. Early stage tokens, you can be investing early into projects that are going to issue a token for their project. And then the last one is to go on to exchange and buy a cryptocurrency that's already on a Coinbase. The thing about those cryptocurrencies are they are a bit more de-risked than the early stage tokens because they've already gone through the process of building up a community and getting listed on an exchange. It is going to be at a higher price than if you got in on an early stage token deal, but that's kind of the trade-off. We're pretty transparent about our returns. So if you look at our venture returns, our worst performing fund is performing at about 8 times capital. And our current fund is about 9 to 10 times capital, though I think it's a little undervalued right now, and IRR is about 143%. So overall, like all of our funds have done fairly well, and just the Bitcoin fund is just ridiculous. And so you can see some of the examples of the companies right here in each of the buckets. You have your custody, payments, and trading on the venture equity side. On the early stage tokens, a lot around decentralized exchanges and decentralized derivatives. And then on liquid token side, some of the more mature companies around smart contract, blockchains, things around yield, etc. So this is the current state of what we're doing here as a fund. We're actually closing up our fund right now. We targeted 600 million. We're now at a bit over 1.3 billion. So it's going quite well. People are really interested in diversifying. We actually are launching a new fund too. We're raising $200 million for a select fund. So the ecosystem has grown. We're actually seeing companies go IPO, and we're seeing large acquisitions happening. So on the select fund, it's really going to be a small subset of about 10 companies that are in the growth stage. Valuations between a few hundred million all the way up to $2 billion. Estimating for each deal, underwriting about 5 to 10x return, if not more. So I think it's going to be lower risk than venture capital. It's going to be all equity, and it's going to be a high concentration of those later stage deals. As you can see right here, the percentage of deals that are hitting the growth stage is also increasing. So, there seems to be a market for it. And, we feel like we're in a pretty good position because we invested into all of these early stage deals. A lot of them are portfolio companies. So we really can track the market through this. So, that's the end of the presentation. I really want to thank you guys for giving the opportunity to give you guys this talk. Hopefully it seems a little bit more approachable, and you guys got sort of the breadth of kind of all the different areas that are going on in blockchain. Feel free to come and chat with myself or John, who is now kind of moved over there. We'll be here for a bit, and then also be here for the happy hour. And if you guys want to contact us, it's invest@panteracapital.com. Thank you.
We'll take a couple questions.
Oh, sure.
We'll take a couple questions. We'll take a couple questions. Yes, go ahead. We can hear you.
I'm curious if you have what the term structure is for the funds that you've created, and ultimately what's your expectation for liquidity out of those to realize those great returns.
That's a great question. So if I roll through, why don't I do this? Here we go. So the fund that we're on right now is a venture fund that is going to be investing into tokens and equity. And so that is a traditional venture fund 2 and 20. The way that I think about it is our investment period is 5 years, but we'll probably deploy the fund in about 2 years. So we'll probably see distributions going back to investors around year 3. And then we also have, and that's kind of like the more institutional fund where everyone's like, hey, I want to invest into Pantera. I want you guys to choose tokens versus equity and over a certain time period. I don't want to think about like all these different strategies. But if you really do want a certain strategy that's not venture capital, that we can actually give you liquidity, we also have 2 hedge funds that are open. One is the early stage token fund that invests into early stage tokens, early stage projects that are going to issue a token. And that's a quarterly liquidity hedge fund. And that is, I believe it's 3 and 30. And then the other hedge fund is a liquid token fund that invests into tokens that are a bit more mature, that are liquid on the exchanges. And that's a quarterly hedge fund that's 2 and 20.
Okay. Any other questions? Any other questions?
Something I haven't fully understood in the NFT market. So I understand the idea like well, at least it's a legitimate painting. It can be qualified that it is real. So then within the NFT market,
Let me hold you up.
Yeah.
So let's say you get the jump shot of Michael Jordan
Reggie
making
Miller?
it to
Sure,
win,
yeah.
or Reggie Miller winning, whatever it is. You get that, and you're one of 10 people that can
Sure.
supposedly own that snippet. What then? How do you actually enforce your ownership rights? So, like with you owning a painting, you physically own the painting. It physically sits in your vault. Sure, you can have pictures of it, everything else, but you cannot have that exact painting unless you buy it at like Christie's auction or buy it from that person. So something I've not been able to figure out within the NFTs, are you enforcing copyright laws to where like, oh, I'm one of the 10, so I own the copyright of that image and it can't show up on Facebook anymore? Or like, how does the actual ownership work? Because I don't understand the token part.
Yeah, that's a good question. So you're right. If you do have a Mona Lisa, and you know, of course, like you can have a copy of that Mona Lisa and you put it onto your wall, and you can say that you have the Mona Lisa, but you really don't have the Mona Lisa because we all know where it is. And so the difficulty is, you know, how do you do this with the blockchain? I mean, the thing with the blockchain is, and this is what we probably have to sort of get to in terms of the user experience, but like you can actually track, and you know, this probably takes a little bit more time than it needs to right now, but you can actually track the origin of each of those different 10, you know, collectibles of the Reggie Miller, you know, sort of 8 shots, 8 points in the last minute kind of game. And you can always point back to the blockchain almost instantaneously. So that's the unique part of, you know, doing this on the blockchain, is that, like, you know, it's all there's a digital representation, and as long as you sort of know which blockchain it's on and sort of what is the sort of like the origin sort of code with it, then you can actually tie yourself to that. I think what's also going to happen in the future, though, is there's going to be, you know, an easier way to mark each of those as being sort of almost like it depends on which platform, but like there's going to be a way for each of these platforms that show that collectible to sort of show that it's authentic versus people needing to actually go out there and look at the blockchain. I think that's number one. And then there's also going to be something around IP and rights too, where even if it's a truly new creative piece, then there's going to be an opportunity for people to potentially, like, you know, have copies of it that aren't the real things. And so, you know, with that, there's going to be some way to tie it back to the original owner. Yeah.
What differentiates your NFT that is on Ethereum blockchain or whatever else? What differentiates it from me capturing on DVR and then downloading that file onto my computer and then uploading?
Yeah, the difference there is that, like, hopefully it's not just that that number one, like, it's who's creating that jump shot and how it's sort of like designed, and number two, what goes beyond just that collectible is like the community that's put around it. Imagine, like, you know, all those guys that have a collectible get to actually get, like, you know, first dibs to kind of buy like other collectibles from, you know, whoever created that. So it's really kind of more about brand engagement with that creator versus just that NFT, because there's a lot of other things that creator is going to be collecting, and so there's going to be a lot more value that's going to be tied to that collectible just because of the different access and community that NFT gets you. So think about Bored Ape Yacht Club, for instance. I mean, having a Bored Ape, and, you know, there's like apes that kind of look like they're bored, they got the sunglasses and stuff like that. It's more than just actually that collectible. You're part of that community where you get to go to the events with other Bored Ape people. You get to maybe see, you know, things, you know, other person, Kim Kardashian, like other community members. It's more about the community than actually the collectible, even though it's probably going to start off as a collectible. That's going to be like the most interesting thing tied to that specific creator. Awesome. Thank you so much, guys.
Thank you, Paul. Thank you so much, Paul. All right, moving on to session 7 now. Current trend in asset management. Heather Brilliant, CEO at Diamond Hill. Heather is one of the leading women voices for the investment management industry. Over 20 years of practical in the weeds, if you will, active equity management experience. Proud supporter of the CFA Institute and a CFA charter holder herself. Please welcome to the stage, Heather Brilliant.
I'm so happy to be here with you today. As you are somewhat aware from my introduction, I did spend a lot of time working with CFA Institute earlier in my career, and also was a volunteer leader of the CFA Society of Chicago many years ago. And so I know how hard it is to put on an event like this, and that it's all done with volunteers who are in the room. So thank you all for putting this on. I think it's a really great event. So I do have some slides, and I think that the title of what is in your program is kind of the state of the investment management industry or trends in the industry. And the reality of what we want to talk about today is really where are we in the markets, what's going on now, and what does that mean for us as CFA charter holders and for the firms that we work for and run in our industry. So a couple of points I wanted to make today. I think that we are in an environment where essentially we are experiencing a period of historic volatility because we are experiencing a historic shift. And this is not entirely dissimilar to the way Chris's presentation, Chris from T. Rowe, started out earlier today, which is to say that we have been coming out of a period of a 40-year decline in interest rates over the course of the last multiple decade period. And what we're really seeing coming out of that is material changes in the way things are valued and the way the world is looking at markets and opportunities for investors. So these extreme shifts are really colliding, I think, when you see some of the extremes that have been built up from a valuation perspective that can reverse as we see things like rising inflation, which Chris talked a lot about, so I will not spend too much time on that topic specifically. Clearly, we're seeing a period of higher interest rates. I think one of the key questions right now is where that settles out. Deglobalization, something that Chris talked a lot about as well, that's really causing investors to recalibrate their valuations. And we all know as charter holders that in order to value a company, especially if you're talking about old school companies with cash flows, maybe this is not how you value cryptocurrency, but it's definitely how you value companies that generate cash flows today or that you expect to generate them in the future. You need a discount rate. And so as inflation increases, as interest rates increase, the discount rates we use in order to value the companies that we're looking at has to go up. And there's a lot of implications for that, which is really kind of the foundation of what I want to talk about today. So the big kind of high-level conclusions from that are that absolute returns will be a lot harder to come by in US equities anyway than they have been in the last decade or even 2 decades. The valuation landscape is shifting materially, which we believe gives valuation-oriented investors a chance to outperform, which I think can be good for a lot of us. On top of that, this is an environment for active managers. Now, a couple people have referred to that, and I stand up here in front of you all as an active manager, certainly hoping this is finally going to be the case, because we've been looking at 20 years where the best thing you could have done to invest in the broad US equity market is to be in passive. So I fully appreciate that, but I do think there's some reasons to believe that now is the time to really think about allocation to active managers, and I want to talk a little bit about that. And then finally, talking about some of the changes we're seeing among clients and what I'm sure you are all seeing too among your client bases, where there's a lot more demand on investment managers to deliver for clients that goes beyond just delivering performance, although that is still, of course, the most important thing that we all have to deliver. So I just want to talk about a couple of these points and share a few of the proof points from my perspective. First of all, this chart really shows valuation dispersion. And I know it's a little bit hard to see, but what you can see really clearly anyway is that the breadth of the lines over the last 20 years gets dramatically bigger. And what that means is essentially in the financial crisis, valuations compressed. Everything was undervalued. So it was pretty easy to buy anything and do okay over that time period. And now we're in a period where while absolute valuations have certainly come down this year, overall, we're still seeing huge dispersion among valuations, which means that active management becomes more important because we do need to be able to understand which businesses are going to generate sufficient cash flow in the future. How do different discount rates influence how we think about valuing those businesses? And what does that mean that we should be doing from an investment standpoint for the next 10 plus years? Let's see here. Then also profit margins. So profit margins are near historic highs. And I think there's a lot of different ways to look at this. Certainly, I think Chris had some data to this effect as well. So I won't belabor the point that we're seeing very high profit margins. But I did want to underline a point that's on this slide as well, which is that labor's share of income is near historic lows. Now, this data is a little bit hard to get on a very timely basis. So this is actually a couple of years old, but it is the most available data out there from this particular source, which is essentially showing that the labor's share of income has not kept pace with gains in productivity. And we think that has very meaningful implications for inflation going forward, particularly as we think about the increasing power of labor. Chris talked about this too, with some examples of some unionization that started to happen. Certainly, we think there's a lot of potential for more of the profit pool to shift towards labor, which comes in the form of rising wage expenses, and essentially means that we do expect to see inflation continue at pretty high rates. Now, 7%, like we're seeing today, I think that's highly unlikely, but it's not out of the realm of possibility. We're certainly seeing it today. We think it's much more likely that inflation settles in the 3 to 4% range. Those are much bigger numbers than a lot of people are assuming still today. And it really does factor into where we expect interest rates to settle if we're all trying to figure out, again, what are these discount rates we should be using to value the businesses that we're looking at. I did want to mention also on this topic that the beginning of this trend toward deglobalization that we're seeing will really have implications as well, particularly if you're thinking about this from a US economic perspective, because we can see already today that in many parts of the US, demand for labor is meaningfully exceeding supply, and that is what's causing part of the increase in wages that we're starting to see now. We were actually starting to see some signs of this pre-pandemic, and we're certainly starting to see it continue to come through in some industries such as consumer staples, where last quarter, P&G reported a gross margin decline of about 400 basis points. And in the last 2 days, there's been a ton of talk and coverage about Walmart's earnings and how challenged they've been, both because of the pressure they're getting from their suppliers, but also the increasing inability to pass along those higher prices. And all of that colliding with this higher demand for labor, I think could cause us to be in a pretty challenging environment for some time. So what does this mean also for the growth versus value dynamic? This chart is looking at the, starting with the pre-financial crisis period from around March of 2007. There are 49 rolling 3-year periods from then until now. Growth outperformed value in large cap in 43 of those 49 periods. Now, as you can see on this chart, the magnitude of that outperformance has really been amplified in the last 5 years. So as I've mentioned a couple of times, I think, as we are looking at the propensity for higher interest rates, that means that we have to be looking at higher discount rates, which helps valuations of firms that have cash flows today or cash flows in the near term relative to companies that have to rely on cash flows that are well in the future. And so I think that when you add that to the onshoring that we've talked a little bit about in terms of deglobalization, the growing power of labor, and the rebuilding of infrastructure that is really only just beginning in this country, then that leaves us really wanting to own firms that are more traditionally considered value investments. Now at Diamond Hill, we are intrinsic value investors. We look at the cash flows of the businesses that we're thinking of investing in over very long periods of time, 5 to 10 years. And so I think that's important context because it is leading us to be more and more interested in looking at companies that are generating cash flows today and that can benefit from some of these underlying trends, specifically companies that are, kind of picks and shovels in the economy that are going to help rebuild our infrastructure, that are going to benefit from increased housing supply, things that we think are very, very long-term trends going on in the US in particular. Overall, too, from all of these things that I've just discussed, we basically expect that broad market returns will be a lot harder to come by going forward than they have been over the last 1 to 2 decades, depending on how you look at it. And we believe it'll be harder for growth to outperform value as well. So this chart is really just showing how important it is to be specific and be selective when choosing the investments that we're making. And this is a little bit of my why passive might not work so well going forward argument. So this essentially shows the Russell, I believe it's the Russell 1000, Russell 3000, sorry, and that approximately 40% of the companies in the Russell 3000 have negative net income. So if you think about, whether you're comfortable owning the index or a passive fund when you're making investments in the US market, it's important to consider that some of that is coming from companies that are actually not making any profit at all today. Now, part of the reason for this is also really important to understand as people who are looking at, cash flows of businesses that we're trying to make long-term investments in. And that is that because of the way accounting rules work in the US, as we're all very familiar, a lot of this is coming from an increase in intangible assets. So it's more important than ever to really understand the underlying cash flow generation ability of the businesses that we're owning. Then also, I wanted to make the point that if you are buying a market cap index, it is not nearly as diversified as it used to be. And so what you can see on here, essentially, I hope you can see it, it's kind of light, but essentially the green line, which is the one that goes up the highest, is showing that approximately 45% to 50% of the holdings in the Russell 1000 Growth Index are in 10 names, 10 companies. And so each of these lines shows the proportion of the index that is in the top 10 holdings. So for growth, for the Russell 1000 Growth, it's gotten to a proportion where essentially you're holding 5 names. I mean, you're holding 50% of your holdings are in 10 names, sorry. And that the blue and black lines, which are a little bit closer together, are still actually showing a proportion in the 25 to 30% range, where 25 to 30% of your holdings in the Russell 1000 Core and Russell 1000 Value are in the top 10 names. To me, that's a reason why we really need to be aware of what we're owning when we're investing in an index. And I think in an environment like this, where you are overly placing bets on fewer and fewer names, it's really important to be active and to make active decisions about how we're investing. So let me turn a little bit now to the kind of client side of the discussion. What are the implications of all of this for the investment management industry? So on top of, active and intrinsic value becoming more and more important, I think it's going to be a challenging environment for absolute returns. On top of all of that, clients are demanding more from all of us as investment managers. There's more investment solutions than most clients know what to do with. We are a very oversupplied industry. And we've seen many areas of client demand, from new vehicles, everything from mutual funds to separate accounts, CITs models. Certainly the rise of direct indexing and fractional shares has made it a lot easier to provide separate accounts to clients at much smaller sizes. Blurring the lines between institutional and intermediary. This is something I'm sure many of you have felt or even benefited from or exploited in a number of ways. An increased demand for concentrated portfolios to balance with passive. For people who still want to get their beta exposure from passive, there's still an opportunity for active managers who run concentrated portfolios to provide that alpha exposure. Personalization, which kind of comes from that ability to provide separately managed accounts at much smaller sizes. And those are just a few things. And I did want to touch specifically on a few things that are on this slide. So First of all, ESG. Now, we had a great speaker earlier today talk a little bit about the landscape for ESG and what the SEC is doing around that. And I'm here to say that while we may or may not want to be incorporating ESG very explicitly in what any of us are doing, for us, 85% of the RFPs that we're receiving from clients today include some form of ESG questions. So the reality today is that we need to be able to answer our clients' questions. And ultimately, as long-term investors, we are considering ESG. How could we not? And I think most of us in this room can agree that it is not possible to make a 5 or 10-year investment without really understanding the implications for the companies that you're investing in terms of how environmental changes might impact them, what's going on in the social landscape, and how you expect that to change over that period. And of course, governance, which I think has been the most clearly embedded in the processes of everyone in this room for a very long time. So, we believe clients can and should ask for whatever evidence they need of these ESG considerations. And so personally, what we're doing is just documenting them a little bit more clearly. But I do not feel like we have changed one thing about our investment process. And I feel like, that is true for a number of people in this room. And part of this, I think, really is about meeting our clients where they are in terms of being able to explain how what we're doing intersects with what they're looking for. Now, I think the hardest thing about this topic, ultimately, is that if you are an intrinsic value investor and you're considering environmental, social, and governance considerations as a long-term investor, that's great. But do you think that you are actually going to change outcomes with regard to, saving the environment, changing the outcome of climate by adding disclosures or telling our clients how we're thinking about these things? That's probably not going to lead to change. And so I do think we need to be really direct where we think we can have impact and where we frankly cannot. And so ultimately, I think there's potential in the future to really think about proactive opportunities for making investments in things like sustainable fishing, marine transportation, areas of the environment and the economy that we actually think can financially change and benefit from some of the trends that are going on in the ESG space. Ultimately, I think the best thing we can do is be completely transparent with our clients about what we're doing today and how that has an impact on their portfolios. So the second topic on this slide, so just to give you a little overview of the other couple things I want to touch on, diversity as a business imperative. Now, some people consider this part of ESG. I kind of pull it out separate, and I want to talk about that for a second. And then I'll also touch on hybrid working, which is, I think, a very interesting topic that we're all grappling with as business leaders today. And then finally, just a little bit on technology. So I think the business case for diversity is as strong as it's ever been. There's some really great research that McKinsey has put out over the last several years. This slide goes through some of that data, which is essentially showing that companies that are run by diverse teams have better outcomes over very long periods of time. They've looked at this data over different periods of time. Essentially, companies in the top quartile of gender diversity on executive teams were 25% more likely to experience above average profitability than their peer companies in the fourth quartile on that same metric. And the reality today, too, is that in the US and the UK, 20% of executive teams meet the definition that McKinsey used of gender diversity. And only 13% of them met the definition of racial and ethnic diversity. So it's not easy to find companies that can outperform on this basis. And while those numbers seem very low, if you think about the world being 50% female, that only 20% of management teams are run by gender diverse groups, that was actually 14% in 2014. So we have seen some meaningful improvement and change in these numbers. And the reason why I think there's a lot of support for this, you could argue this data is completely correlation. There's no causation here, right? It's very, very hard to prove causation on something like this. But ultimately, the thing I've found most compelling when it comes to causation on this topic is some work that has been done by University of Michigan professor Scott Page. And hopefully I can say University of Michigan here a little easier than in Columbus. And so Scott Page has published a couple of books on the importance of cognitive diversity, and that what we're all really after are teams and groups of people that think about decision making with very different perspectives. It's not about whether we have men and women or people of different skin color or different ethnic backgrounds. It's actually because all those differences bring different ways of thinking about problem solving and different ways of approaching the topic of whatever challenge or innovation we're trying to solve for or create. And so I do think that is the fundamental underpinning for why this topic is so important. And I call it out as something separate from ESG because I think it's something as an investment management industry that we can change and that we can do better. And I think we can serve our clients better if we do this better as well. So hybrid workforce, I want to talk a little bit about. I was recently at the CFA Society of Dayton talking about this kind of similar presentation, and I was really excited to talk about the market dynamic, and this was like a month ago, so it was even before some of the really obvious changes in valuation have transpired over the last month, and everyone just wanted to talk about hybrid work. And so I did want to just touch on it briefly to say that getting the question of how much should we require our employees to be in person versus how much should we be comfortable with people working remotely, getting that right is critically important in our industry because we are all in a people business. We're here working with each other, and that's all we have, right? Our assets walk out the door at the end of every day, if they even came in the door in the first place, which is the big question. So there is this study that came out of Stanford that I found some really interesting data points from. And what this slide shows is that essentially, on balance, male or female, employees would like to work from home approximately 2 days per week. And employers would like to honor that request about 1 day per week. So it's just something to think about in terms of, how far away you might feel from where your employees want to be in terms of, time in the office. I personally think time in the office matters if you use it intentionally. And I specifically think that is about making sure time in the office is spent with each other and on topics where innovation and collaboration are required. If we bring our people to the office and they're Zooming with the colleagues who chose not to come in that day, that's never going to work. And then no one understands why they had to come to the office. So I do think this is something that requires a lot of thought and intentionality. And the final thing I'll say is I read a really interesting book on this topic by Keith Ferrazzi and Kian Gohar, who their book is called Competing in the New World of Work. And they essentially said, rather than defining hybrid work in terms of the physical distance of whether someone comes to the office, how about if we think about it in terms of strategic, operational, and affinity difference? And those first two really refer to how close or how aligned are your teams with what you're trying to achieve? How much do people really buy into your strategy and your operational plan for getting there? And affinity is really, do you have the culture to withstand remote work? And if you do, be able to take advantage of that as a competitive advantage. So anyway, I won't go on about this topic anymore, but I do think it's a super interesting one that really behooves us all to get right. So the final slide really is just on how technology is upending our industry. And I think we all are very aware of this. I'll just mention briefly that, certainly I think in terms of making sure that we are using data and the tools available to us to make sure that we're communicating effectively with each other, with our clients in a way that is personal and that really reflects that we have a lot of data on each other that we can use to make sure that we're talking about the things that we're each interested in is a really key kind of fundamental requirement in our industry today. But technology is changing so many parts of our industry from operations to front office, investment processes, incorporating AI, that I just didn't think we could talk about the future of our industry without at least touching on technology. But I know I'm running a little bit over, so I'm just going to leave it at that and open it up to a couple questions so we can talk about this further if that's where the questions lie.
Oh, I know we got some questions. Come on now. There we go. Yep.
Hi, thank you for your comments. I was wondering if you can dig a little further into you said the hybrid and remote work environment is increasing diversity. Do you have any sort of levels on that? Is it younger people, older people? And what are you seeing within that trend, I guess? I'm curious.
Yeah, so essentially, I mean, that study from Stanford, which is where the data in those slides came from, is that, first of all, part of that study that I didn't even put up here is that in financial services in particular, that people value the opportunity to make the choice of whether they work from home or come to the office more than a 10% pay rise. So it's the second most high industry in terms of really valuing that opportunity to make the choice of working from home. When it comes to the topic of diversity, essentially what that slide showed is, and I think I can maybe even go back to it, is that there are some differences between how much men versus women would prefer to work from home, but there's not a lot of difference that employers want less working from home than employees want. And then also you can see on the right of this that the desire for flexibility is extremely high among different racial and ethnic populations. And the reason why I think that's important is because as an industry, we are really trying to attract and retain a very diverse workforce that is something that I think we were trying to put a focus on as an industry that we haven't historically. So understanding the importance of the opportunity to make the choice of working from home, I think is really important. And this isn't about people wanting to work remotely permanently. It really is about that flexibility and the opportunity to kind of build that hybrid workspace. Thanks.
Thank you. Any more questions?
Here's one.
Okay. Get over to you.
Yeah, I just had a question about how you're thinking about ESG for, you said 85% of your clients are inquiring about it in RFPs. Are you trying to structure their considerations, how they look at their own specific ESG considerations and tailor investments to that? Just because I know, especially with the E&S part, if you ask 10 different people, they'll have 10 different opinions on that. So how do you get around that?
So essentially what we do is we are just documenting where we think an environmental, social, or governance consideration has factored into our valuation. But if it doesn't factor into our valuation of a business, then we're not explicitly considering it. And we do not make value judgments because it's just not part of what we do. You know, we are investing for a broad group in one strategy, right? I mean, we have multiple strategies, but whenever we're talking to someone, to a potential client, it's not for a custom strategy. It's for a strategy that already exists. And so we do provide some opportunities for customization in separately managed accounts for institutions. But you know, if we're talking about a mutual fund, if there's tobacco in the fund, then everybody owns the tobacco company and it can't be excluded, right? It's physically impossible. So point being, I think, you know, ultimately what we're trying to do is say, here's what we've taken into consideration and why. And that does not include value judgments. It's just simply where we believe that things are changing materially in environmental, social, or governance considerations, or that they could change materially, that it's affecting our valuations. Thank you for asking.
Big round of applause for Heather, everybody. Thank you, Heather. And we are ready to continue now with kicking off our Hoosier Hub Series Forum sessions, session number 8. If we all could grab our seat, please. Session 8. Making Indiana and India America's Economic Engines. As we find our seats here, at this time, allow me to introduce to you Brad Chambers, the Secretary of Commerce for the state of Indiana and CEO of the Indiana Economic Development Corporation, and Scarlett Andrews, the Director of the Department of Metropolitan Development. Brad and Scarlett will be discussing how Indiana and Indianapolis are the engines driving the national economy. Let's give them both a big round of applause. Oh, come on, we can do better than that. Come on.
Thank you.
And thank you, Secretary Chambers, for being here. We know each other, and our staffs work very closely together at IEDC and at DMD. But I think this is a great opportunity for us to get to know each other a little bit better, learn more about what IEDC in particular is working on and some of your goals and economic development in Indianapolis and Indiana. So I'm just going to kick it off with some questions. In your time in the role, Secretary Chambers, so far, what would you say has been your major push and what are you most excited for?
Want me to do this or if there's a...
Jim, I'm sorry.
Yeah, that's fine.
No, it's right behind you. It's right behind you.
It is?
It's right behind you. All right, perfect. Thank you.
Still getting used to the public-facing aspects of this job. Well, thanks for being here and your interest in Indiana. And it's what a beautiful, bright, sunny day to kick off the month of May here in iconic Indiana way. The governor asked me if I'd serve in the capacity of Secretary of Commerce last year, and he and I had a vision reconciliation process that was really robust. And I'm an active business owner and have been for almost 4 decades in Indianapolis, and growing companies, investing dollars, and getting a return on that. And that's the approach that I wanted to bring to this job, and I wanted to make sure that the governor and I were aligned on that, and we were and are. And so my approach to economic development in Indiana, to running the state's economy, has been that approach, a business approach, an investment approach. And it's been a really interesting 10 months on the job. And so what I wanted to do is 2 things when I showed up. One, I wanted to show up with a vision and a plan. It didn't have to be perfect, but it just had to be a plan. It had to be a destination that we all could strive for and target. And then I wanted people to have fun in the office. I wanted them to buy into the mission, buy into the vision, and have fun in an aspirational way. And there's a lot of momentum, a lot of tailwinds at the state right now, and I think people are having fun. So I'm pleased with that. And then we established a 5E mission and vision for the state, and that vision was the built environment. Our first E is the built environment. And I think people ask me, what do you do as Secretary of Commerce? And I think one of the most important jobs, and people don't really think of it this way, is population growth and workforce growth. In today's climate, adding people to your state and workforce to your state is critically important resource. And then our second E is building an economy of the future. Our third E is entrepreneurship. Our fourth E is navigating the energy transition. And our fifth E is external engagement, telling the Indiana story. So starting, long answer to a short question, sorry. But establishing that vision was really important in a roadmap.
And in thinking about that vision and how your interaction is with companies and investors, those are excited about Indiana, what message does the state government, IEDC in particular, have for those who are already in Indianapolis or looking to relocate to Indianapolis, especially those companies?
Yeah, we're blessed with a state that's always had excellent fiscal management, right? Since 2005, when Mitch Daniels was our governor. And that's been a consistent theme. So I think everybody nationally and certainly in the state and locally know and understand and trust that Indiana is well managed fiscally. And then so that's kind of a fundamental aspect of our ability to convince people to either expand or invest in our state. But we're taking it in a different direction in really treating our incentives as investments in companies. We're looking at return on investment. You guys should appreciate this because you do it every day. And I use the analogy in some of my presentations that Indiana's 401k, right? We all have 401ks, and we have fixed income component to that 401k, and we have our equities and our higher yielding private equity investments. Our economy is the same way. Our fixed income in our state portfolio is our advanced manufacturing sector, and our equities and our private equity is our higher growth contributions to our state's GDP. So, I looked at our state's GDP over a 30, 40-year period when I started, and said, what do we need to do so that GDP can be at or equal to, if not grow faster than U.S. GDP, so we're not falling behind as a state. And we're going through a process of identifying those industries to add more equities, to add more private equity, to complement our advanced manufacturing base and to grow our economy faster so that we can be equal to or better than U.S. GDP on going forward basis. So we're having a lot of success with that, and that roadmap is really working right now. But that's the way we're looking at how to grow our economy. And so that's where our focus is as it relates to recruiting businesses and stimulating other local businesses, innovation, entrepreneurship, higher growth industries.
And when we think about companies, my department of metropolitan development at the city of Indianapolis often works with yours in the work of incentives, of tax incentives, in terms of attracting, retaining, and expanding businesses and companies here in Indiana and Indianapolis. I wonder if you could talk a little bit about the role of incentives and how that works with attracting companies.
Yeah, great question. And as I started, population growth and workforce growth is really important, and the community's role in stimulating that is super important. The State's Ready program is an investment in that first E, and that investment in the built environment. And what the cities are doing, statewide, especially Indianapolis. Indianapolis is a critically important asset to the state generally, in how they treat the customer, right? The growing businesses, what tools they use. Whether it's TIF or other tools at the municipal, local level, and then the statewide tools. And we've revamped our toolkit to be more nimble, really, to not be so programmatic in the way we invest in companies, whether you're a small company or you're a large company, to just be more custom in our approach. So and it seems to be working. It seems to be well received. We've added a couple new tools called the Innovation Development District, which is more of a transformational tool for larger billion-dollar up projects. But really just customizing the tools, being a little bit more nimble, and treating them as investments and working very closely with the locals.
And can you comment on the strengths that Indiana has already that has enabled our past economic success and what we're going to continue to do to build the economy of the future?
Right. 10 months in, I'm just super bullish on Indiana. I got to be honest. I didn't, coming in from an outside industry, and I'm drinking the Kool-Aid. I got to be honest with you guys. Fiscally, we're super well run. We've got great places in the state. We've got population growth that beats our peer states. We've got in-migration numbers that are moving up. COVID was helpful to the Midwest. COVID was helpful to states like Indiana that have a really good product for people to raise a family, to grow a business, or grow a business and raise a family. So our population growth numbers, and then the state's leaning into that by $500 million investment in Ready that's going to be spread through all communities in town, 17 regional areas. The governor's leaning into broadband investments. We've got record investment in roads and transportation and parks and green spaces. So, there's records being beat everywhere from an infrastructure perspective. So we're fiscally well run. We're a low tax environment. We've got great quality of life attributes. We're affordable for people. We've got incredible highways and roads infrastructure. Investments in broadband, and then a $500 million investment in communities that leverages to $10 billion, and another $500 million, my guess is it's going to come next year. So that's a lot of momentum on a statewide basis. And then businesses are growing. This is a double-edged sword, but 2.2% unemployment in the state. Workforce and unemployment is the biggest challenge on a national basis. I want to lean into the universities, the innovation coming out of our universities, Purdue, IU, Notre Dame, Rose-Hulman. We've got incredible universities. So there's just a ton going on, and it's all good. It's really exciting.
And are there obstacles that Indiana has, just thinking about our strengths and looking into the futures? What obstacles do we have in terms of being more competitive, and what do we need to do to differentiate ourselves from other states and other places?
Right. any good business, I say, is always got opportunities for improvement. CEOs and the business owners in the crowd, it's more important to focus on the areas where you need to improve, so you can improve those in time before they become a real problem for your business or your enterprise. A state's no different. A city's no different, right? I know you deal with the problems, and we all deal with the problems. And there's always going to be problems. But so addressing, education is an issue. It's not impacting our economic performance right now. So we have time. It doesn't mean we should sit back and not deal with it. We need to deal with it. We need to make sure that we articulate properly the value of education in Indiana. We as a state need to continue to incent and encourage higher wage jobs so we can lift up all Hoosiers from an income perspective. That is something that's near and dear to my heart and a focus. So the wages that we are working on in 2022, and I'll just give you a little statistic, are about 20 to 25% higher than the wages last year. So it's a living wage. These are really good wages, so people can, raise a family and have a house and put their kids through school. So really focusing on quality over quantity of industry and quality over quantity of business is super important. Just as a few things. But so yeah, there's always things to work on. Education is one of those. Keeping our costs down. Maybe telling the Indiana story a little bit better too. We're very humble, and there's a lot to talk about. We should be proud of it. We should brag a little bit as a state, not be humble Hoosiers, but be proud Hoosiers.
I definitely agree with that part.
Yeah.
Well, in thinking about the industries that we know that we're leading in, you think about life sciences, automotive manufacturing, ag tech. We've always excelled in these, and we're seeing that too. Those are the industries that the Department of Metropolitan Development is targeting when we're looking at trying to attract companies. And we also went through this process of looking at inclusive growth, which really meant incentivizing companies that were offering higher wages. Yeah. But now we're seeing that our floor of $18 per hour is really probably needs to go up in terms of being competitive and offering those living wages for people. But in thinking about those industries that I mentioned and that we excel at, are there others that we need to be thinking about, especially as they relate to your 5Es?
Well, I'm going to change that to 7Es come July, and I'm going to add equity and education as our other 2Es, because those are super important to the first 5Es. But we're going through a formal analysis. It's called a company's technonomy out of Ohio that's helping us with our Economy of the Future study. And what are those industries that can leverage existing Indiana infrastructure and expertise, but add that growth that we talked about earlier? Ag tech is a super interesting space for us. We've got a global leader in Elanco. They are creating the epicenter of animal health here. We've got Corteva Global Headquarters that just announced their global headquarters here. We've got Beck Seeds. We've got a ton of innovation happening in agriculture and the crossroads of technology. The governor and I were in Israel a month ago, and we had an ag tech roundtable. And the thing that's so interesting about Israel is they innovate and they create at a very young age, the early seed stage. But it's hard for them to commercialize and grow those businesses in the Middle East. So we left Israel with 4 ag tech businesses that are super interesting, really interested in working in Indiana to scale and grow and commercialize their business. So Indiana's got a real advantage in ag tech. I think we've got a role to play in microelectronics, semiconductor manufacturing. We've got one of the best schools in the country for semiconductor education is Purdue. We've got Crane Naval Warfare Center, one of the biggest consumers of semiconductors in the country. And we've got 5 OEMs, 5 auto manufacturers in the state of Indiana that are consumers of chips. So I think the state has got a role to play in semiconductors too. That's a new industry that we really haven't fully developed. And then lastly, I think we should be a leader in the sustainable development and manufacturing of sustainability products and be a leader in the energy transition. Not many know that Indiana has reduced its its consumption of fossil fuel from in the 70s down to under 50%. And we're right now, our coal consumption is about 47%. And we're the fourth biggest state in the country for the development and construction of clean energy. So we've got more solar and wind in development than most other states, number 4 in the country. No one knows that. So we're really leaning into the energy transition. I think we should be a leader not only in that, but also in the production, manufacturing of solar panels and other goods and services that are completely complementary to our advanced manufacturing DNA.
And how can local institutions, companies, investors help Indiana continue to nurture an environment that proves to the rest of the world that Indiana can be the right choice to grow their business?
Yeah, it comes back to that external engagement. I mean, we have tons of assets on our balance sheet, right? Assets of quality of life, assets of low cost of living, assets of an entrepreneurial ecosystem that's good. We have, we have entrepreneurial municipalities. We just have so many assets on our balance sheet. We really need to tell the story better and louder globally. And that's part of the reason we travel. I mean, I got to be honest, I was a little skeptical on the travel aspect of Secretary of Commerce job, but I am now convinced that the engagement that we in the return on that investment is real. Telling the Indiana story, engaging with people. We were in Slovakia 6 weeks ago. And since then we're having really meaningful conversations with a large manufacturer about relocating from Eastern Europe to Indiana. So I think the one thing we can do is speak differently about our state. Our state has tons of assets. We've got a lot going on for ourselves. We need to walk with a little bit of swagger, and I think that would help, to be honest with you.
Well, I'll get hyper local for a second in thinking about Indianapolis, because my day to day is Indianapolis. And as an entrepreneur and business owner that started in Indianapolis, I'm wondering if you could speak a little bit about how our city is competitive and what role it plays as the center of economic development for the state.
Well, it clearly is. It's super important as the heartbeat of the state from an economic development perspective, from a culture perspective. It's centrally located. We've got, literally the best airport and transportation system, I think, certainly in the Midwest, if not the country. I mean, our FedEx hub is one of the best in the world. Our airport is the best in the world, as ranked 10 years in a row. Again, the state attributes. But the city of Indianapolis is super important. It provides a cultural hub. And so we need to grow and protect that, right? And it needs to grow and lean into the tailwinds that we have right now, and lean into the higher wage jobs, the technology jobs, and really the culture of entrepreneurship that is thriving in Indianapolis. It's an asset on our balance sheet. But Indianapolis is critically important to our growth, and so at the state, we're here as your partner to help support that, and I think we're trying to do that. The arts component, the entertainment component are super important. Obviously, the tools that we have to incent and invest in businesses to grow are available and important as well.
And do you want to talk just a little bit more about the two additional E's, equity and education?
Sure. Touch on it a little bit, but the ability for everybody to rise up, for everybody to earn higher wages, everybody to have opportunity to start businesses is super important. We just had an Entrepreneur of the Year for the state of Indiana. Dante Williams, I believe is his name, and he started his business. And he came from an underprivileged background and economically disadvantaged, and that guy worked hard, and he came into the state and he got an SBDC loan to help him with his business, and now that business is thriving, and he's Entrepreneur of the Year, and to see how that's changed his trajectory and his family's trajectory is critically important. So it's important for us, I think all of us, city, state, and all cities and towns throughout the state, is to make sure that the playing field is level and the resources are abundantly advertised, so that everybody knows that we The state of Indiana is a place where everybody can climb the ladder. And so I think equity is really important. And then education, we touched on it. In some ways, there's math behind if you get an extra year of education, or 2 years or 3 years or 4 years of education, that your income can go up. And so we just need to drive that home and make sure that education is available and accessible and people know about it. We have a 21st Century Scholars Program in the state of Indiana. It's one of the best infrastructure to get your college paid for if you meet certain thresholds of economic privilege or lack of privilege. And we need to make sure that people are taking advantage of that. It's important that our population, our citizens, understand they can get an education in Indiana, and that education will pay them back over a career. So equity and education really are fundamental to the other 5 E's.
And finally, I just want to ask, how can we be better local partners, or how can we work together better with IEDC?
I think communication, and we probably we're all busy. You guys are running the biggest city in the state, and you're busy, and you're developing your downtown and your neighborhoods, and you're doing great things. And we're off doing what we do at the state. But I think community, whether it's in an organization like the IEDC or it's one of the businesses out here, when you increase communication, you increase output. And I think communication is fundamentally important to how we all can work closer together. I'll say a shout out to the IEDC team as well. I started 10 months ago. They looked at me like, who is this guy and what's he know or doesn't know? And it was in 10 months later, we all we're aligned and we're excited about the things that are brewing at the state level, which is going to lift up all communities throughout Indiana. A lot of tailwinds, a lot of interesting and good news that should be coming out in the next 2 to 4 weeks at the state level. So we've got a great team at the IDC. You've got a great team at the city. We need to make sure those two great teams work well together, because when we do that, all of our citizens are going to benefit. So it's pretty exciting.
Well, anything else you'd like to share?
No, thank you for being here, and thanks for all you guys are doing. I love the old Mitch Daniels statement. Someone asked him, he said, Governor, when he was governor, what can we do? What can we do to help? Thanks for all you're doing. Well, what can we do to help? And his response is perfect. As a business owner, he said, go make a profit, right? And he goes, because if you make a profit, you're going to hire more people because your business is doing well. When you hire more people, they're going to buy another house. And when they buy another house, then they're going to put their kids through school. So to the business community and to all you guys doing what you're doing, do what you're doing. And in my entrepreneurial career, people would say to me, hey, thanks for hiring that guy, or thanks for doing what you're doing. I never gave that any credence. I never put any weight on that. But be honest with you, running a business, being a good CFA, doing what you guys doing, making a profit is super important. It's fundamental to our economy and our quality of life here in Indiana. So that's an old Mitch Daniels, oldie but goodie. But that's what I would say, is just go do what you're doing. Tell the story, too, to everybody who'll listen about the cool things that are going on in Indiana. Hopefully we can spend a little bit more effort on telling that Indiana story through a marketing spend, and we're working on that, too. But it's good stuff. What the momentum you have. It's been a tough 3 years for all of us, right? But, man, I'm pretty excited about where we're at and where we're going, so.
Well, thank you, Secretary Chambers, again for being here.
Scarlett, thank you. I appreciate it.
Thank you, guys. We can take one or two questions. We do have time for one or two questions. Any questions for Brad at all? Or if we don't, we're all good. But yes, ma'am. We got one question back here.
Hi. Oh, good.
I was just wondering, with all the shifting around of manufacturing from Asia and whatnot, and the trends toward onshoring, are there specific places you're targeting to bring business to the Midwest and to Indiana, obviously, specifically?
Yeah, great question. Just had just had an interesting conversation about supply chain in the life sciences business. So I think there's a big opportunity in life sciences for supply chain onshoring, like a real big opportunity. There is an onshoring, as you guys know, just reading the paper in the Wall Street Journal, there's a big onshoring opportunity in microelectronics. Just Intel obviously announced in Columbus, Ohio, which is a good thing for the Midwest because it validates that the Midwest is a place of value. But there's a huge supply chain opportunity in microelectronics from that. So I'll give you a couple of tidbits that I didn't talk about that are similar. There's some Wall Street Journal analysts and other Wall Street analysts that are calling the Midwest the newest emerging market. How about that? Which, as those of us who've been toiling away in the Midwest for 30 years, we kind of knew it, right? I mean, returns in the business we generate are good, blah, blah, blah. But so apparently everybody else is figuring that out, which is a good thing. So the newest emerging market. And then when I started, I called all this, probably a dozen secretaries of commerce throughout the country, and I said, what are you seeing? I need to get educated. I'm new to this. And they said there's going to be $50 to $100 billion of economic investment floating around the United States in the next couple of years. $50 to $100 billion of capital investment going to be floating around the United States in the next couple of years. And Indiana in the eastern part of the country has better than a fair shot at landing that for a lot of different reasons. One, we make things in this state. Governor probably alluded to that. It's our DNA. We make things. Our cost infrastructure is right. Our resources is good. Water, power, labor. And so, in a labor-constrained market, we're still growing our population, and it's one of our highest priorities, if not our highest priority. So the opportunity, back to your question, long answer to a short question, but we see opportunity in onshoring of supply chain in 2 or 3 different industries. Those are just 2 of them, and kind of gives you a high-level anecdote of what we're hearing nationally. I don't know that you want to go to Texas and build an electricity intensive business right now. And I like Texas, but they've got an unstable grid in some respects. Or go to California if you need a water-dependent industry. So we've got real advantages in natural resources, and the most important natural resource we have is our people. And we continue to develop and cultivate that. So sorry for the long answer.
Okay. And I've got one final question, Brad. The governor kind of threw you under the bus earlier that you would elaborate a little bit on the economic summit coming up the next couple of weeks. Hoping you could kind of just expand upon that and just kind of talk us through what that looks like.
Yeah, thanks for that. I'm glad you mentioned that. So started last July. The team came in, a month in and said, hey, Secretary Shelner had a plan for an economic summit, a global summit, to invite people from all over the world to come to Indiana and have a conversation around important conversations, sustainability, workforce of tomorrow, vehicles of tomorrow, autonomous transportation, just really interesting in thought-provoking conversations about the future and the challenges of today. And so I said, okay, when is it? They said February. I said, no, we're not doing it in February in Indiana, sorry. Let's do it around the race. And we did. But this summit, and I was, I'm kind of skeptical, and, but I will tell you, it is incredibly well received. We have got 29 or 30 countries attending, and a lot of them at the ambassador level. So that is a higher level foreign dignitary coming to our state, 28, 29, or 30. So a lot of those are ambassadors. So we've got big international delegations. We thought we'd have 350 or 400. We had to close our registration at 800. It's at the convention center. The programming is Thursday and Friday, and you've got Roger Penske, you've got Eric Schmidt, former chairman of Google. coming in. You've got the CEO of Shell and the CEO of NTT. You've got we got the president of Saab and the president of Rolls-Royce. So we've got someone coming from Amazon and high-level folks from Microsoft. So we've got real interesting, thoughtful, on the leading edge of innovation, on the leading edge of technology, folks coming in to have conversations, as well as our pretty highly regarded local CEOs, Dave Ricks and Tom Linebarger from Cummins. So we have programming Thursday and Friday. I'm just super excited that we're going to be able to show off our city, show off our state to a global audience. We hope to knock it out of the park, and then they get to get treated at the race. But we hope to have these really good, thoughtful conversations. Let our universities take a hold of that. We're participating with Purdue and IU and Notre Dame and others, and then do this every couple of years. I don't know. I want to call it the Davos of the Midwest or what, but the Aspen Institute. But it's been really well received. So thanks for tipping me on that. I would have not brought that up, but I am really excited about the response we're getting to Indiana, and that's another reason why we need to be proud.
That's great. That's awesome. You got passes for everybody to go to next week, right?
I do. Okay. It'll be 800 going to 900 or 1100 or 1,000.
That's right. Big round of applause here for Brad and Scarlett. Thank you guys so much. Thank you. Thank you. All right, moving on now to session number 9, Venture Investing in Indiana, Driving Innovation. Eric Tobias, partner at High Alpha, Jim Bergstrom, CFA, co-CIO at IU Foundation. Eric Tobias, of course, IU grad, renowned venture investor and co-founder of High Alpha. Going back a decade, was the founder of iGo Digital, which was acquired, of course, by ExactTarget in 2012, which we all now know was acquired by Salesforce in 2013. Now he's helping other investors plot the same course. And Jim Bergstrom, IU grad as well, Chief Investment Officer of the IU Foundation, a former president of CFA Society, Indianapolis, a decade ago, 2012 through 2013. Let's give a big round of applause for Eric and Jim.
Great, thank you. And for me, it's a real personal privilege to be up here for this event. I actually planned or led the planning of the 2012 event, which was a half-day forum, which many of my board members thought we were crazy for trying at the time. It's just really gratifying to see it grow to a full-day event this year and hope to see it continue to grow in the future. Anthony mentioned Eric's background. I want to give a little bit more about Eric. He's a fascinating person, one of my favorite people to connect with in town. As Anthony mentioned, he founded and led 3 companies to successful exits to public companies. And then he became VP of product at Salesforce. But Eric, if you know him, is an entrepreneur at heart and yearned to build something even bigger and better. And so in 2015, he co-founded High Alpha with 3 partners. And High Alpha is the first venture studio in the industry. It's actually since been replicated elsewhere by other firms in other cities. But we in Indianapolis should be proud that High Alpha was a real innovator in this space, conceived of the concept and launched it, proof of concept, and it's really one of the growth engines of Indianapolis at this point. He has too many accolades to list out. You can read them in his bio. But another personal note, he loves music. He's a co-owner of The Vogue in Broad Ripple. And it's really cool for me when you see somebody's personal interest intersect with their professional life. And that happened with Eric a couple of years ago. During the pandemic, he knew as well as anybody that live concert venues were hurting. And that artists really needed a way to get their music out to their fans. And so one of the companies that High Alpha conceived of and launched and is one of Indianapolis's real growing success stories is called Mandolin. It's one of my favorite applications. Hopefully we'll get a chance to dive into that a little bit later. And if you're wondering why I'm up here on stage, it's because IU Foundation's proud to be one of High Alpha's anchor investors. So we've had a great partnership with them.
Thank you, Jim.
So with that, I'd love to hear just straight from you High Alpha's origin story. Go back to 2015 and walk everybody through how it got started. And
yeah, thanks for having me, first off. Awesome to be here with you all today. So High Alpha was started really over probably a 4 or 5 year period. I was running a company called iGo Digital, and we were growing very quickly, and had some friends that said, hey, I think we're going to start a venture fund. This was two of my now partners, Mike Fitzgerald and Christian Anderson. And Indiana really suffered at the time from a lack of access to capital for startups. It was challenging to go find places to get funding. And so the idea of this venture fund was that we would make very micro investments into companies, and we would do it kind of on nights and weekends. And we did that for a couple of years and made, 10 or 15 investments, and had a ton of fun and learned a lot, made a lot of mistakes, but it was working. And then Salesforce came along and bought ExactTarget, and you all have heard that story plenty of times. I don't need to share that again, but we wanted to get back to our entrepreneurial roots. We were really enjoying supporting entrepreneurs and helping them pass on some of the lessons that we had learned, and decided that would be a really fun thing to do as our full-time job. So the initial idea was that we were going to solely be a traditional venture capital firm, and then we couldn't let go of the fact that we were entrepreneurs at heart, and we loved to operate companies, and we had a lot of ideas. We had been running a business, and anytime you're running a business, I think you always come up with better ways that things can be done, or gosh, I wish that existed when it doesn't. And we had a lot of those too. So we came up with this idea that if we combined venture capital with a studio concept where we would come up with our own ideas, we would start our own businesses, and we would fund them through that venture capital, that we could create something really special. And we didn't know if that would work back in 2015, but you kind of fast forward 7 years, and we've been able to start about 30 companies from scratch, and have invested in another 40, so about 70 companies in our portfolio. And of those 30 companies we've started from scratch, we've hired probably about 1,100, 1,200 people. So really, really proud of the job creation and the fact that we're trying to create an engine of growth for the state and the city, and also having a ton of fun doing it. It's very hard being an entrepreneur, and so when you can pass on some of those learnings and provide support, not just capital, but real support to those entrepreneurs, it's really gratifying.
Yeah, that actually leads into my next question really well. In our venture capital portfolio, some of our best managers around the world have the same ethos that you guys have. So they used to be operators, entrepreneurs. They've been in the trenches. They know that it's hard, that there's plenty of ups and downs with building a company, and that as a venture capitalist, you're able to oftentimes be a life coach, a counselor, so much more than just providing the capital. You're an advice provider. You're the first text or call when they run into a big issue. So maybe talk about how your entrepreneurial spirit at High Alpha has helped you from a competitive advantage in terms of winning deals and just helping these companies along.
Yeah, it's a great question, and it's a timely question, because we've been in an environment for the last 10 years-ish where capital has been aplenty. That was not the case when I was starting and growing businesses, but it has been for the last 10 years. So when capital has been aplenty and you have options of who to get capital from, then the next question is, well, what else can they provide me? And I think that's been a real competitive advantage for us, to be able to have empathy for what the entrepreneur or the co-founding team or the executive team is going through. We are often the first call. We want to be the first call. And part of our studio model is we are co-founding these companies, with the founders, with the CEOs, and that means we're locked in for the life of the company. People ask all the time, "Are you an incubator? Are you an accelerator? Are you?" Yes, we're all those things, but we're really a co-founder because we never go away. And I think that that spirit provides a lot of differentiation, and it also provides a lot of comfort to the CEO. It's a lonely existence at times, and so having some group of people, and it's not just the four of us who started High Alpha. We have 45 people on our staff that all in some form or fashion have been entrepreneurs and worked in startups, and so they understand what these teams are going through and trying to build.
Great. You referenced the studio side of the business where you're conceiving of and helping to launch these businesses. One of the unique things that you guys do is Sprint Week, where it's a super busy time at High Alpha, all hands on deck. You bring in outsiders. I'd love to have you maybe walk the crowd through a typical Sprint Week from beginning to end and sort of what gets born out of those weeks.
Yeah, I would encourage this process for any business, any organization. And we kind of stumbled upon it, but it is definitely part of our secret sauce. So 4 times a year, we shut down our operation. We don't have meetings. We don't take phone calls. We shut down. And we divide our company, which I mentioned is about 45 people, into 4 teams. So think of it as 10 or 11 people on a team. And each team takes a new idea. And at the start of the week, the idea is very raw. Let's take mandolin, the idea that Jim mentioned earlier. So back in March of 2020, the idea was, okay, the world has shut down. Artists, musicians cannot make a living. They can't reach their fans. How do we solve that? That was the problem that we started the week with. And 10 or 11 people went through an exploration of getting on the phone with artists, getting on the phone with managers, talking to agents, brainstorming about how we might solve that problem. And you kind of fast forward to Friday and out pops a business, literally. We had figured out artists need to live stream. They need to be able to do that from home. They need to be able to sell tickets just like they would to a concert. Okay, who are our first 4 or 5 customers going to be? We lined up those artists over that period of time. And the amazing thing about this process, we're all busy. Everyone's super busy. So it's easy to say, well, we're too busy to get to that. Or let's have a meeting and talk about it, and we get a little bit of it figured out, but not all of it. Well, we'll just pick it back up next week, right? Or we'll pick it back up tomorrow. And the great forcing function of Sprint Week is you start Monday with this problem, and you got to stand up and present a business on Friday. So there is no, we'll figure it out later. You got to figure it out. And it forces you to make decisions. It forces you to move with speed and conviction. And that's the process we've used to start 30 businesses.
Great. For a firm that's only 7 years old, you've had a number of success stories. I'd love for you to walk the audience through maybe one that has been exited already, and then maybe one that's still building and is one to watch in the coming years within Indianapolis.
Well, they're all kind of like kids. I love them all. So fun one to talk about that has exited would probably be a company called Lessonly. Lessonly was started actually prior to High Alpha. We started it back in 2012 or 2013, and really got it going. And then it was really the first company that we put into High Alpha, and it was led by a phenomenal entrepreneur named Max Yoder. And he had an incredible sidekick named Connor Burt, and the two of them built the company over the last 10 years. Very simple concept. The idea was that it used to be that we would all go to training. Could be about a system, could be about a process, but we all had training as part of our job. And it used to be that you would go to a room at a not so fancy hotel for a day, and you'd sit and listen to somebody train you all day, and then you'd go away and okay, that was training, and we'll do it again next year. The pace and speed at which we all operate now, it requires us to go through practice and learning all the time. So that shift in organizations created a need for a different type of software to support that. And Max and Connor created a company called Lessonly that solved that problem, but maybe more importantly, the culture that they built was incredible. I think at the end they had about 350 employees. They were working with organizations from all over the world, from folks like T-Mobile all the way down to mom and pops who are running businesses, and really just made a dramatic impact in the world through this vision of how to train employees in a different way. A company that I'm really excited about that we're currently working on that hasn't been announced yet is called Holder, and it is in the blockchain space. And for those of you who understand that world, great. I was not one of those people. It was not something that I was familiar with or really interested in. But this, I'll give you the short pitch. When you buy a digital asset, such as an NFT, might be familiar with that. You purchase that and store it in a wallet, and that wallet has no identifiable information. It's a big long string of characters, and that's one of the benefits of blockchain technology. Is it's impermeable and it kind of lives out in the ether. The downside is if you are that NFT seller and you hit a home run and you have hundreds or thousands of people buy your NFTs, now all of a sudden you want to market to them, you want to talk to them, they're your customers. And there is no technology that really facilitates that. So Holder is doing for NFTs and blockchain what ExactTarget and other marketing platforms did for digital communication. And really excited about that. I think that could be a very big business.
Terrific. You mentioned lessons learned and the fact that this is sometimes a tough business. I'd love for you to walk through maybe a few of the key learning opportunities you guys have had over the past seven years or so.
Yeah. I wish I could tell you all 30 of those businesses went like straight up and to the right. It doesn't always work that way. And I think there's been a lot of lessons about why. Much like all of your organizations and businesses, ours is one driven off of talent and the people that are inside the business and working on the idea. And in our case, we're matching an idea with a founder or a group of founders. So we're playing matchmaker, and the fit between the idea and the entrepreneur is super important. Getting the right group of early customers and early partners is also super important. I think another big thing that we've learned is timing is also really a critical part of what we do. You can be too early or you can be too late, and those that really hit it seem to time it. And that's a hard part of our business because we are not just an investor, we are a co-founder. And so when something isn't quite working, maybe a traditional investor would, kind of cut their loss and move on to the next thing. These are businesses that we started. We've made commitments to the entrepreneurs that we're in the boat with them, and so it is our responsibility to roll up our sleeves and figure it out. And I think managing that has been a fun challenge.
Sure. You mentioned blockchain. High Alpha's historically been very strong in B2B SaaS companies, just with the ExactTarget background and Salesforce being so strong in our city. What future growth areas are you most excited about, whether it's blockchain, climate tech, AI, machine learning? Maybe pick an area that you're exploring out of one of those and share some thoughts that you have about how you see that future unfolding.
Yeah, it's fun to go after Brad because he kind of riffed on three categories. One was ag tech, the other was sustainability, and the third, I'm blanking on the third. Those first two are very interesting to us. We are actively working on a couple of ideas in the ag tech space. Our focus is B2B software. Those are the companies that we create, and that's the expertise that we have. And we think we can apply that expertise into a lot of domains that we partner with other subject matter experts. We've made 2 investments in the sustainability world. One of them is a really interesting company out of Chicago called Reaply. They have about half their team here in Indiana, and it is repurposing office equipment. Large enterprises, think Lilly, they have office equipment all around the world, and yet their growth happens and their needs happen at different times in different places. So they might have 100 desks in Ireland, but they've just hired 100 people in Germany, rather than have those 100 desks in Ireland sit idle and have to order new ones and cause extra demand on the environment. The software helps identify that and move those logistically. Again, very important for a large enterprise with lots of assets on a global basis. So it's things like that we're thinking about. I was with a group about a month ago who is working on developing businesses in space. How to create a data center that resides literally in space, because one of the challenges of data centers are heating and cooling. Well, those issues don't exist, in the atmosphere. So it's an incredibly exciting time. There's a lot of innovation happening and a lot of new possibility.
Great. As everyone here is aware, obviously the Midwest has many tailwinds that we've been enjoying in recent years, and Brad talked about, from his perspective, some of why Indiana's benefited disproportionately. From your lens and from your leadership role within the venture capital community, what is it about Indianapolis and Indiana at large that you think are great strengths that have helped our technology community grow the way it has in recent years?
Yeah, I don't want to repeat what Brad said, because I think he got a lot of it right. People, cost of living, et cetera. What I would add is our ambition level has changed. When I've been a tech entrepreneur for, 25 years. And when I first started, people would say, "You're from Indiana? Why?" They didn't believe that a tech company could be built here. And then we went through a period where we were trying to kind of organize ourselves and really believe in ourselves. Now, I meet with people that are from here, grew up here, work here, and it's not, hey, someday I hope to start a business. It's, hey, someday I'm going to take this company public. Our ambition level has gone up because we have witnessed our neighbors and friends do it, and now we know it can be done here. And I think that's a huge shift, a positive shift. You heard, again, Brad spoke about this. We have a Midwestern humble, which is core to our DNA, but in some ways it holds us back. And I think we're beginning to see a positive shift to really truly believing that anything can be done in Indiana.
Great. As everybody's aware, the market environment has shifted over the past 6 months or so. It started in the public markets with high growth tech stocks tumbling. It's started to spill over a little bit into later stage private equity. I'd be curious how you see that market environment shift affecting your companies, the future opportunity set that you may see, and the types of conversations that you're having with CEOs today.
Yeah, it definitely is shifting. Great companies are built in up markets and down markets. Exact Target started in 2002, just after the dot-com crash of 2000, 2001. And I have that own experience from my background. I've started 2 of my companies kind of during a downturn. I think this is another area where Indiana has a real opportunity. The frothiness of the last 10 years, certainly we saw some of that, but not the full weight of it. And I think that will benefit us. I think great companies are going to continue to have plenty of opportunity to be funded and continue to grow. I think mediocre companies are going to have to work harder, and I think underperformers are really going to struggle, and that is how it should be. So I think that we're entering a period that will feel different. Our focus, our advice to our entrepreneurs is continue to build a great company. If you do that, everything else takes care of itself. I do think you are going to need to conserve cash, and I think you'll see hiring change. And in the tech business, that is going to be very interesting. It has definitely been an employee market. salaries and comp has been through the roof, especially over the last 2 or 3 years. So I think some of that will, maybe temper a bit. But I think access to capital is going to be very, very important, and those who have capital will be in a strategic position. And we're really excited about how we can help entrepreneurs through that.
Great. Over the course of your career, you mentioned seeing a significant mind shift in entrepreneurs in what they believe is possible. Maybe talk about how you've seen the interest of coastal capital, so coastal VC firms, growth equity firms, interested in companies based in places like Indiana. And then as you look to recruit world-class CEOs to run these companies that are coming out of the studio, how that interest level has changed over time in terms of trying to get a world-class founder to come relocate to Indiana to run a company that could become a multi-billion-dollar company.
Yeah, we're really fortunate at High Alpha. We have an amazing pool of investors, including IU. Thank you. Our lead investor on the studio side is a group called Emergence Capital out of San Francisco, and Foundry Group out of Boulder, Colorado. And both of those groups, I think, have been very vocal about wanting to partner with High Alpha, yes, because of our model, and yes, because of what we're doing, but also because of wanting access to the Midwest. The coastal firms are all going through a paradigm shift where values are just out of control, and they're looking for new deal flow. And that is a different scenario than we saw even 5 years ago. So I think that's going to continue. I think that's all very positive for Indiana. I think the appetite for entrepreneurs to build a great company with partners here in Indiana is also at an all-time high. Back to the ambition thing, and back to, we have proof points. We went through a very special time over the last 10 years where, in my business tech, where Exact Target, Aprimo, Angie's List, Interactive Intelligence, kind of on and on, where we had these huge winners, and that creates proof points. It creates experience. All those employees that went through that now have the entrepreneurial spirit and can kind of peel back out and create their own stories. So I think you're going to see a ripple effect for that for a long time. But we had an entrepreneur in last week who is currently running a very large portion of Zoom. And we all know Zoom because we've spent the last couple of years on it. And this individual is going to leave their job and come run a High Alpha company. Why would they do that? Well, they know how to scale because they've gone through that at Zoom. They don't necessarily know how to start. And by partnering with us, that gives them that ability. So I think you can, you can find the talent, and it's global now.
Great. I want to make sure we stay on schedule, and I'm sure there are questions in the audience. So I guess I'll turn it over to see if there's any questions.
I see there is a lot of things going on around the tech space. But is there anything happening in the life sciences from, like High Alpha Group, venture capital space?
Yeah, I think we do not do anything in the life sciences. Our focus is on B2B and particularly software. But there is a ton of initiative in the city and state around life sciences, and David Johnson and his group are doing a ton of work there. But that is not our focus. In the back.
In the last tech bubble, a company like Cisco fell pretty significantly because they were selling products to businesses that didn't have a sustainable business model, in particular the CLEX. What is the risk in this time around in venture capital that the revenues are coming from companies that are ultimately going to go bankrupt?
Good question. I think that depends on stage and scale. So young baby startups selling to other baby startups, I think you'll see some of history repeat, right? Those companies are going to struggle. There has been a change, though, in that many of the tech companies have achieved a scale where their customers are both similar tech companies, but also traditional enterprise. And those companies are going to weather the storm much, much better. So I don't think you're going to see a wipeout like we've seen in the past. I do think you're going to see a calibration. And it's really important when you're building a young company to think about the diversity of your customer base for situations like this. And some are better positioned than others, of course. The other big change that I think needs to be acknowledged is the role of tech in all of our lives is different today than it was in previous downturns. In previous downturns, especially maybe the first one, it was really a nice to have. It is now a need to have in all of our businesses and all of our personal lives. So I think we'll be much slower to give it up. Somebody's got to ask a question about music. We can't have a whole room here and somebody's got to ask something about music. Yes, ma'am. Thank you for asking. We bought the Vogue in 2019, and it's been amazing. The Vogue is an incredible kind of icon of Indianapolis. It's this beacon of Broad Ripple, kind of the central spot of Broad Ripple, and hopefully many of you have had a fun night, maybe in your youth or maybe recently. My favorite part is the diversity. On any given night, we'll have a bluegrass band to a R&B singer to a heavy metal to tonight there's a Christian rock band there. I mean, it's just all over the board. And so by the very nature of that, we attract different audiences, and we, certain people will walk out of there and be like, that was the best night I ever had. And that's really special to bring. And I think it has a direct connection to all the topics we're talking about today. People choose where they want to live, where they want to invest, where they want to spend their life based on the totality of the quality. And the work environment is part of that, but what you do in your free time and what you do for fun is also part of that. And we're trying to invest in a very small way in making sure that nightlife and the arts are a central part of what we're doing here in the city. We started a series at Holiday Park, which is on the north side, called Rock the Ruins, and it's an outdoor summer festival, and it's very much in this realm where it's designed for fans to come, but it's also designed for businesses to bring their employees and have outings, and that was especially important last summer when everybody was just getting back to doing stuff. So I think this is the role of business going forward. We have to think about how we engage the community and how we engage our employees and how we build things beyond just the business to impact the place that we operate.
Your team invests in founders when you're looking to seed a company. Can you talk about some of the traits that you look for when you're trying to find a visionary founder?
Yeah, we love somebody that has demonstrated action, somebody that has got something going or tried something and failed. Chip on the shoulder is something that we think is really important, something to prove. That can come from a lot of different places, but that creates drive and creates motivation. We look for somebody who is a great team builder, somebody who can bring others along on the journey with them. We look for somebody that is a very good storyteller, which is also a part of bringing people along on the vision, but it's also a big part of raising money. And software companies require a lot of capital to grow and scale. And then the last thing I would say is we look for an intangible that's really hard to quantify around just somebody that can make things happen that otherwise shouldn't happen. Startups are incredibly difficult. Most of them fail. And the reason for that is you have no momentum. All the inertia goes against you. And in the early days, you have to manufacture momentum. And sometimes that's getting a customer to say yes when they shouldn't. Sometimes that's getting an employee to join when they shouldn't. And a founder has to be able to evangelize that and get those things to come true until they just are true. And once the wheel is spinning, then it's a lot easier to scale it. But in the early days, you got to make it when it's not true.
All right, a big round of applause for Eric and Jim. Thank you guys so much. I gotta say this. This guy here knows how to fish as well. Went on a big fishing trip for my charity golf outing, and so he got it done. He was the winner on that. So thank you guys. Just want to mention real quick. I got to jump on television, so I'm going to introduce the next session. And then, unfortunately, I've got to get out of here to talk some racing today. But I got to say, as I said at the beginning of this day, I'm so used to doing emceeing events for sporting events with the Colts, the Pacers, you name it, IndyCar. And so today it was definitely a treat for me to be here because I learned a lot. And I'll be talking to my my money managers too about some things. But next up, here we go. Session number 10. ROI, optimization, education. Chris Lowry, Commissioner for Higher Education for State of Indiana, and Luke Zhang, Senior Data Scientist at Resultant. Chris, a former Chancellor from Ivy Tech and nationally recognized expert on education, workforce, and economic transformation. And my man, Luke, is a Rose-Hulman grad, Governor Holcomb's COVID data scientist, IBJ's 20 in their 20s. He's extremely talented. Please put your hands together for Chris Lowry and Luke Zhang.
Hello. Mic check. 1, 2. All right, we're on.
1, 2, we're on.
All right. Hello, everyone. Thank you for sticking around and listening to our talk. First of all, some of you might be thinking, why this young Asian kid up here? And I know we are the only reason between you and that beer in the track, so we'll make this short and make this interesting. I'll owe you guys an introduction. My name is Luke Zhang. I'm a senior data scientist at Resultant. For the past 2 years, I've been working along with Governor Holcomb, Dr. Box, Dr. Weaver on COVID. So I'm the evil reason why some of you guys have to wear a mask and then complain about the vaccines. So it's not me, it's the data. And then I'll let Commissioner introduce himself.
All right. Hey, Luke, thank you. It's fun to be on stage too with Luke. He is a genius at social media and has this data reputation that follows him. I don't know if you know him, but I know him from his colleagues at Resultant. And yeah, it's a pleasure to be here. Chris Lowry, I'm Commissioner of Higher Education in Indiana. I have been in this role for an entire month. So, I'm new to this role, but as was said during the introduction, I have a background for the last several years in higher education. But I was actually professionally raised at Hillenbrand down in Batesville, Indiana, where I was for about 20 years and got involved in public policy and a number of other things, and now here. So we're looking forward to this. You said keep it short and sweet, Luke. Higher education, great investment. We're going to talk to you about some of the ROI.
Yeah, sounds great. So ROI, return of investment. We're going to jump right in. Returns. Okay, I'm a data guy, so I'm going to throw some numbers at you guys. According to the U.S. Bureau of Labor Statistics, if you're a doctorate degree holder, when you graduate, you'll normally make $97,000. On average, in terms of salary. If you have a bachelor degree, you're going to make $67,000, in terms of salary. If you only have a high school degree, that money really goes down to only $37,000. And then if you don't even have a high school degree, unfortunately, your average is only going to be $30,000. So we see that huge gap in terms of salary, right? But also we hear on the media, on the news, where a lot of college students, when they graduate, they can't find a job. So as we know, Commissioner here did a wonderful job at Ivy Tech, did a lot of work as a counselor and also the chief workforce officer. So could you tell us a little bit about what you did there, what kind of work you did, and what kind of tricks you have under your sleeve, in your pocket now as a commissioner?
Sure. Thanks, Luke. I'll do that quickly, and then I want to pull the thread on some of the data. I'm a data guy, too. First night on the job, that was April 18th, I had just gotten a report from Indiana's Department of Workforce Development. And at 8 o'clock, I looked up and went, okay, I probably should leave because I was just kind of nerding out on some of the numbers. And I want to dig into those because they also reflect what Luke was talking about. Yeah, so in my former life, which was at Ivy Tech, as I said, I had left industry. I was recruited out of industry to go into higher ed, which was a really big move for me. I thought I would frankly retire from Hillenbrand. That's where most of my friends are. I live in Batesville, but I also live in Indianapolis, and thought that's where I would be. But I had been leading at Hillenbrand the workforce efforts for our company. We had split apart, and then we became acquisitive. And around 2010, we decided we knew there was this looming war for talent. And as our CEO said at the time, if there's a looming war, we win. And so we started putting together some pretty aggressive approaches with our local school corporations, which led me to Ivy Tech. And then in the last 5 years, I was asked to stand up and then lead the workforce side of the college. Yeah, a couple numbers. You like data, Luke? When I went into that role, the college had been producing graduates with credentials, and a lot of those sub-associate degrees, so technical in advanced manufacturing, IT, healthcare, logistics, ag bioscience, and so forth. We had been producing as a college for pretty steadily several years, roughly 20,000 graduates. And we decided that was completely insufficient to meet the labor market needs. We're still not meeting them. But when I just left a month ago, the most recent numbers, Ivy Tech now produces graduates at about 38,000 a year. And so, we move the needle pretty significantly. They need to move the needle even further. But a key to it is really understanding very crisply the needs of employers. Related to that, Luke, I think I told you it was a full day yesterday. They're usually full days. And, I think a part of the role that I have in working with our universities is really to listen to not only what employers need today, but trying to see around the corner and anticipate what they're needing. So yesterday included a meeting early in the day with Kevin Brinegar, who is president of the Indiana Chamber, and then a meeting with Dave Ricks, who is, as you all know, probably CEO of Eli Lilly, and wrapped up my day with chairman of the board at the Cook Group, Cook Medical in Bloomington over dinner. And it was really principally to talk with them about what they see on the horizon. We know that the labor market's tight, 2.2% here in Indiana, and similar across the nation. But we've got to solve for that equation, but we've also got to be solving for 5 and 10 years out.
That's wonderful to hear. So let's switch gear a little bit. We talked about the return. Let's talk about the investment. As we all know, especially the parents here, if you're paying for your kids' college tuition, kudos to you guys. College tuition has been crazy. I graduated from Rose-Hulman. Thankful for my parents that they covered everything. And I'm going to bash on my alma mater real quick. Rose-Hulman, as we know, is a great engineering school here in Indiana. It ranks really high nationally. But it's not that well known outside of Indiana. But we keep our tuition just like the Ivy Leagues. So right now, Rose-Hulman charge $81,000 a year for tuition. That's a brand new Tesla that I see. So as you guys see that, a lot of students, especially my friends out of college, they rack up the debt. Yet a lot of boot camps, I work in tech, a lot of boot camps have offered different ways that you can pay for the shorter period of the boot camp. Whether you don't have to pay them in the front and you pay them when you get a job, or they can be creative. Yet our colleges still follow the same method of, well, you got to figure out that tuition. Either you rack up the debt or your mom and dad going to be supportive. So what do you think that we can do as a state to help with that?
That's a great question, Luke. So I'm going to say several things about that. The return on investment is still absolutely there with higher education. And I'm going to use this example too. Subscribe to the Wall Street Journal, a lot of other publications. They have had some interesting profile articles, as Fortune and others have, about the extremes. And I think it's important to recognize the extremes and then also to bring it into context for Indiana. The way I've been putting it is that unicorn exists in Indiana. I'll give you 2 unicorns, okay? Go with me here. There is a barista somewhere in Indiana who has a master's degree in some weird subject from USC, and he owes $150,000. he's somewhere, right? I see a couple people smiling. Maybe, it's not like your kid or something. And there's also the millionaire next door, or if you're in Seattle, it's the billionaire next door who dropped out of college and so on and so on and so forth. So let's acknowledge they exist. Here's the deal. In Indiana, the average student who has debt is right around $30,000. That's, I don't know, roughly the price, I think, of a Kia or something like that. And you discussed, Luke, I think it's really interesting, the wage premium. For the high school diploma holder, the median wage in Indiana is $39,000. There is a 60% premium on that with a bachelor's degree or higher at mid $60,000. Here's the other thing, and I'm going to get around to a couple of the solutions too you're talking about, Luke. When you look at net worth, and I think that's really important. So I think out of the gates, we ought to look at what's the unemployment rate, what's labor participation, what are the wages, and what are net worth. Those are four pretty decent economic signals for the relevance of those degrees. And in the United States, for someone who has less than a high school diploma, let's just go high school diploma, it's right at $300,000, and it's $1.5 million for a bachelor's degree and higher. So the $30,000 debt, I don't want any student to have debt, and we've got to mitigate that as much as possible, but yet there is an investment aspect to this. So what's been going on? Mitch Daniels has, if any of you know Mitch, next time you see him, every time you see him, say, well done. They've held tuition and fees for 13 years. He and I met a couple of weeks ago, and but known each other a long time, but when we sat down to talk, I said, Mitch, I just need you to help everybody else see how to do this. Right, because their quality's improved, their prices have stayed level, which of course means they've actually declined, inflation adjusted. And they're a top 5 or 10 ranked university on the public side in the nation. Pretty good work. I'd say he gets A's on his report card. So, how can we help more do that? At Ivy Tech, where I just was for, a number of years, we held tuition for the last 2 years and instituted going forward for the next 2 years, not only doing that, but including all course material in it. Because, frankly, students who come from lower socioeconomic status, by the way, oftentimes never get their course materials. So we got to look for creative ways to do that. The other thing that I think would be worth pointing out to all of you because of the roles you have, Indiana is really generous on its scholarship support, especially for students with need-based data. And in fact, we're 5th in the nation and number 1 in the Midwest because I think the state recognizes really well that we need to do that. The other thing, and I just asked for this data the other night, Luke, because of our conversation coming up. For the last 5 years of reporting data, our institutions in Indiana, adjusted for inflation, are negative 1% in tuition adjustments. So they've not quite kept up with tuition in the last 5 years. Now that said, higher ed has been writ large on a trajectory that outpaces inflation for a long time. So anyway, I think a lot of work underway in Indiana, and also though the need really to work with families to help them know what the alternatives are, and frankly for the students to know, because you're right, at the end of the day it is an investment, and people need to be making those decisions wisely.
Yeah, thank you. I'm so glad you brought up, President Daniels' no tuition increase for Purdue, which makes Purdue, a really popular school here in Indiana, also in the nation. In your eyes, do you think that method could have worked out for all the colleges and universities in this nation? If so, we do have inflation, right? We do have to pay the professors and all the labs and all the wonderful toy that I play in college. So how do we conquer that with that price difference?
Yeah, pardon me, I think with any pricing, regardless of what the service or the product is, at the end of the day, we all look for the net price, right? I think Purdue and President Daniels have been genius because they've really made it simple for the consumer. We're holding tuition, we're holding fees, and that's the deal. So it's a really easy thing to follow, Luke. I think where oftentimes the consideration doesn't get made well enough is for the other factors that come into play. So as an example, a number of students in Indiana qualify for Pell, the federal grants, the federal funding. And you include Pell when you include things like the 21st Century Scholarship Program in Indiana, or the O'Bannon Scholarship, or Workforce Ready grants, and so forth. From the gross price to the net price, it's very seriously mitigated. So I think there are a couple of things there. One, Luke, I grew up professionally in a lean manufacturing environment. And as I've told folks all the time, my 20 years there, there was one thing I knew certain. Every year, my new budget was going to be less than my old budget, or something really close to that. It's a lean environment from the Toyota production principles. My point being that I think any institution can look and say, so how can we be more effective and efficient at the same time? But then on the other side of that is also helping to tell the story and say, so our total loaded price at the gross level is $50,000, but our average student, does this, does this, does this, does this. I was looking the other night for curiosity at the Kelley School of Business, which is probably some graduates out here, which is just an exceptional school, and specifically was looking at their MBA program because someone had been talking about it, and I thought, what are the costs? It's phenomenal the degree to which they mitigate their overall costs for their average student at Kelley in the MBA program. It's amazingly generous. But if you only looked at that point at the gross price, you might go, wow, we're up into the six figures whether you're an in-state student or out-of-state.
Yeah, let's switch gear a little bit. So one stats, I don't know if you probably know this more than I do. As a data nerd, as a Rose-Hulman trained engineers, I actually look it up. State of Indiana, it's right behind California in terms of producing engineers. We produce a lot of engineers in the state with Purdue, IU, Rose-Hulman, right? But we lose almost all of them to other states because they rack up the debt of $100,000 and they realize, oh, Google, Facebook, or whoever on the West Coast is going to pay me a lot more to cover that debt, and they would just lose them all. So as a commissioner, how do you propose that we fight that? We want the good people here so that they can enjoy the track, they can be here listening to us mumbling and jumbling.
Yeah, and Luke, I love Indiana. I was born and raised here. I spent 1 year out at Disneyland East. That would be Washington, D.C. And, I think more people ought to live here. They ought to stay here. They ought to have, businesses and families here. So to that end, and thanks for teeing that up, in my new role, I've talked a lot already with commission members, policymakers, business folks, and so forth, that regarding the talent pool, I think there are three levers we can pull much more effectively in Indiana. One is more students leaving high school have to do something beyond that diploma. That high school diploma is just absolutely not enough today, and it's going to be even more challenging to have a livelihood going forward. That's called the going rate, or fancy words, matriculation from high school to college or university or some training. It's been on a downward trend for the last several years across the United States, including in Indiana. We've got to do a much better job of reaching kids and their influencers, their parents, their religious leaders and others to help reverse that trend. Secondly, we've got almost 2 million, let that sink in, almost 2 million working age Hoosiers who do not have a credential beyond high school. That worries me. And it worries me because, as the Brookings Institute, American Enterprise Institute have pointed out, because of the nature of our economy in Indiana, our workers are at most risk of digitization and automation of any state in the U.S. Now, for me, the opportunity is, well, we've got to leverage more programs like the Workforce Ready grant and so forth to help skill up working age adults. And then the last one, Luke, is getting more of those students to stay here in Indiana after they cross the stage at Purdue or IU or Rose or any place else. And it's one, as I've been meeting with the presidents in the last few weeks of the universities, I've raised all three of those and have specifically said, we got to figure out how to keep even just a few more percent of those engineers, of those accountants, of across the board, those individuals. So here are some things we've specifically talked about. IU is my undergrad alma mater, so that gives me license to pick on them. And as I think about the Kelley School, one of the things I absolutely love doing is, and I've spent a lot of time there over the years because I've been involved with the university for many years. I love going through there and seeing the students, talking with the students, seeing the business folks who are there. The students are impressive. And it's just like talking with engineering students at Rose or Purdue and many other students. They look good, they're in their suits, they're sharp, they're ready, got a better resume than any of us in this room, right? They've crafted it really well. And then I look around and a lot of the employers who are there courting them, right? Because it's a courtship. They're courting them and they're luring them away to San Francisco and Chicago and New York and pick some other places. All great places, but they need to stay here, or at least more of them in my estimation. So one of the things in talking with these business leaders, talking with the university presidents and so forth, that I've been asking is just to say, how can we put more of Indiana's job creators at the front of the line? How can we just get a few more folks, and pick your school, I'm picking on IU obviously right now, but how can we get just a few more? And by the way, along the way, the old lean manufacturing person here too, let's set a goal. I was really impressed during a conversation with Jeff Mearns, who's the president of Ball State, probably some BSU graduates here, the other day, and was raising this topic, and he said, I couldn't agree more. And I said, really? And he pulled out 2 pages of paper, and he said, my current percentage right now that I retain upon graduation is 71% in the state of Indiana. And I said, well, that's better than the state average. And he goes, and we have set a goal of 77%. And I said, Jeff, that's what I'm talking about. Setting a goal like that and then backing into it, right, and saying, so how do we move 6 percentage points here? So it's a lot of those things. I think, partly because I spent so many years in business, business has just got to be more engaged with higher ed, and higher ed's got to be more engaged with business. I have sort of a standard joke, that I speak 3 languages: English, higher ed, and business. And right, because sometimes something gets lost in translation between education and business, and I think too many people make that complex. You just got to show up and make clear what it is you're seeking, and again, nudge your way to the front of the line, or say, kind of do a whistle and say, we'd like to be at the front of the line too.
Yeah, so I promised the audience to keep it short and sweet. So I'm going to throw you guys one last stats to circle back to our topic, why ROI optimization is education. Because I did look it up. The CFA Institute actually published a study in 2019 where they look it over all the people who passed the CFA exams and look into how much money y'all make. You guys do make a lot. So for an average CFA, starting salary is $126,000 with a total compensation of $177,000. So maybe you should make the exam much harder. So before I open up to the audience, Commissioner, do you have any last words of wisdom to share with the finance people who make a lot of money?
Well, I think Luke knew I was excited for this. I started talking about ROI a few years ago in higher ed, and I have to admit, I received from some people sort of that deer in the headlight look, and honestly from some folks who said, people should be seeking higher education, for a lot of other great reasons, including enlightenment and so on and so forth. And I said, yes, check all of those boxes, but at the end of the day, people are looking for a return on their investment. Luke may not know this, but his colleagues at Resultant have actually been working with me off and on over the last year to year and a half. He probably does know this, on an ROI model that I was inspired by in Switzerland. Switzerland I've spent a lot of time there over the years in business and then in some training and so forth. They are just wicked good in terms of applying return on investment to, it seems, almost anything that's done either in the private or public sector. And they've been doing that for a long time, and they do it specifically in linking the employment space and the education space. And having connected with some economists over there, I came back and said, I want to try to do this work, especially in Indiana. And so, kind of a pitch for your company, they've been working with me over at Resultant to look at 4 levels, ROI models for individuals, so students for employers, because there's a much greater ROI than I think sometimes employers realize. For government, because I think you should always have to think about justifying your expenditures. And then for other investors like philanthropy, of course, that's really important in Indiana as we think of the Lilly Endowment and Fairbanks and Lumina and all the others that are here. So yes, ROI. And Luke, thanks for doing this today.
Yeah, and I was going to say, seems like you love the model that my company's working on, so I definitely know about it, and I would definitely take credit. If it sucks, it's not me. I know nothing about that. So let's open up to the audience. All right, who has questions for us?
First, I guess I'll preface this by saying I acknowledge that we all benefit from living in a world with more educated people. And I think of my time in college and in grad school, I liked it, I learned a lot. But I also think there's quite a bit of signaling going on there. So my question is more about the ROI trend. Is that perhaps gone down over time, you think? What does that model kind of show? Is signaling picking up, or?
Yeah, so I think it's a stunningly good question. I think one of the trends that we've been seeing, particularly in the last 5 years, call it, is a much better understanding of some of the finite skill sets that are needed that don't necessarily require a bachelor's degree and higher. I tend to think of it as, again, the sub-associate degree space. So that might be an academic credential that's the equivalent of, say, a semester, or it might be an industry certification. And by the way, education is getting better about embedding those, into the different academic credentials. Kind of makes sense. An industry has identified this as valuable. I think in terms of looking at the ROI side of that, we've gotten better. Part of the challenge in the past, I think, was so much that anything below an associate degree, there wasn't very much quantifying of both the skills that came from that and what the skills were the employer community was seeking. So that I think has been a vast improvement. I'll give you a quick example, and this is one of those things. It's been almost quietly going on. I don't know if Governor Holcomb would have mentioned it this morning, but in the last 5 years or so, the state of Indiana has had this program called Workforce Ready Grants, and they're all in that sub-associate degree space. So an academic short-term credential or something like one of these industry certifications. And the way it was set up is that we leverage, your financial people, we leverage the federal dollars. And it's available to any Hoosier who doesn't have a college credential. So, if you don't have a college degree of some type, you're eligible. It's not income dependent. It's not financial aid based. However, we leverage the financial aid. Here's a really interesting thing about how that works and has worked out. By leveraging the federal dollars, which I always remind folks, they are going to go somewhere across the United States. If they're going to go anywhere, let's just have them go to Indiana. By leveraging those, our average cost of these credentials people have been earning over the last 5 years is $315. That's the state's out of pocket for those credentials that average about one semester, okay? The average wage gain for those same individuals this year over the next with that credential is $6,800, right? Even if you start extrapolating out the taxes and so forth that come from that, the extra generation of that, it's just a good deal. Whether you count that wage increase, and now we're seeing the subsequent years of that too, or whether you count the tax generation side of it. So that was a really long-winded answer to your question, but I wanted you to know there's more focus on understanding that that it's not just the bachelor's degree and higher that we probably all traditionally think of, but especially in that really tightly defined skill space, to meet those needs that employers are looking for. And more wisely spending the money, frankly. Sorry.
Apologies, I'm actually not from the state, but I was going to ask you, Chris.
We can recruit you here.
No, maybe. But to the point that Luke was making earlier about his friends being engineers going out to California, we heard in the earlier sessions about the future of work possibly as remote work. So what about the fact of educating the kids from Purdue and Indiana and letting them know if they go to Google, they're going to live in a one-bedroom condo versus they can buy a house here? And even supplementing those policies with like home assistance. If they're going to buy a home and stay here 5 years, what about that ROI? Building for the future, getting people to say, hey, you don't have to deal with the higher prices, the taxes, the earthquakes, the fires, and you can't even water your lawn out there. Why not stay here where you can actually go golfing and water your lawn?
Yeah, those are great points too. I don't know if Elaine Beadle, who probably many of you know, who's leading the, I'll get this wrong, the Indiana Destination Corporation. She's the secretary of that space for Indiana now, and her primary focus is on bringing people to Indiana and keeping talent here, and I've worked with Elaine for many years. But we're all talking about exactly those kind of things. You know, to some degree, first of all, we have to do the early things you said. We've got to let folks know, right? Like young people, let them know some of this stuff if they haven't been thinking of it. And if they do decide to leave at 22 and then they are thinking about family formation and other things like that around 27, 28, 30, 32, then we need to lure them back. But, right, at the end of the day, people respond to incentives. You know, the armchair economist, you don't have to be financial advisors to know that people respond to incentives. So I think all those things are on the table right now. You know, the way Indiana's looking at them. The state had initiated this past year something called READY grants. I can't remember what that whole READI acronym stands for, but different regions in the state are looking specifically at those kinds of things. You know, how can we actually incent someone? You know, there have been programs like that for a long time in the medical profession. Our son's best friend is an ER doc in a small community here in Indiana, was lured with that kind of thing, with incentives to come, we'll pay off your debt, et cetera, for a certain, period of years. They work. So I think all of those things have to be on the table, in addition to just making sure people know this is a great place to live. And I'll give you my card later, see if we can bring you here. Yeah, I'm glad you mentioned that too. That was on my list and didn't know if we would have time, Luke. I think income share agreements are terrific because they provide the consumer yet another option. As of now, Purdue University has had, I believe, about 1,000 students exercise an income share agreement. I could be completely off on that number, but I'm pretty sure that's the number. And I'm being told to wrap it up. The state of Indiana also is working on a progressive income share agreement, very similar, but with some nuance to it. I just think it's another great option for students to have. The more options we can have to, mitigate the costs, consumer options are great. Maybe offline we'll talk a little bit. I'll give you my card too. I think there's much potential with income share agreements that especially higher ed has not figured out yet.
Well, let's thank the commissioner for the wonderful session.
Thank you, Luke.
Yeah, thank you. Hi. Hi, it's me again. Not AC. I'm filling up, I'm trying to fill up for AC because he's a bigger deal to film me for TV, and I'm here standing in front of you. I know it's 4:30. I know that Bud Light's calling my name. I'm not sure about you guys, but let me introduce the very last speaker, one of the best speaker, Judas Thomas. So Judas is the deputy mayor of neighborhood engagement for the city of Indianapolis. Judas has over 30 years of experience in tourism, convention planning, sports marketing, and art culture communities. spent over 13 years as Director of Convention Service for Visit Indy. And she will be my favorite deputy mayor if we fix the potholes. So thank you, Judith. Welcome, welcome.
Can you guys hear me? Yeah, good. I'm bringing my purse up like the queen. Sorry about that. So glad to be here with you all today. The spirit of May is certainly upon us here in Indianapolis at the Motor Speedway. The city of Indianapolis couldn't be more proud of IMS and the great excitement that the month of May brings. Not only that, when I was walking up, there was an actual fox on the track, which I had so many questions. As soon as I was walking up and I caught a glimpse of it, like who missed the fox just walking around? It was fascinating. So on behalf of the city of Indianapolis and Mayor Joe Hogsett, I'm excited to be here with you at the CFA Annual Investment Symposium. As the commissioner mentioned, the Indiana Destination Development Corporation, I'm actually a part of the board, of the foundation board. It is amazing some of the stats that we hear. As you mentioned, the engineers, and how many engineers come out of the state of Indiana. It's the same. I think we're only second to Pennsylvania in out-of-state attendees to colleges and universities in the state of Indiana. And to think that many of them leave, we're trying to figure out a way how to capture that. And that's capture them and keep them here. And that's the entire state and all the universities and all majors, second only to the state of Pennsylvania. So we've got a lot of work to do and we're very focused on it. Indianapolis is a welcoming city and our business community continues to grow and diversify, as you've heard today, with the catalytic projects building a stronger Indianapolis. We continue to be champions for Indianapolis and the great Hoosier state by encouraging financial professionals and companies to move and work here. That's what you guys have been discussing today. The mayor's office appreciates collaborative efforts between the public and private sectors. We are so much stronger when we all work together. I'd like to give a special thanks to Scarlett Andrews, the director of the city's Department of Metropolitan Development, for highlighting what is making Indy an attractive place for companies to call home. From seeing developments at the beautiful Bottle Works, the Stutz Building, Cook Medical Manufacturing, to Elanco's global headquarters at the former GM stamping plant site. There is so much momentum in this city. It's a very exciting time. And I also appreciate seeing the surge in investment locally in venture, recently attending the ribbon cutting for Intellinair. I always get that. I can't get that. There's an accent on there. I can't quite get Intellinair. This is what's interesting. I used to work with the National FFA convention, so I know how important ag business is. But with what Intellinair does, they specialize in agricultural data, crunching numbers, and analyzing aerial and satellite photos, specifically to look for hidden problems lurking in the farm fields. This just fascinates me, like weeds or pests. If the software spots something, the farmer receives a text alert. I mean, how innovative is that? And how game-changing is that in ag business? And this company also had an option to keep their headquarters or move their headquarters to California, but they chose Indianapolis. That shows the impact and what we're doing here in this city and in this state. So I think that's pretty impressive. And I'm looking very forward to the bright future for Indianapolis as our city becomes home to more innovation, bright minds, new companies planting roots. Now, let's wave the checkered flag. Luke, is there really a checkered flag? I mean, am I really waving a checkered flag? That's what I heard. But that's okay if I'm not, but you get the point. So we've got a bright future here in Indy. So glad that you're a part of it and looking forward to the future. So enjoy the month of May. Thank you so much. Oh, well. Thank you all.
Well, that concludes all the sessions we had today. I know it was a long day for everybody. I really appreciate everybody that hung in here. But I just want to say thanks again to everybody, the sponsors, our team, all of you for coming out. I think we really set the groundwork, hopefully, to continue to do this year in and year out and on a bigger basis and, show the Hoosier hospitality, why you should come to Indiana as a destination investment forum and to talk about global issues that are going on and things that the investment world has to face to figure out how to maneuver this ever-changing world, especially over the last 2 years that we might be, entering a new paradigm So thanks again. I also wanted just to say that, something on what Eric Tobias said earlier about Indiana, and there's really this ambition locally. And I feel like, the people that I run around with here locally, I feel like there is a lot of ambition with the younger people believing that Indianapolis and Indiana actually can compete on a global stage, with all the investment, the VC, the startups, and things like that. So, I want to make a shameless plug here. We're looking for new charter CFA board members, and if you want to, get involved with something, try to make a difference, and try to do something new, going into presidency next year, we're going to be entrepreneurial and trying new things like the Hoosier Hub. Things may fail, but you don't know until you try. So if anybody's looking to get involved, I'd love to talk to you. And then again, you said. Let's have a few drinks and have a little fun. Let's network. That's a big part of what our organization is, right? Camaraderie and around our craft of investment, as it is in art. So thanks again to CBRE for sponsoring. In terms of logistics, we'll be hanging out here, but if you guys go all the way down here and take a left, and then take another left, that'll get you to the garages. So if you haven't been there yet today, definitely go check that out, as that's a real cool part of this whole experience. So thanks again. Look forward to talking to each one of you. Thank you.